the market should, what they should be paying attention to in terms of the whipsaw we saw between headlines and how they reacted?
I think we can all be forgiven for not believing or thinking that this new year is 2025, not 2018. 2018 was really the year where all of the policy initiatives got unspooled, and literally you would have, I mean, we would write our research reports Friday afternoon, then you'd hear a tweet and we'd have to rip it up all again for Sunday publication. I think we all need to get used to that. But the cadence of the market being 3 steps forward and 2 steps back does not mean that we're not still in this bull market. It just means it's more volatile, which it should be with valuations where they are.
I remember a lunch we had together in late 2017. You won't mind me sharing this. And you talked about the low volatility trades and the risk of them exploding going into 2018. It was followed by Volmageddon. Do you think this is a 2017 setup or an 18 setup? How do you think about what kind of year we're going into?
Our base case is for volatility, episodic volatility.
Good evening to all of you. आज है 8th of January 2025. Welcome once again to this live analysis. एक बार देख लेते हैं मार्केट को फटाफट से. नेचुरल गैस को देख लेते हैं. कल का ये वो रीटेस्ट लेवल था, कल रीटेस्ट किया था, फिर से थोड़ा सा मैंने बताया था लो लेवल तक आएगा तो वहाँ से फिर से बाइंग हो सकती है. उसी लेवल पे ओपन हुआ था, एक नया सपोर्ट वहाँ पर फिर से देखने के लिए मिल जाएगा अब आपको. कल के एफईजी पे थोड़ा बहुत रुक रहा है प्राइस अभी फिलहाल के लिए, काफ़ी देर से ब्रेकआउट कर रहा है. अगर एफईजी निकाल देता है, कल ही मैंने बताया था, अगर ये 312.13 के ऊपर एफईजी के ऊपर निकल जाता है तो फिर हम एक्सपेक्ट करेंगे 325 के आसपास जाए. तो अगर एफईजी के ऊपर निकलता है तो यहाँ पर भी अगर जो लोग एफईजी से ट्रेड करते हैं वो लोग ट्राई कर सकते हैं. कल काफ़ी देर एफईजी से रेजिस्टेंस अच्छा खासा ले लिया था, सेलिंग अच्छी खासी आ गई थी. अभी काफ़ी ज़्यादा कंसोलिडेशन कर चुका है, तो अकॉर्डिंग एफईजी को अब निकल जाना चाहिए. तो अगर कोई ट्रेड लेना चाह रहे हैं एफईजी के ब्रेकआउट रीटेस्ट पे प्लान कर सकते हैं. इसमें और कोई ट्रेड नहीं है. ऊपर जाएगा तो लगभग 320 टू 323 के आसपास एक वीक रेजिस्टेंस है. ये रेजिस्टेंस है बट बहुत वीक है. थोड़ा यहाँ सेल करोगे तो क्वांटिटी कम रखना है, मिनी वगैरह सेल कर सकते हो. मेजर रेजिस्टेंस फिर आपको सीधा 339 के आसपास मिलेगा. नीचे सपोर्ट फिर से वही 302 एंड देन 288, ये दो भी बने हुए हैं. बाकी डेटा की अगर बात करोगे तो अभी न्यूयॉर्क सेशन ओपन हो जाएगा 6:30 पर. उसके बाद फिर 6:45 पर एक डेटा है, गोल्ड और सिल्वर को इम्पैक्ट करेगा. 7 PM पर एक डेटा है, गोल्ड और सिल्वर को इम्पैक्ट करेगा. 8 बजे यूएस मार्केट की ओपनिंग है. टाइम के अकॉर्डिंग फिर नेचुरल गैस की इन्वेंट्री शाम को 10:30 बजे आएगी. आज ही है, याद रखना. बाकी क्रूड ऑयल की इन्वेंट्री 9 बजे ही है आपकी. क्रूड ऑयल में भी देखोगे तो मार्केट में थोड़ा बहुत याद रखना, न्यूज़ भी आई थी एक, विच इज़ रिगार्डिंग द ट्रम्प की ओर से. ठीक है, दो चीज़ों को लेकर, एक जो टैरिफ वो लगाने वाले हैं, ठीक है, और दूसरा जो हमास ने कैप्चर किए हुए हैं इजराइल के लोगों को, उनके रिगार्डिंग. तो ये दो बहुत मेजर न्यूज़ थी क्रूड ऑयल पे. उसका मुझे लग रहा है मेजर इम्पैक्ट देखने के लिए मिल सकता है आने वाले समय में. पहला, उन्होंने कहा है कि मेरे इनॉग्रेशन 20th of January से पहले सारे हॉस्टेज छोड़ देना, नहीं तो फिर बहुत बुरा हो सकता है. एंड सेकेंड वन इज अबाउट टैरिफ, जिसमें ट्रम्प ने ये कहा है कि वो अपनी इमरजेंसी पावर, मतलब जो उनके प्रेसिडेंट हैं उनकी इमरजेंसी पावर का वो यूज़ करेंगे नए जो टैरिफ हैं, ठीक है, वो लगाने के लिए, अगर, ठीक है, वहाँ की जो बाकी पार्टी उन्होंने सपोर्ट नहीं किया. राइट, तो ये दो न्यूज़ है. ये जो दूसरी वाली न्यूज़ है टैरिफ वाली, दैट इज़ मेजर न्यूज़ एक्चुअली. ठीक है, लेट्स सी इसका क्या इम्पैक्ट पड़ता है. वैसे ये जो न्यूज़ है इसका इम्पैक्ट एक तरह से नेगेटिव ही होना चाहिए था. लेट्स सी. बाकी क्रूड में देखो, यहाँ पर एक रेजिस्टेंस है, सेल करना चाह रहे हो तो यहाँ से एक थोड़ा बहुत सेल कर सकते हो. थोड़ा न्यूज़ का ध्यान रखना. बाकी नीचे एक सपोर्ट आपके पास 6374, और फिर एक वो जो नीचे वाला वीक सपोर्ट कल का, ये 6284. बाकी अगर ऊपर निकला तो फिर देखना पड़ेगा, बिकॉज ऊपर कोई और रेजिस्टेंस सब बचा ही नहीं है. इतना पीछे लेवल दिख नहीं रहे 15 मिनट में. तो ब्रेकआउट रीटेस्ट हुआ तो फिर वी विल सी कि मार्केट कहाँ तक जाता है. थोड़ा बहुत वो न्यूज़ की वजह से वॉलेटाइल हो सकता है क्रूड स्पेशली. गोल्ड और सिल्वर को भी देख लेते हैं. गोल्ड के लेवल वैसे मैंने बनाए नहीं है, रेजिस्टेंस पे था, कल सेलिंग आई थी. उसके बाद वहीं पर रुका हुआ है. देख लेते हैं अभी गोल्ड में, ठीक है। एक बार पहले एक बार सिल्वर देख लेते हैं। सिल्वर में मार्केट के पास देखो कल वाला रेजिस्टेंस था, थोड़ी बहुत सेलिंग आई थी, फिर नीचे आके सपोर्ट लिया, वहीं पर रुका हुआ है, कुछ खास जा नहीं रहा ऊपर नीचे। दोनों ही लेवल ठीक ठाक ही हैं, अब कहीं ना कहीं तो ब्रेकआउट ब्रेकडाउन करेगा। देखो ऊपर का जो रेजिस्टेंस है वैसे टेस्ट तो हो गया है, और नीचे का सपोर्ट भी कुछ ज़्यादा ही टेस्ट हो चुका है। तो ये दोनों ही लेवल मल्टीपल टाइम सपोर्ट रेजिस्टेंस ले चुके हैं। अगर अब ये वापस नीचे आता है तो ब्रेकडाउन के चांसेस बनते हैं, तो 29.97 के नीचे ब्रेकडाउन रीटेस्ट पे एक सेलिंग का प्लान रख सकते हो। अगर बाइंग में हो तो अपना एसएल स्टिक रख लो 29.97, इससे ज़्यादा बड़ा एसएल लेना मत। ऊपर निकला तो मेरे अकॉर्डिंग ब्रेकआउट होना चाहिए, वही 30.40 एक छोटा सा रेजिस्टेंस रहेगा। इसका ब्रेकआउट रिटेस्ट हुआ तो फिर मेजर रेजिस्टेंस 30.78, तो 30.78 एक अच्छा रेजिस्टेंस है, यहाँ से सेलिंग प्लान कर सकते हो। बाकी ये 30.40 और $30 ये दोनों ही वीक सपोर्ट वीक रेजिस्टेंस है। अब किसी ने भी बाई सेल अगर किया हुआ है ऊपर या नीचे से तो अपना एसएल थोड़ा ट्रेल कर लेना। बाकी ब्रेकडाउन ब्रेकआउट हुआ तो अच्छा मूव आ सकता है उस केस में। न्यूज भी है तो वेट फॉर द न्यूज एज वेल। बाकी नीचे आया तो फिर वही 29.47 एक और सपोर्ट है, दैट इज द नेक्स्ट सपोर्ट एरिया। ये डेटा इंपॉर्टेंट है 7 PM वाला, विच इज़ अनएम्प्लॉयमेंट क्लेम्स। गोल्ड भी देखोगे तो ऊपर वैसे ही ये कल काफ़ी डीप लेवल से सपोर्ट रेजिस्टेंस लेके आया है, तो 2660 इज़ अ लास्ट रेजिस्टेंस कह सकते हो। लोअर लो बना नहीं रहा है यहाँ पर, देखोगे ना प्राइस एक्शन थोड़ा सा। अगर ये नीचे नहीं आया और वापस ऊपर चला गया तो ये कुछ इस तरह का प्राइस एक्शन बिल्डअप हो सकता है यहाँ पर। इसको अगर थोड़ा बेरिस होना है तो नीचे आ जाना चाहिए, नया स्विंग बनाना चाहिए इसके नीचे। तो ऊपर लास्ट रेजिस्टेंस 2660, वहां से ट्राई कर सकते हो एक बार फिर से सेलिंग, नहीं तो ब्रेकआउट करा 2663 के ऊपर तो ब्रेकआउट रीटेस्ट पे बाय। नीचे अभी सपोर्ट कुछ खास मुझे दिख नहीं रहे, लेट्स सी देखते हैं सपोर्ट कहाँ पर है। नीचे वाला सपोर्ट है ना, ये भी थोड़ा वीक है क्रूड का, ठीक है, ये थोड़ा सा वीक सपोर्ट है, तो थोड़ा सा इसको ध्यान रख के ज़्यादा क्वांटिटी मत लेना अगर यहाँ पर प्राइस आता है तो। करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम एंड सब्सक्राइब द चैनल एज वेल। बाकी देखो एक नया फीचर धन ने और लॉन्च कर दिया है, ठीक है। जैसे यहाँ पर अभी आप लोग अगर ट्रेडिंग व्यू का टर्मिनल यूज़ करते होगे तो आप टिकर यूज़ करते होगे, आई होप सो, ठीक है। अलर्ट्स यूज़ करते होगे, वहाँ भी कर सकते हैं। बट अभी फ़िलहाल के लिए अगर आप चार्ट को पीछे करना चाह रहे हो, मतलब रिवाइंड करना चाह रहे हो, तो रिवाइंड का जो चार्ट है वो हायर टाइम फ्रेम पे काम करता है फ्री वाले वर्जन में, मंथली डेली और वीकली टाइम फ्रेम पे। नीचे स्मॉलर टाइम फ्रेम जाओगे 15 मिनट, 1 आवर, 4 आवर, 5 मिनट, उसमें ये रिवाइंड वाला का बट फंक्शन, बार रिप्ले वाला फंक्शन वर्क नहीं करता है। तो धन ने अभी लॉन्च कर दिया है, अगर धन का आपके पास चार्ट है उसको आप डायरेक्टली ट्रेडिंग व्यू से भी कनेक्ट कर सकते हो, बाय द वे। यहाँ पर धन का यहाँ से भी चार्ट को कनेक्ट कर सकते हो, या फिर धन के अगर वेबसाइट पे ट्रेड करते हो तो उनकी वेबसाइट पे भी ओपन कर सकते हो, दोनों जगह पे। वहाँ पर आप ये बार रिप्ले का ऑप्शन आप यूज़ कर सकते हो फ्री ऑफ कॉस्ट, ठीक है। ये फंक्शन वहाँ पर अवेलेबल हो चुका है नया, और ये फंक्शन आते रहेंगे तो वी विल लेट यू नो, आई विल लेट यू नो। बाकी जिन लोगों ने धन में अकाउंट ओपन नहीं किया, करना है तो लिंक आपको डिस्क्रिप्शन बॉक्स में मिल जाएगा, कमेंट बॉक्स में भी मैंने पिन किया हुआ है।
of Wells Fargo. Two-day winning streak on the S&P 500, leaving behind that 5-day losing streak to close out and begin 2025. Equities right now on the S&P 500 up by 0.1%. On the Nasdaq, up by 0.1% also. On the Russell, the small caps doing okay, up by 0.2%. Lots to talk about in the bond market, particularly at the longer end of the curve, and we can start from 30s and work our way in. The 30-year yield is up a single basis point in the US at 4.86, so close to levels we haven't seen since late 23. In the UK, close to levels we haven't seen since the late 1990s. Starting to look a little bit painful in British markets.
Especially when it's not accompanied by the growth that a lot of people are expecting in the United States. And it really produces this quagmire that, frankly, both the Bank of England and the ECB are facing, which is inflation is proving to be sticky, even at a time where they need to generate some growth and, frankly, might limit how much they can cut rates.
Sterling doing better this morning. Cable, the pound, doing better against the US dollar. In the last 24 hours, everything was doing better against the US dollar. Really, that was initiated by that report coming out of the Washington Post, suggesting that the incoming aides of President-elect Donald Trump were thinking about or proposing ideas that would water down a universal
न्यूज है वो एक्चुअली। प्लस सिल्वर का बेस्ट लेवल तो ऐसा कुछ नहीं है। लेवल मैंने बता दिए फिलहाल के लिए, गोल्ड में और सिल्वर में उनको देख सकते हो। वैसे न्यूज है तो थोड़ा ध्यान रखना, न्यूज पे ज़्यादा कुछ ऊपर नीचे खास हुआ नहीं। तो सिल्वर में तो कल वाला रेजिस्टेंस ठीक ठाक है, मतलब 30.40, फिर एक मेजर रेजिस्टेंस ऊपर 30.78, नीचे एक सपोर्ट 29.47 एंड देन 28.30। ये तो काफ़ी अच्छा है, सबसे अच्छा है। These two are best। बाकी करने को तो यहाँ पर ब्रेकडाउन रीटेस्ट पे भी सेल कर सकते हो। अच्छा सपोर्ट है, काफ़ी देर से रुका हुआ है, अगर नहीं रुकता अब तो ब्रेकडाउन रीटेस्ट पे सेलिंग भी अच्छी आएगी। बट याद रखना डेटा भी आने वाला है कंटिन्यूसली, 6:45 से डेटा स्टार्ट हो जाएंगे। क्रूड वीक लेवल लिखा हुआ है, ठीक है। इसका मतलब ये नहीं कि वहां से सेलिंग या बाइंग नहीं आ सकती, बट थोड़ा सा कमजोर वीक रहेंगे, ध्यान रखना।
Question here of whether he can come through with this and whether NVIDIA is just showing why NVIDIA will be the biggest winner of this transformation and not that broadening out.
Well, they have the software component, they have the chip component, and now it feels like they're going to be pervasive everywhere. And it goes back to what Julian Emmanuel said at the start of the program, which is basically this is an inflection point this year for AI and adoption and how we see it really circulate across consumers and everything consumers use.
And we've got the conversation that matters coming up on Bloomberg TV. Do not miss this. 11:30 Eastern Time on Bloomberg Television. Bloomberg's Ed Ludlow will be sitting down with Jensen Huang live from CES in Las Vegas. Must-watch TV a little bit later this morning. Elsewhere, the US blacklisting Tencent and CATL for alleged links to the Chinese military. Both companies pushing back, saying they have no ties with the military. The move threatening to disrupt the global EV market, with Tesla and other major automakers dependent on batteries made by CATL. Tencent came out and said this must be a mistake. We have no relationship whatsoever.
The issue is the fact that if you are a Chinese company, what U.S. officials will tell you is they have an obligation sometimes, if there's a national security concern, the CCP comes to you and says, we need to know about this. They have an obligation then to share that information with the
सिरल जी नेचुरल गैस बाई किया अभी एफईजी से। अरे उसमें रीटेस्ट तो होने दो, अभी ब्रेकआउट ही हुआ है, रीटेस्ट होने दो एफईजी में। अगर ये एफईजी ब्रेकआउट रीटेस्ट करता है तब ट्राई करना। एफईजी के लो पर ही रखना पड़ता है सेल उस केस में, अगर एफईजी से बाई सेल करने का प्लान कर रहे हो। बाकी नहीं तो नीचे सपोर्ट है 302 के आसपास। एफईजी से अगर बाइंग का प्लान है, थोड़ा ब्रेकआउट रीटेस्ट पे प्लान करना, ठीक है। और थोड़ा सा अभी 6:30 भी होने वाला है, न्यूयॉर्क सेशन भी ओपनिंग है, उसका ध्यान रखो। क्रूड ऑयल उससे ज़्यादा अच्छे लेवल पर है। ये कल वाला ही एफईजी है, ध्यान रखना। सपोर्ट जी, वॉइस लगता है रिकवरी हुई है, हेल्थ हाँ थोड़ी बहुत। लाइक भी करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम। 15th जनवरी।
All of this, Meta elsewhere, electing 3 new directors to the board, including Ultimate Fighting Championship CEO Dana White. White has been a vocal supporter of President-elect Donald Trump, speaking at the Republican National Convention and Trump's election night event.
This is just another one of the big tech companies that are adding more conservative members to their boards. This does come after Mark Zuckerberg does have a relationship with Dana White going back, so it's not completely out of the blue. Should note that. At the same time, it kind of speaks to the point you're making earlier, which is companies are adapting and adjusting to this new political regime, and they're doing so at a very quick pace.
They're adapting to the fact that the election showed this is a center-right country at the end of the day. And it's not just Dana White, which when I view him, I just remember Trump being at the RNC talking about the fact that he decided to leave his vacation early to come here personally and introduce Trump. Not Melania Trump, Dana White introduced Trump at the RNC. So when you think of him, you do think of the Trump world. But also, Nick Clegg is out. You guys talked about this last week.
Yep.
Joel Kaplan, deep Republican ties, is now the man that has to deal with policy.
Watch this space. It's not the first, not the last. The winds of change. We're going to see a whole lot more of this through 2025 and maybe even beyond. Let's turn to Canada. Prime Minister Justin Trudeau resigning as head of the Liberal Party after more than 9 years in power.
I have always been driven by my love for Canada, and Canadians deserve a real choice in the next election. And it has become obvious to me with the internal battles that I cannot be the one to carry the Liberal standard into the next election.
And given where the polls are right now, 20 points behind the Conservatives, that choice might turn out to be a big change. And there has been a major change. Go back to the G7 photo in the south of Italy 6, 7, 8 months ago. Anne-Marie, you were down there. How much that's changed in the last 6 months, half a year?
We talked about it. I was reporting live from Bari that this was
चल गैस 12 बजे से साइडवेज है, वो कल वाले एफईजी पर ही रुका हुआ है। अब मूव कर जाएगा मेरे अकॉर्डिंग 6:30 के बाद। वो कल वाला एफईजी था, अगर रेजिस्टेंस लेने की कोशिश बहुत किया है, अभी भी रुका ही हुआ है। अगर ब्रेकआउट रिटेस्ट हुआ तो अच्छा सपोर्ट बन जाएगा, बुलिश हो जाएगा मार्केट। नहीं होता है तो फिर वही 302 एंड 288। दिस इज यस्टरडेज एफईजी एरिया। यस, इन्वेंट्री भी है आज।
is a lame duck lineup of leaders except for one, Georgia Maloney, who basically greeted everyone. It felt like they were all going there to kiss the ring in southern Italy of this new leader of Europe, this Principess of Europe. Yeah, Emmanuel Macron's there, but he has been dealt a huge blow domestically. She's really the only
डीके हो रहा है, हाँ साइडवेज डीके ही होगा। अभी थोड़ा वेट कर सकते हो 6:30 का, नेचुरल गैस में, नहीं तो 6:30 के बाद थोड़ा मूव कर जाए। अगर और थोड़ा साइडवे चला गया तो फिर और ज़्यादा थीटा डिके होने के चांसेस बढ़ जाएंगे। नहीं है, एफईजी के ऊपर जाएगा नहीं जाएगा, अगर एफईजी से वापस रिटर्न कर गया तो फिर नीचे ही आना है। ऊपर जाना है तो एटलीस्ट एफईजी के ऊपर एक प्रॉपर ब्रेकआउट रीटेस्ट होना चाहिए। इन्वेंट्री यस 10:30 इंडियन टाइम के अकॉर्डिंग। हाँ, क्रूड ऑयल ने भी यहाँ पर एक पुट साइड का ट्रेड प्लान कर, सेलिंग साइड का, पुट का नहीं है, मैं पुट नहीं बोल सकता, सेलिंग का प्लान कर सकते हो। 6445 ये जो रेजिस्टेंस जोन है, नीचे ध्यान रखना, नीचे वाला सपोर्ट जो लिखा हुआ है थोड़ा सा वीक है। बाकी क्रूड ऑयल थोड़ा सा वॉलेटिलिटी ज़्यादा दिखा सकता है बिकॉज ऑफ द न्यूज़। इन्वेंट्री की बात नहीं कर रहा हूँ, ओवरऑल न्यूज़ की बात कर रहा हूँ। बाकी 6:30 और 8 PM पे ध्यान रखना मार्केट का, न्यूयॉर्क सेशन और यूएस मार्केट की ओपनिंग पे।
France, maybe a little bit less so. There's still a lot of consternation, and it could be messy if there's another election this summer. Canada, though, this is all about tariffs, in my opinion. You know, domestic policy in Canada is not really moving the currency markets all that much. Question is, how fast does Poilievre come into power? How fast can he get into these tariff negotiations? Fortunately, I'll say, Trudeau, I'd say, sent some positive signals after his visit to Mar-a-Lago at the end of last year. I think Canada, on the whole, can avoid the worst of the tariff sort of issues and implementation, but it's going to be a rough ride for the next few months here.
Eric, I just want to underscore something you said. Essentially, it doesn't matter who comes, who goes, the leadership of any of these countries. What matters is tariffs, in terms of just where the currency is, and that has been the reason behind the loonie strengthening over the past couple of days, as well as the euro. Is that correct?
In the case of Canada, absolutely. Again, I don't see any real material change in domestic economic policy, maybe some slight fiscal tightening from the Conservatives in Canada if they come into power. I think Germany is a different story. Tariffs matter hugely, but so too does domestic policy, right? We know the German economy has lagged for a long time. They need debt brake reform. They need to unlock some of that fiscal spending. I think Merz is the kind of candidate that can deliver that. The question is, does he have the backing, right? Does he have that supermajority in the Bundestag to really deliver that? And that's what we'll have to find out at the end of February.
There's also this sort of question around Europe, which is how do you pair tariffs with the idea that inflation is sticky and might limit how much the ECB can cut rates? How do you sort of juggle those two ideas?
I think tariffs themselves are probably not inflationary to the extent they're going to move the needle on ECB policy. If anything, they're probably demand negative. We know Germany in particular, very manufacturing export dependent. But if you look even pre-tariffs, just the last few weeks, some of these inflation prints we've been getting out of Europe have been a little bit hotter, right? You look at the just this morning, the ECB inflation expectations figures, pretty strong. And German inflation numbers yesterday also on the hot side. So we're coming into this with a little bit of actually fresh momentum in European inflation. That's going to make the ECB's job more difficult. And one reason why we think that sort of front-end, short-end rates in Europe and Germany have some room to recover here alongside the euro.
Eric, what did you make of the whiplash we saw yesterday with the Washington Post story talking about how this might be a more narrow, targeted approach on critical imports into the United States, and then Donald Trump walking that completely back? When you see that episode, really on one of the first big trading days when people are back from the holidays, what did you learn from that potentially you're going to be looking out for the rest of 2025?
We saw this just time and time again in 2017 and 18. And I think my takeaway is there's some kernel of truth to the story. I think there probably is an initiative being worked on by the likes of Bessent, Lutnick on this sort of initiative. I don't know that it's the only initiative, right? There's still the U.S.-China piece, which I think is really its own track for tariffs that wasn't really mentioned as part of this story. I suspect that is something that's being worked on in parallel. There's a lot of Section 232, Section 301. I think it's going to be a multifaceted approach on tariffs this year. I think Trump's denial is not necessarily that surprising, right? You don't want to necessarily signal, hey, actually, all that tough talk I had on the election campaign, it was really just bluster, right? You don't want to send that message. So I think there is a kernel of truth to this. I do think that, our baseline is that we're not going to get 20% tariffs on all countries, on all goods, right? I don't see that happening. I think what it really reveals, and you were talking about this earlier, is positioning, right? You just needed one headline to get a little bit of relief in this dollar strength trade. I think it's going to be a very back and forth year for the dollar. We're still bulls on the dollar, but I realize short term we could see a little bit more consolidation and some dollar weakness the next few weeks.
If we could just build on that kernel of truth and coming back to Canada where John started the conversation, if it was to be critical imports, what would that mean for Canada?
Well, Canada is a big exporter of iron and steel to the U.S. So if this is going to be via Section 232, sort of a national security route for tariffs, yeah, Canada is going to be certainly in the crosshairs. It's not, at the end of the day, energy is really what Canada tends to export to the U.S. primarily, right? So as long as that's not included, Canada is going to avoid the worst of this. There's also some sort of off-ramps, some side letters in the USMCA agreement that actually allow for some delay in tariff implementation between the U.S. and Canada. So that's also sort of working in Canada's favor here and potentially helping to at least delay or at least maybe ideally allay some of the biggest concerns from U.S. putting tariffs on Canada.
Eric, good to see you. Great to catch up. Eric Nelson there of Wells Fargo on the latest and the changing face of the G7 in the past 6 months or so. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Sticking with President-elect Donald Trump, he is looking to keep the special counsel's report against him from becoming public. Trump's lawyers are arguing that the report should not be released, citing Jack Smith's political motivation and desire to undermine the transition. Smith had dropped his case against Trump after the election, citing long-standing DOJ policy against prosecuting sitting presidents. Getty Images and Shutterstock have announced that they will combine in an equals transaction merger. The combined company will have an enterprise value of about $3.7 billion. Once the merger is finished, the company will be named Getty Images Holdings and continue to trade under the ticker GETY. Shares of both companies, as you can see, are much higher in the pre-market. Home prices in the UK have dropped for the first time in 9 months. Average prices fell 0.2% in December to just over $370,000 US. They had climbed to a record high last summer. The drop in prices is attributed to stuttering economic growth and high mortgage rates, which are expected to continue to pressure the housing market. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next, the Fed's fight against inflation.
I think the bigger risk is reacceleration, not only of inflation, but of the economy, too. All of this is just suggesting that the acceleration story is going to be the bigger issue.
Apollo's Torsten Slok, up next.
Sea cargo is responsible for 3% of global greenhouse gas emissions annually, and ports are a major contributor. As Mexico's first carbon-neutral port, ICTSI subsidiary Contecon Manzanillo is setting the standard for progress. By deploying electrified cranes and tractors, recycling and reusing resources, and offsetting emissions by allocating resources to preserve critical ecosystems. This demonstrates how ports can be drivers of positive change and sustainable growth.
Two-day rally on the S&P 500. Can we make it day 3? Equities just about positive on the S&P. Under surveillance this morning, the Fed's fight against inflation.
I think the bigger risk is reacceleration, not only of inflation, but of the economy, too. Add into that the inflation rate is not getting to 2%. There is an argument to be made that it is stalling at around, the high 2s if you measure it by CPI. Because we're at the same levels on year-over-year CPI that we were 7 months ago. And all of this is just suggesting that the acceleration story is going to be the bigger issue.
So here's the latest this morning. The US 30-year bond yield climbing to its highest level in more than a year as investors remain concerned over a potential reacceleration of inflation. Torsten Slok of Apollo noted the impact of the Fed cutting 100 basis points, writing the bottom line is that Fed cuts and associated developments in financial markets will boost GDP over the coming quarters by 1 percentage point and boost inflation by 0.5. Torsten joins us now for more. Torsten, good morning.
Morning.
It's good to see you, sir, and a happy new year. You wrote, and I think it's important to recognise, they cut 100 basis points in September, and yields moved 100 basis points in the other direction. What do you think explains that?
Well, that is really unusual. I mean, normally the textbook would say if you cut interest rates, long rates should also be going down. So why is it that when they have cut 100 basis points in September, that we've now seen long rates go up 100 basis points in September? And that's opened up a lot of conversations about, is this because Fed cuts were not warranted? Is that because of fiscal policy? Or is it because of less demand from abroad? There's just a very important quantification debate around why is it long rates are going up. And an important part of that question is that the term premium has gone up 80 basis points, at least according to the New York Fed. So using that measure, 80% of the increase in long rates since September has potentially been driven by worries about fiscal policy, at least issues that are not explained by changing Fed expectations.
So which of the three questions, which of the 3 points that you're making do you lean on as a reason behind the rise in yields?
Well, the challenge is when you do these decompositions and trying to quantify what are the sources of why long rates are going up, is that you don't know this unexplained factor in the term premium, what's driving that. Is that because of fiscal worries? Is it because of, some people say it's just some technical issues with the yield curve steepening? In my view, I think at least it tells you that there's something else going on, because if you look at the chart, it is just really unusual that long rates are going up when the Fed is cutting. So that's why, if it is because the market is worried about fiscal issues, then of course we need to think about, well, what are the consequences as we get some fiscal news potentially over the next several weeks.
A number of people have said this is a good thing and people should embrace it. You see an actual normalization of the yield curve, and that's fantastic. You have a newly positive yield curve, 210s now, the steepest going back to 2022. Do you think that it is a positive development or a negative development?
Well, I think what's lying underneath this is that the expectation was that, when the Fed starts cutting, they always cut a lot. And of course, over the last several quarters, the expectation was that the Fed will cut a lot more relative to what's priced in at the moment. So now, of course, markets are pricing that rates will stay higher for longer, and therefore we will not get all these cuts. So the question, therefore, is, well, is that good or bad news? Well, it's good in the sense that the backdrop is that the economy is still strong. But the bad news, of course, is that rates higher for longer will continue to weigh, in particular, on balance sheets that are weaker. Companies with a lot of leverage, companies with low coverage ratios will continue to get hit by rates higher for longer. So higher for longer has a number of consequences that are bringing back memories of what we saw in 2022 when you had rates going up and stocks going down at the same time.
With yields higher over the past since the Fed has been cutting, and you're saying some of this is driven by fiscal, we haven't gotten the fiscal package yet. But the incoming Trump administration has made it clear in the first 100 days they want to see something, whether or not it's one reconciliation bill or two. So basically, is that just saying to the Fed, you're on pause until we see exactly what comes out of this proposal?
Well, and I think also to your important point here that it used to be that these bills would be two separate bills, one with border and security in the first bill that would be dealt with first, and then later we'll deal with what's going on the tax front. But combining all this, of course, raises the risk that I'll get a Bloomberg headline saying some pretty significant number in terms of what the deficit impact is. So if you do have a bigger risk of a higher headline number, that also raises at least modestly the probability that we'll get some at least potential Liz Truss moment where we could see a fairly significant number coming out, where instead of doing it drip-wise throughout the year, having a big number where suddenly markets say, wow, there's already QT going on, there's a stock of T-bills that need to be rolled over, and on top of that, we already have a 6-7% budget deficit. All that combined means that Treasury issuance continues to be a very important topic.
What does that Liz Truss moment look like in the United States?
Well, the risk, of course, is that if there is a still very significant budget deficit, and if we still have significant issues with, again, the number of T-bills outstanding, meaning short-dated debt that needs to be rolled over, we still have QT. There's a lot of conversations about when that potentially will end. And on top of that, if we do have new fiscal deficit spending and a number that's much bigger than what the market is expecting, that certainly raises the probability, at least, that we might have some situation where the markets are saying, wow, that's a lot of Treasury issuance. We already have discussions literally every day when we have a Treasury auction around, hey, what was the metrics on the auctions and what are these numbers telling us in terms of the overall fiscal sustainability, which Jay Powell, of course, always keeps on pointing out is already unsustainable.
Lisa mentioned it already this morning. We get a 10-year a little bit later. You wrote about it to close out 24. The risk of a 2022 repeat in the market, how great is that risk?
I think that is much higher than what the market is the probability the market is assigning at the moment. Because remember, the key issue in 2022 was that the 60-40 portfolio really underperformed because rates went up because inflation was going up, and at the same time stocks went down. And now we've had the Nike swoosh has been flattened out on Fed expectations. So therefore, if we now are getting back to Fed expectations being roughly flat, we have a few cuts priced in. Imagine if suddenly those expectations start to move up, that people are saying, well, maybe we'll get another hike. I do think a lot of equity investors will be looking at that and saying, well, in that case, you already had the trailing PE on Tesla at almost 200. That's why some of these stocks on a trailing PE basis are incredibly expensive. And if you now have that, well, maybe the Fed has to do something more, meaning hike rates again, well, then I do think some of these more sensitive names, they will certainly see a bigger hit. So that's why, given all the stocks returns have been driven by a handful of stocks, I do think that that makes it much more sensitive to if, again, the Nike swoosh sweeps up and we do get a situation where the Fed is pricing in more hikes coming.
Torsten, a clinic, as always. It's good to see you, sir.
Thank you.
Thank you. Torsten Slok there of Apollo. In a second hour of Bloomberg Surveillance, just around the corner, we'll catch up with Keith Lerner of Truist, Republican Congressman French Hill, Jason Thomas of Carlisle, and former Chicago Fed President Charles Evans from New York. This is Bloomberg.
We ended the year on a bumpy note. We sort of started the year on a bumpy note because we know that we need more clarity. We need more answers.
One of my core beliefs about politics and markets, whatever it is, you have to go through some temporary repricings.
We are at levels that are problematic for the stock market.
We'd expect another strong year, just not to the same extent of 2023 or 2024.
I think we're seeing probably more opportunities in the equity market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Bouncing back from the longest losing run since April. Two-day winning streak on the S&P 500. The second hour of Bloomberg Surveillance starts right now with equity futures up by about 0.1% on the S&P, just about unchanged on the Nasdaq 100. Loads of economic data this week, including payrolls on Friday. Later on this morning, JOLTS job openings, the ADP and claims report you will get tomorrow. Bear in mind, jobless claims usually comes on Thursday, but we've got the late President Jimmy Carter's funeral on Thursday, so claims are brought forward. And also keep one eye, maybe two eyes, on the debt auctions coming a little bit later. Lisa, very focused on this. 10-year notes later on and 30-year bonds tomorrow.
Yeah, $39 billion of 10-year notes today at 1 p.m., $22 billion tomorrow of 30-year notes. And yesterday's 3-year auction didn't go phenomenally. And we should note that usually shorter dated paper does better. If you are having your eyes glaze over as you listen to this and you're saying, really, this again? This is incredibly important at a time where yields on the long end have backed up dramatically, and you see them much higher than the ones in the short end, the highest levels that we've seen going back to 2022, which really has a huge impact on all financial instruments.
Garfield Reynolds, market strategist at Bloomberg, was talking about how bond investors may face a lose-lose dynamic coming out of Washington. Well, actually, this week, I'm also looking forward to this reporting that President-elect Trump will be sitting down with Republican senators. We just talked about this with Torsten Slok about how they may see maybe one huge reconciliation package. The bond market might find that very uneasy, and it might unnerve them. Maybe they would need to do two, and potentially these senators can assuage him.
And not just the US bond market, but the global bond market. What happens here is going to put the fiscal squeeze on everybody else abroad. I think the headline that we got out of the UK this morning is pretty clear on that fact, that we've got a UK 30-year yield at a high we haven't seen since the late 1990s. And that's certainly not about growth. And that was your point in the last hour. That's about something else.
It's about debt auctions in the UK. It's about U.S. rates. And it's about the fact that inflation has remained stickier across Europe, across the U.S. It raises a question. Are we in a secular inflationary environment that is going to make it very difficult to see rates come down to levels that a lot of these countries need in order to get the growth that they want? And that is the reason why people are trying to answer the question that Torsten Slok was just asking. Why? Why the incredible rise, and how sticky is this?
They've lost fiscal space in the UK. They've lost fiscal space in France. And if the United States comes out with increased debt and deficit spending, they're going to put the squeeze on these countries even more. So what does it mean for markets? Well, Torsten Slok of Apollo is making the case that maybe a big risk for this year is a repeat of 2022. Bad for bonds, bad for stocks. Bad for both.
Well, this is the reason why people are sort of wondering, what regime are we in? And we go back to what Stuart Kaiser was talking about, 2017 or 2018. If you have a situation where the prospect of another Fed rate hike could come back on the table, how much could that torpedo already elevated equity valuations at a time where people still have not wrapped around their heads what the idea of higher for longer actually means for risk assets.
The problem with that is that President-elect Trump is not going to accept a market that's bad for bonds and a market that's bad for stocks, which may mean that might be the ultimate check on what he does in power.
3 minutes of market coverage for the bears. That's enough of that. Equity futures right now in the S&P 500. That was so negative to start this hour. Equity futures on the S&P just about positive. On the Nasdaq 100, we're doing okay, just about unchanged.
Can I just add some positivity?
Please do.
Okay, maybe yields are higher because growth is actually going to do really well, and we're going to get the efficiency from the godfather of AI, Jensen Huang, and his rock star jacket, and he's going to come out and transform the way that we live.
It's a nice bullish story to help you sleep at night. Coming up this hour, Keith Lerner of Truist, as stocks look for a third straight day of gains. I would not let you narrate my stories to sleep at night. Congressman French Hill on President-elect Donald Trump's agenda, and former Chicago Fed President Charles Evans on the Fed's timeline for a return to 2%. We begin this hour with stocks high. The S&P 500 and the Nasdaq seeing back-to-back gains as investors begin to pile back into big tech. Keith Lerner of Truist cautiously optimistic, writing the primary market trends remain higher, driven by a resilient economy, supporting solid earnings growth near 10% in 25, yet investors should anticipate a bumpier path relative to last year. Keith joins us now for more. Keith, welcome to the programme, sir. Why a bumpier path this year compared to 24?
Yeah, well, great to be with you. Our outlook theme is a bull in a China shop. So kind of as you mentioned, the primary trend is up, but it's going to be delicate. There's going to be some things that are likely broken. I think what we look at, the November pop in the market, then followed by the December pullback, is kind of a microcosm of what to expect. I think one thing, just as a starting point, as far as why it might be a pumpier ride, is expectations, right? Expectations are much higher this year, and markets are all about how things come in relative to expectations. You have to remember, coming into last year, the consensus was looking for GDP growth for the U.S. economy around 1%. It looks like that's going to be around 2.5% for 2024. As we move into this year, we already have those expectations that are somewhat higher. And then, of course, the battle that we all know between the potential good and the potential bad of Trump's policies.
And Keith, why you should have maybe a little allocation to gold in the portfolio. Keith, why does that make sense this time around?
Well, it's just something that's as somewhat of a portfolio diversifier as a whole, and also kind of the geopolitical uncertainty that we're seeing. Central banks are continuing to buy gold. In fact, we just saw a headline this morning from Bloomberg about China continue to start buying gold again. So we just think that's a good hedge relative to just a stock and bond portfolio.
Keith, the fact that you even want to hedge to the stock and bond portfolio is interesting, especially in light of our conversation just moments ago with Torsten Slok of Apollo. The idea that maybe we could see a repeat of 2022 when both bonds and stocks did poorly, simply because you might have some sort of reemergence of inflation that could prompt the Fed to hike rates. Is that on your bingo card at all for 2025?
Well, it's certainly a risk. We don't think it's the most likely scenario, but I think this, if you look back over the last 18 months or so, when we've seen rates move above 4% and move at a quick velocity, that's been the struggle for the market. It's not just getting above 4 or 4.5%, it's the pace at which we've moved. And if you look at the bond market, which you all have been talking about this morning, really to us, the main reason for the recent move up is you're seeing that term premium, that uncertainty factor really start to rise at a more rapid pace. So I do think that is the risk. But I would also say it probably has to reset on how people think about investing. Now, part of the reason back to tech is because of this, because if you think about small caps as an example, where a lot of people got more positive after the election, they're basically back to where they were pre-election because those interest rates are somewhat higher. So if rates are going to be somewhat higher for longer, which we think is the case, it's going to be hard for something like small caps, which have a lot of floating rate debt, to outperform. And we've been bullish tech all last year in communications, and we're still bullish now. Just an interesting tidbit, not a recommendation, but NVIDIA peaked in June of last year. It was actually flat, or actually slightly negative from mid-June to the end of last year. Semiconductors are still about 7 or 8% below the lows from July. So even though we've had this kind of ramp up recently, we still think there's further to go in tech.
I'm glad that you mentioned this, because so far to start 2025, we've seen this effort to have stocks climb out of a hole that was at the end of the year, but it really has been only big tech. That's been the outperformance. You've seen an underperformance of equal weight, underperformance of small caps. To your point, is that basically the roadmap for the year ahead, with people betting on 1 billion humanoid robots from Jensen Huang?
I would stick with tech as the primary or the dominant theme of this bull market. When we look back at bull markets, every bull market tends to have a theme. This one, as we know, is AI. And when you look back at the late 90s bull market, like tech led until the end as far as relative performance. As you move to the 2000s, it was more about global industrialization. We saw things like EM and industrials lead to the end. So if you believe the bull market is intact, which we do, then it's more likely that AI will and technology will continue to lead. And when that stops, it probably means that we're at the end of this bull market. Again, we're giving it the benefit of the doubt. I will say underneath the surface, you're looking at, only about 25% of stocks in the S&P above the 50-day moving average. So just that does kind of go to your point about it. It's really been more tech. I would say we like tech. We like large caps the most. After large caps, it would be mid caps and then small caps the least within the U.S. But I also think this backdrop still continues to support our longstanding bias for the U.S., which has a lot more tech in the large cap index.
I know your bias is to the U.S., but you also talk about how international market underperformance is at an extreme. And when it's at an extreme, like we saw with positioning yesterday and all those tariff headlines, you can take advantage of it. Are there any areas that you think we should be looking out for that potentially the market could take advantage of?
Yeah, well, since we've been on the U.S. side for several years, I know that becomes a really big consensus heading into this year. So you always start to think, okay, where could the consensus get tripped up a bit? And it is extreme. We just had the worst performance of developed international relative to the U.S. since 1997. And then when we look back at 2016 as a little bit of a roadmap, we saw international underperform initially, and then in 2017, for a couple of months, they outperformed. So I think the risk is you could see a kind of a cyclical rebound, or maybe a short-term rebound, but I still think the fundamentals favor the U.S. So unless you're very nimble, I still think you want to stick with the primary outperformance of the U.S., which we expect to continue, especially if you expect tech to outperform, then inherently you're still saying the U.S. and large caps should outperform because of the weighting within the indices themselves.
Hey, Keith, got some breaking news on a large cap right now we need to talk about. Good to catch up. Keith Lerner of Truist. That name is Meta. Of course, you saw the change in the past week. Nick Clegg is out. Coming in, taking over Joel Kaplan, the Meta Chief Global Affairs Officer, out with this statement this morning. And here's some of the headlines for you. Starting in the United States, we are ending our third-party fact-checking program and moving to a community notes model. We will allow more speech by lifting restrictions on some topics that are part of mainstream discourse and focusing our enforcement on illegal and high-severity violations. We will take a more personalized approach to political content so that people who want to see more of it in their feeds can.
This is a huge reversal from some of the moderation that they had in prior election cycles and, frankly, prior years. This, according to Mark Zuckerberg, some people believe giving more people a voice is driving division rather than bringing us together. More people across the spectrum believe that achieving the political outcomes they think matters is more important than every person having a voice. I think that's dangerous. This idea of the Dojification of Meta at a time when potentially, whether they're catering to this new administration or adopting what basically has been the shifting sands, it remains a debate.
It feels like Joe Kaplan and Dana White are officially in the driver's seat now when it comes to Meta. We want to fix that and return to the fundamental commitment to free expression. Sounds like something you would hear from Elon Musk when it comes to X.
Big changes at Meta and more big changes still to come, I'm sure, for corporate America. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. The Wall Street Journal reporting this morning that the Biden administration is in negotiations with the Taliban to swap Americans detained in Afghanistan for at least one prisoner, an alleged Osama bin Laden associate in Guantanamo Bay. The Taliban is seeking an additional 2 prisoners in exchange for the Americans. President Biden has reportedly not made a decision on the proposal yet. Hedge fund Bridgewater Associates has laid off about 7% of its workforce, affecting about 90 employees. A spokesperson for the firm said that the layoffs are meant to keep the organization nimble and flexible. The cuts now bring the firm's headcount back to where it was in 2013. Similarly, hedge funds Two Sigma and Brevan Howard also cut about 10% of their staff last year. A patient in Louisiana who tested positive for bird flu has died in the first confirmed death linked to the respiratory virus in the U.S. The patient was over the age of 66 and had underlying medical conditions. Louisiana's Department of Health said that there were no additional cases found and no evidence of human-to-human transmission. The CDC says that there are currently 66 confirmed cases of bird flu in the country. That's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Trump returning to Washington.
If I'm Donald Trump, if I'm chief of staff to Donald Trump, Why do I care if it's one bill or two? How do I get what I want? How do I get my agenda approved?
We'll talk about that next on the program with Congressman French Hill.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
If you are just tuning in, welcome to the program. Stocks are positive on the S&P 500. A kick-off Tuesday morning, up by close to 0.1%. Under surveillance this morning, Trump returning to Washington.
If I'm Donald Trump, if I'm Chief of Staff to Donald Trump, why do I care if it's one bill or two? How do I get what I want? How do I get my agenda approved? If you tell me I get a better chance of doing that with one bill, yay, let's do one bill. If it's got to be 16 different bills, I'll do that. Historically in Washington, D.C., the reason you get these massive bills that everybody says they hate is that that's what passes.
So here's the latest this morning. Donald Trump heading to Capitol Hill tomorrow as the president-elect pushes Republicans to pass a single massive bill containing his priorities. Trump looking to secure a House vote on immigration, energy, and extension of the 2017 Trump tax cuts by April. The Republican Congressman French Hill of Arkansas joins us now for more. Congressman Hill, good to catch up with you as always, sir. We'd love your opinion on what you think is the best way to pursue the president's agenda. Is it through going after just one big bill?
Well, Jonathan, it's great to be with you. Yes, I do support one bill because I think that's the easiest way to get the votes for the president's priorities in the House, which include, as you said, energy permitting reform, securing the border, and of course, debating and completing an extension of the Trump tax cuts from 2017.
Congressman, we've been debating around this table how much the 10-year yield has a seat at the table when deciding what kind of bill and how big it is when the Congress meets and possibly passes this as soon as April. What's your view on this? How much of a veto power does the bond market have?
Well, Lisa, look, I don't think it makes any difference on that point, whether it's one bill or three bills, to the point of your previous commentator. What I think's concerning to me is that I wish we'd finished FY25 spending last Congress. I think that would have been in the president's best interest. But instead, this first quarter, we're going to do both. We're going to complete fiscal 25 spending by the middle of March, and we're going to try to do budget reconciliation with the House and Senate before early April. That's a big lift, and it may demonstrate a little uncertainty on the part of the bond market, but I think the real issue is let's get spending under control through budget reconciliation. That's the purpose of budget reconciliation. It's a procedure by which you can do big things in Congress using 51% vote margins in the House and Senate. President Obama used it to create Obamacare. President Trump in his first term used that to reform the tax code. So Republicans in the House and Senate this year want to use budget reconciliation to get federal spending under control while we also extend the pro-growth features of the Trump tax cuts.
Congressman, one of the concerns that we hear from a lot of fixed income strategists who come on the show is that they're not seeing where the cuts are going to come into place in this reconciliation bill. Where are they going to come?
Well, we had a meeting all weekend where we worked with our committees of jurisdiction on determining cuts in spending across the board, with the exceptions of what President Trump has taken off the board, which would be Medicare and Social Security benefit areas. The rest of it's on track. And you know how much spending has gone up, and just since the pandemic, we're running a $2 trillion deficit per year, 7% of GDP. That's the part that's unsustainable. Everyone in Congress knows that. So we've got to get our spending on a more sustainable, predictable front. I think that would benefit the bond market if they saw that kind of work on the part of Congress.
Well, we have the CBO talking about at least one point of that one big, beautiful reconciliation potential bill, which would be just extending TCJA over the upcoming decade would cost $4 trillion. On top of that, the president-elect continues to talk about no tax on tips. How much do you think can actually get through this Congress?
Well, look, Anne-Marie, you had CBO also say that the Tax Cuts and Jobs Act, when they did not dynamically score it, would not produce increased revenues over a 10-year budget window. And in fact, since 2017, you've seen record federal revenue pour into the country from no more reversions, people bringing taxable income back, the investments that were made, GDP growth, job growth, wage growth was all up in those years following the Tax Cuts and Jobs Act, but before the impact of the pandemic. So I don't believe House Republicans are governed completely by the opinions of CBO exclusively, even though that's an incredibly important component, because we've seen how in error estimates are from the Joint Tax Committee and from CBO, not recently, but for the past 50 years.
Congressman, you're also now the chair of a very powerful committee, the House Financial Services Committee, and we see a number of representatives going to Mar-a-Lago this upcoming weekend. Will you be there? And if so, what do you plan to discuss with President-elect Trump?
Well, President Trump has invited the committee chairs to a dinner, and we'll be talking about our priorities that we have for the first few months of his administration and getting his views on those.
What are your priorities? Specifically for the Financial Services Committee?
Well, you know, we've talked about that many times. I've got three big priorities. First, I want to right-size the regulatory system for particularly community banks. I think that's an important feature that's gotten off track, particularly in the Biden-Harris administration. We want to make sure the SEC is focused on capital formation and investor protection and orderly markets, and not a political agenda that soon-to-be former Chairman Gary Gensler had. And finally, we want to have a market structure for innovation in this country where people can use blockchain, can use digital currencies and digital assets to advance their business mission and make sure that the U.S. is a leader around the world in this new Web3 innovative technology.
Congressman, we also need to talk about the Fed. Yesterday, Michael Barr stepping down, you welcomed that. This morning, the Wall Street Journal in an editorial is talking about that maybe a replacement for Michael Barr will be Governor Bowman. Would you welcome that?
Mickey Bowman's done an outstanding job as a governor on the Federal Reserve. She comes to the Federal Reserve with practical experience, both as a bank commissioner in Kansas, as well as a family connected to community banking business there in the heartland. She's been a great voice for common sense and tailoring and regulation. And I think she would be, if President Trump made that decision, that would be, in my view, a good one.
Congressman, we're seeing some big shifts in corporate America as well. We'd love your thoughts just to close up this conversation on what we just heard from Meta moments ago. And if you missed it, because it only broke about 15 minutes ago, I'll give you a summary of it. This came from Meta about 15 minutes ago, that starting in the United States, they're going to be ending their third-party fact-checking program and move to a community notes model, something we're more familiar with the likes of X. We're seeing some big shifts around corporate America. I think taking note of more conservative voices in the last few months, particularly after the election in early November. That is notable, I think, Congressman Hill, for corporate America. And I just wonder how you're responding to things and what you think of that shift.
Well, Jonathan, over the decade that I've been in Congress, for basically 3 decades before that, I was in corporate America, both with public companies and private companies. And I've never been a big fan for bringing politics, partisanship, and social policy fads into the corporate boardroom. I think business should be in the business of delivering a product that meets the needs of consumers, all consumers, no matter what their walk in life is. And so that's why I think it's good that business appears to be getting back focused on conducting their mission and leave the politics at home or out with their friends.
French Hill, appreciate your time, sir. Congressman French Hill
good to be
of
with
Arkansas. Good to see you, sir, as always, down in Washington, D.C. Just finishing up there on some of the changes we're seeing in corporate America.
A question about what kind of role they're taking, how much this is shifting to conservative versus just simply exiting the stage left. I want to make a note, though, just to build on what you're talking about with that announcement from Meta, from Mark Zuckerberg. They talked specifically about their efforts in 2016 to have third-party moderators. And why it failed was because those independent moderators were no longer independent and actually had their own views and biases. It was almost a walking back of what happened following the 2016 election.
And it's really not a surprise given post the election and all these executives that have been going down to Mar-a-Lago speaking to President-elect Trump. I was putting together a list of the shift we've seen in all these companies.
Sure.
McDonald's yesterday, Meta yesterday, and today, Walmart, Tractor Supply, John Deere, other companies as well, Ford, Caterpillar, Boeing, and the list, I think, will continue.
Everyone wants politics out of corporate America. Everyone I talk to, anyway, and maybe that's just my crowd. I'll say this, though. Are we really taking politics out of corporate America or just replacing it with a different kind of politics? Because there's a difference. I have to say there's a real difference. And the way that Congressman Hill was talking about was just getting back to the old way of doing things. Get the politics out of the boardroom, get the politics out of corporate America, get the politics out of human resource departments as well. Do all of that. I'm on board with that. Most people are. But are we just replacing it with a different kind of politics?
It's a great question. And we don't know. I mean, honestly, we just don't know the answer. That will have to be ready to be seen. Also, how do you define what politics is when a lot of it has to come down to policies that go to the heart of how business operates? So it's kind of a very narrow line.
This is a huge story for corporate America and will be for the next several years. Coming up, Jason Thomas of Carlyle on the Fed's definition of restrictive monetary policy. That's next. This is Bloomberg. Equity futures right now on the S&P still just about positive, up by close to 0.1%. We're 2 hours away until the cash open with your morning movers. Here's Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. Las Vegas had something for everybody, from the jacket that Jensen Huang wore through to the sprinkling and the halo effect in terms of the companies that he's doing business with. The stock was up aggressively so far this year, up 11%, and it's the scale of adoption of Blackwell. Blackwell and Engine AI has arrived for PC gamers, developers, and creatives. This was about talking about robots, a business worth $38 billion is the projection. Hardware, $3,000 hardware PC for AI developers out there. So this is about encroaching more into autos, more into robotics, and really there was a sprinkling of dust for everybody. Uber got a little bit of the halo effect because yesterday, 24 hours ago, I was talking to you about the upbeat guidance from Uber along with the buyback. NVIDIA and Uber. The data from Uber will lock into NVIDIA and give you the road forward, as Dara Khosrowshahi says, to supercharge the timeline for safe and scalable autonomous driving. So there really was a drop the mic moment for a number of different companies. Let's run it off with Tesla. It's interesting, they're on the back foot this morning. Bank of America downgrades the stock. Why? Because it's a valuation and execution risk. They do shift the price target to $490 from $400. So that's a genuflection to the valuation. But robo-taxi now accounts for over 50% of the implied valuation in this stock. And therein lies the point. Where is the future of autonomous driving? How much of Tesla is really about the cars? We've talked about this with Dan Ives. That's about 15-20%. The rest is on autonomous driving and the AI trade. So for now, the Bank of America just takes 2% out of Tesla in the first wave this morning. Jonathan.
Manus Cranny, thank you, sir. Appreciate the update. We'll touch base again in about 60 minutes' time. And the surveillance this morning, US East Coast dock workers and their union meeting today to try to negotiate a new labour deal. If they don't come to an agreement, a January 15th strike that would shut up major East and Gulf Coast ports is all but certain.
So, new year, same problem, and potentially you can have 47,000 workers at these major ports striking as soon as next week. Interesting, though, early October, the International Longshoremen's Association got backing from high-profile backing, at the end of last year in December, from President-elect Donald Trump. And he almost was taking their side when it comes to automation. And at the end of the day, that is what this fight is about.
That's what I want to build on, the idea of semi-automated cranes, the use of them. And basically they're saying if you use them, you have to have extra workers on hand. And companies, dock operators are basically saying, look, you can't tie our hands in terms of efficiency before we even get started and understand what the technology is. This is going to be a fight that's going to be increasingly difficult for leadership to really weigh in on, given the hope economically for a whole much more productivity.
I'd also throw this in there. Not just what the tech is, but where the tech is coming from as well.
That's a great point.
Been a major issue regarding the next story as well. Treasury Secretary Janet Yellen telling the Chinese Vice Premier that recent hacks to the Treasury Department raise, quote, serious concern about malicious cyber activity. Yellen also warning of consequences for Chinese companies that support Russia's invasion of Ukraine.
So we've heard this before, and I go back to that story with the incredible detail over the weekend that we've spoken about, this Wall Street Journal story, and their sources were saying how Jake Sullivan told these telecom companies in the fall of 2023 about China just lingering and hacking. What I found so interesting when I saw the press release, though, yesterday from Treasury, it was the last line. Yellen expressed serious concern about malicious cyber activity to He Fang. The last line. And after everything we've learned about what China is doing, their pervasiveness across U.S. industries, hacking her and her colleagues' potentially emails, and also listening in on conversations of President-elect Trump, you'd have to think, why didn't they lead with this?
Well, Janet Yellen has been a huge proponent of bilateral conversations and the importance of maintaining communication as a way to avoid some serious altercation. This is probably her last communication with her counterpart over in China, and it raises the question, has it been effective, especially when we're talking about these malicious hacks that are still being unfolded?
Pretty shocking reports. The latest on the United States and China. Let's finish on this story here. Meta revamping the company's approach to free speech. The CEO, Mark Zuckerberg, saying Meta will drop its third-party fact-checking and move to community notes similar to X. Meta will also lift restrictions on some topics and take a more personalized approach to political content in the United States.
It really just feels like this is yet another company that is shifting to the right, reading the tone of the room of the electorate of the United States. Many people you talk to say they feel like corporate America has gone to left. Meta now, Nick Clegg is out. Joel Kaplan will be running the scene. And I think adding Dana White, I think really tells you the tone and the tenor potentially we could see out of Meta.
There's also a larger question here about, A, where the liability lies, right? They don't want to have the liability of a news organization, so they want to step away from that. But number two, what the role is of some of these social media companies and whether this is actually just removing politics or whether this is just injecting a new form of politics on different types of businesses remains to be seen. Social media still needs to be worked out in terms of the main way a lot of people get their news and, frankly, what kind of filters people are. Look, we all hope it becomes the town square where everybody can actually voice honestly their opinions. Let's hope that this moves more toward that.
Meta's down in the pre-market by about 0.6%. Not a big move. Plenty more updates on that story a little bit later. Let's turn to the Federal Reserve. Investors are waiting December Fed minutes and more Fed speak this week. Jason Thomas of Carlyle saying, though policymakers keep using the word restrictive, it may not mean what they think it means. It may be time for the Fed to leave well enough alone and retire the presumption that this economy cannot withstand rates at these levels. Jason joins us now for more. Jason, welcome to the programme, sir. Let's talk about that word restrictive. What guides your view about how restrictive we actually are?
Well, if you look at the last 18 months, the real Fed funds rate has been in excess of 2%. That should be very restrictive. But yet over that same horizon, we've had real GDP growth that's averaged nearly 3%, almost twice the level most forecasters had for the U.S.'s potential growth. We've had productivity growth that's exceeded 2% on an annual basis for the last 5 quarters. And of course, we're left with core CPI that is still above 3% when you add in measures of financial conditions, stock valuation ratios, credit spreads at 17-year tights. I don't see restrictiveness anywhere one would look in the data. And I think it's time to retire this language because in many ways it's also created some damage because it's created expectations among market participants, among investors, management teams, that they should delay transactions, delay interest-sensitive purchases 6 months, 12 months, 18 months into the future when rates are lower. So I think just abandoning this language, changing the rhetoric, accepting that it looks to we're more or less at neutral today would actually be, I think, quite helpful in terms of many of the elements of the economy coming to terms with rates likely to persist near these levels.
Jason, what do you see the message as from the long end of the yield curve, the idea that as the Fed has cut by 100 basis points, the long end of the yield curve has risen by 100 basis points?
I think it's the market repricing neutral. The term premium is estimated, right? It is the 10-year yield in relation to expectations for short-term rates over those 10 years. What are those expectations? I think that right now, it's not so unreasonable to think 4.25 is going to be where the Fed funds averages over this 10-year period. If so, 10-year yields at 460, that's not really much of a term premium, at least when we look historically. The term premium in the 90s averaged about 150 basis points. So I think that we've been so used to during the period of QE, during the very large reserve accumulations, China, other central banks, we became accustomed to a term premium that was zero or negative. And so a term premium that's modestly positive, people think, oh boy, this is a sign of concerns about the fiscal outlook or just the sheer volume of bond offerings. But I think a much simpler explanation is that the neutral rate has just been repriced by markets and it's moved into the 4.25 range.
Jason, when you look out over 2025, you just put out a paper talking about some of the big questions for the year ahead. If you look at just where the market is setting up, the market seems to be positioned for U.S. exceptionalism, tariffs that are going to affect the rest of the world, not necessarily the United States in a negative way, and the idea that we're going to get a soft landing with a few more Fed rate cuts at the same time as technology really does increase efficiency across the sphere. Where would you push back against that market positioning?
Well, I think first we have to wait and see what Europe is going to do in response to the U.S. election result. 14 months before the U.S. election, European Commission President von der Leyen commissioned a report from ECB President Draghi. And we'll see if they act on it. People talk about Europe's security dependence on the United States. But over the last few years, there's been an increased economic dependence. European exports to the United States are up 52% since 2001. Over the same period, European exports to China have basically flatlined, largely because of the sudden emergence of China's auto sector. So I think I would pay very close attention to changes in Europe. It's priced about a 40% discount to the United States. Obviously, market participants are not especially optimistic about the likely changes there. But that provides a pretty significant risk compensation to investors. Secondly, I think most people are focused on NVIDIA, AI. I think we should increasingly focus on NVIDIA's customers. The four largest customers in the United States their capital budgets roughly doubled from 2023 relative to intended investment in 2025. Data center investment in the United States up eightfold over this period. We're going to see how productive these quote-unquote AI factories are. And I think that this is going to have a big impact because the valuations of these companies are implying that the return on this capital is going to be in a 25-30% range. And we're waiting for the proof in the pudding. We don't yet see clear evidence that there's going to be the downstream revenues and applications necessary to justify all those outlays.
Are you basically saying, Jason, that you're bullish right now on Europe and getting a little bit more bearish on U.S. big tech?
I think that, in the past, big tech in the United States had enormous price-to-book ratios, the valuations, because, you don't value a money printing machine based on the cost of the paper or the printing press. So these were very rich in intangible assets. Over the last few years, what you've seen, I think, is effectively a change in strategy and a move to a much more asset-heavy business model. If you look again at just the top four customers in NVIDIA, their capital budgets have gone from just 0.1% of U.S. GDP to now over 0.7%. So 0.7% of U.S. GDP. I mean, this is really phenomenal increase in spending, and the valuations have actually increased over this period of time. Price-to-book ratios have actually gone up even as they've moved to an asset-heavier business model. So again, this is interesting. It's certainly curious, and I think when you look at what is cheap, what is not at risk of a valuation decline related to, again, rates being higher for longer or just a revision to growth expectations, I think much of the rest of the world, but especially Europe, you are getting pretty well compensated. And also, I would say that, the euro, I think it's reasonable to expect that it is going to break through parity by June. So, by the second or third quarter of this year, you could have, if you're a U.S. dollar investor, you could be looking at a European market that looks exceptionally cheap, both in terms of the valuations, but then also on a currency-adjusted basis.
Jason, are you almost saying at the end of the day, an antagonist approach from an incoming Trump administration might force the Europe to actually find its own growth and be a great place for investment?
And we'll see what they do. But the issue in Europe is not the lack of tools, the lack of resources. Europe saves more than the United States. In terms of just raw financial resources, they have more than the United States. It's been a lack of political will. And it's also been an assumption, and Draghi calls this out in his report, that actually the inaction is the only way to preserve consensus. Well, inaction is actually deepening political divides in Europe. So we'll see. Of course, we have a German federal election in February. We'll see, what that signals about the electorate's appetite for change. But I think perhaps even more importantly, it could signal to policymakers the sorts of changes that could be in store if they don't reform. So yes, I think that this Trump election victory could be a very important impetus for changes that in many ways are long overdue.
Jason, appreciate your time. Really thoughtful stuff, sir. It's good to hear from you. Jason Thomas there of Carlisle, particularly on Europe at the end. Europe's issues are so deeply, deeply cultural that it's going to take a lot more to get them out of this hole.
Does it take much, though? If it doesn't take that much, if it just is a slight upside surprise or a slight sense that there could be leadership, Jason's point is it doesn't take that much based on where it's priced.
Saw evidence of that in the last 24 hours in foreign exchange, the point we've made on this show a few times. Euro dollar right now just short of 104, 103.95. With an update on stories elsewhere this morning with your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. Meta is revamping the company's approach to free speech. CEO Mark Zuckerberg says Meta will drop its third-party fact-checking and move to community notes similar to X.
After Trump first got elected in 2016, the legacy media wrote nonstop about how misinformation was a threat to democracy. We tried in good faith to address those concerns without becoming the arbiters of truth. But the fact-checkers have just been too politically biased and have destroyed more trust than they've created, especially in the US. So over the next couple of months, we're going to phase in a more comprehensive community notes system.
Meta will also lift restrictions on some topics and take a more personalized approach to political content in the U.S. Dell, meanwhile, is rebranding its PC product lines in a bid to revive weak sales. It dropped decades-old names like Inspiron and XPS in favor of simplified Dell, Dell Pro, and Dell Pro Max lines. AMD said Dell will use its chips for some of its business computers for the first time, a blow to rival Intel. President-elect Donald Trump has reiterated his ambition to buy Greenland as his son, Donald Trump Jr., prepares to visit the Arctic island. Trump promised to make Greenland great again after news of his son's visit emerged late on Monday. Trump wrote on Truth Social, Greenland is an incredible place, and the people will benefit tremendously if and when it becomes part of our nation. We will protect it and cherish it from a very vicious outside world. That's your Bloomberg Brief. John.
Danny, thank you. Watch this space. Up next on the programme, the case for higher for longer.
They understand that the economy is doing okay. Inflation is a little bit sticky, so it makes sense to wait. We're going from a period of low uncertainty to much higher uncertainty, and that's what's got to get priced into markets.
Up next on the programme, we'll catch up the former Chicago Fed President Charles Evans from New York. You're watching Bloomberg TV. Stocks up for two straight sessions. We're up again this morning by close to 0.2% on the S&P. Bond yield's a little bit higher as well. Some headlines in the bond market in the last 24 hours. The 30-year yield, the highest since 2023. In the US and the UK, the highest since 1998. Just unbelievable. Under surveillance this morning, the case for higher for longer.
They understand that the economy is doing okay. Inflation is a little bit sticky, so it makes sense to wait. They also understand that there's a lot of uncertainty about what policy is going to be forthcoming. And Powell said when things are uncertain, you should slow down. So I think that all makes a lot of sense. I think the big disconnect, I think, between markets and the Fed is where is the Fed heading over the medium to longer term? We're going from a period of low uncertainty to much higher uncertainty. And That's what's got to get priced into markets.
So here's the latest this morning. Fed Governor Lisa Cook saying the FOMC can proceed cautiously on further rate cuts with inflation pressures remaining. The former Chicago Fed President Charles Evans writing, I expect inflation will return to 2% within the Fed's current timetable. They don't want to risk cutting rates and then need to backtrack higher if inflation rises again. Charles joins us now for more. Charles, welcome to the programme, sir. Just want to go through a range of comments we've had from Fed officials over the past few days. Governor Cook said inflation has been stickier. Governor Kugler said, obviously, our job is not done. President Daley said we're uncomfortably above our target. Why do you suppose, with all of that in mind, they reduced interest rates at the last meeting?
Well, I think that, the Fed has done a readjustment in the stance of monetary policy. They've cut rates by 100 basis points over the last year, since September. And the last cut in December was a close call, according to Chair Powell. So I think they're well positioned at this point to deal with the risks that they expect to be facing this year. And I think there are an awful lot of risks. Inflation has been bumpy, and their focus is on getting inflation back to 2%. They are looking at a projection themselves of core PCE at the end of this year at 2.5%. That's a little bit more than uncomfortably above 2%. And they don't give any indication that they're willing to sort of say, well, 2.5 is really not that far above 2%. So with their focus on 2%, I believe the Fed policymakers that they are going to be patient in adjusting monetary policy, and they're going to need to see improvements in inflation.
How concerning is it to you that longer-term rates have risen so much since the Fed finished cutting by 100 basis points last year?
There are a lot of things going on at the same time. And so it is the case that the Fed funds rate is lower. That would put downward pressure on the 10-year rate for sure. But it's also the case that, their fiscal deficits are continuing to be high. There's a lot of uncertainty about that. How are investors going to be responding to that? And so I think it's natural to suspect that funding rates could be higher at the long end. It's also the case, that productivity is higher. AI offers a lot of promise. Growth has been above 2%. Our assessments of long-run trend tend to be about 2%, but if they're higher, that would also justify higher long-term rates too. So there are many things in play, plus all of the uncertainty associated with volatility and tariff commentary.
How much are you concerned about the fact that the Fed hasn't really put out a framework for how they're going to deal with some of the potential policy changes that are coming out? This was something that former New York Fed President Bill Dudley was talking about. Do you think there needs to be a better communication of scenario analysis around tariffs and around potential immigration changes?
The Fed communications is always difficult. It's difficult for central banks. It's difficult for any institution that is dealing with uncertainty and talking about what they're going to be doing over the next 6 to 18 months. Uncertainty is just very difficult to describe in a way that many readers can fully appreciate. The Fed has a number of communications tools. The summary of economic projections are one of them. And so, by the Fed's own take, they've indicated that they're expecting inflation is going to be higher than they previously thought for longer, and they need to take action. You could go through a few different scenarios where, well, it could be better than that, and explain how, the funds rate would fall. Or you could say it's going to be worse than that. They have internal documents where they go through that. I'm not convinced that the public would be able to digest 3 scenarios when they have as much difficulty with one. You'd constantly be going, well, which of the 3 do you really think we should be paying attention to?
Speaker Johnson is talking about this potential one big reconciliation bill by May. If that is the case, does the Fed then just stay on the sideline and wait for the policy chatter to become actual legislation?
Well, I think the typical Fed approach, Chair Powell has tried to describe this at the last couple of press conferences, which is to, observe the legislative process, observe the progress. When do they get legislative language? When is it about to actually take it be enacted, and what actually ends up in the bill? A lot of things end up, with the last minute in a bill or get taken out. And so it's very difficult to have confidence that you know exactly what the stance of fiscal policy is until you get, real language there. And I mean, if you just go back, previously when you've talked about eliminating the Affordable Care Act, that would have huge implications for the economy, and it came down to a single vote. And so, you have to actually go through the process before you can fully appreciate what that's going to do to the economy. That's part of the uncertainty that I was talking about. Right up until the end, it could go either way sometimes when it's a coin flip, with very large implications for the path of the economy.
You've lived it. We appreciate your experience, sir. Former Chicago Fed President Charles Evans on the latest effort from the Federal Reserve, a Fed that seems to be swinging between two risks. One risk being cutting too soon, too much too soon, and another risk being too restrictive for too long. And I'm not sure they know where they are.
And that's the reason why we're going to hear a lot of patience. The question is, what exactly does patience mean?
Coming up in the third hour of Bloomberg Surveillance, we'll catch up with Omar Aguilar of Schwab Asset Management, Dan Niles of Niles Investment Management, Dana Peterson of the Conference Board, and Brian Weinstein of Morgan Stanley. From New York, you're watching Bloomberg TV.
Moving money isn't just transactional, it's personal. A gig driver in Indonesia needs instant access to wages. An exchange student in the UK relies on transfers from his family in Hong Kong. Small businesses depend on rapid payments to grow and thrive. With 8.5 billion endpoints across more than 190 markets, Visa Direct helps to make all of it possible. Collect, send, receive, convert, hold with Visa Direct.
Market, I think, is more focused on the near-term effects of tariffs.
The markets will cheer a narrower approach to tariffs.
Markets have been sort of underestimating how much the Trump administration likes tariffs as more than deal-making.
I don't think any of us know. I'm not even sure the administration knows what the final set of tariffs are going to look like.
We're still in this waiting game. Things are proposals right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
It is January 7th, and it already feels like things are getting a little bit too breathless. Not even had an inauguration yet. That's on January 20th. Still got to go at the payrolls report on January 10th. Once you've got all that, still need to figure out the direction for policy, for tariffs, for how big this one big beautiful bill is actually going to be, and whether it will be one big beautiful bill or whether it will be two. There's a lot of things we've got to figure out.
You said it feels breathless. Well, let's see if anyone can catch their breath. I think that yesterday was a perfect example of that, the whipsaw of headlines coming out. It's going to be pared back tariffs. No, it's not. What are you talking about from Donald Trump? The moves in the market highlight a couple of things. How offsides into certain how crowded trades people are, long dollar U.S. exceptionalism, and the question of what it takes to truly disrupt that.
Also, this won't be an administration that's like watching paint dry. President-elect Donald Trump is going to want to maneuver, and he's going to want optionality, which means there is going to be a lot of whipsawing. But Jonathan, to your point about this optionality of one or two bills, potentially by Friday, we're going to have two bills because he's going to Washington, D.C. tomorrow. He's going to meet with Senate Republicans. And guess what? They want a two-path approach to enact his agenda. Very different than, well, the congressman is going to meet over the weekend. So then on Monday, we're going to have a different narrative. And that is what we have to get used to.
The backdrop for financial markets is just absolutely amazing at the moment. We've got long-end yields at levels we haven't seen for a number of years, since 23 for the 30-year in America, since 1998 for the 30-year in the UK, and questions about how much fiscal space we actually have in 2025 for various governments at a time we're seeing big changes to political leadership too. And these are all things investors have got to think about.
Especially given the fact that you've got a lot of debt issuance on all sides of the Atlantic, right? I mean, this is sort of the point about how much fiscal space. You talk about that with the United States, with the auctions this week and just going throughout the year as the deficit does deepen, but also in the UK. And questionably and arguably, they have that much less fiscal space with those debt auctions maybe spurring this rise that you're talking about to the highest levels on those yields and long-end yields in the UK going back to 1998. A question here about whether this is noise or whether this is signal for the path ahead at a time when some people are saying, as we just heard Charlie Evans say, formerly of the Chicago Fed, inflation still is on a path to 2%.
I'm getting some signals from corporate America. These aren't just questions for the government. They're questions for companies as well, worldwide. Brings up Meta. If you're just joining us, welcome to the program. About 60 minutes ago, we heard this from Facebook. Starting in the United States, we're ending our third-party fact-checking program and moving to a community notes model. We will allow more speech by lifting restrictions on some topics that are part of a mainstream discourse. The latest from Mark Zuckerberg and company.
And that comes after a number of personnel changes at Meta, decisively moving to the right, whether it's Dana White being put on the board or whether now Nick Clegg is out and Joel Kaplan will be the head of global policy at the company. And this is just an additional company that's moving away from some of the left approaches we've seen at corporate America. Walmart came out yesterday. At the end of the year, we heard from the likes of Boeing and John Deere. Jonathan, you always say this, and I thought about this yesterday when I saw these moves, what Michael Jordan would say, which is that Republicans buy sneakers too.
All I can say is that this is also a bit of a kowtow to Elon Musk, that we're moving to the same model that Elon Musk has. And when you take a look at all of the potential people coming into the new administration tied to technology oversight, all of them are friends or connected to Elon Musk in some capacity. So you have to wonder how much this is an effort on that front as well.
Right. It's the PayPal mafia. You landed it nail on the head. Those are the individuals that they're either talking to behind the scenes or that are getting seats at the table. What is interesting, though, is you hear a lot of people saying that there's been a shift too much to the left in corporate America during the last 4 years. Will they make the same mistake, though, and go too far to the right instead of what, Jonathan, you said earlier, and what French Hill said, the congressman of Arkansas, of just getting politics altogether out of the C-suite?
Or are we just replacing it with a different kind of politics? I think back to earlier this year, after the assassination attempt on Donald Trump's life, and the conversation that we had with Mark Zuckerberg, Emily Chang sitting down with Zuckerberg. And I think that was the moment, at least around that time, where you really got a sense that Mark Zuckerberg had woken up to the reality that we were about to get a second term from President Trump. Turned around to Emily and called it badass, one of the most badass things he's ever seen. And since then, you've just seen a series of changes come from Mark and the company.
Mark and the company, as well as, and he was one of those individuals that went down and had dinner with President-elect Trump at Mar-a-Lago. But not only that, Jeff Bezos, another individual that was seeing the change of tone. He's tweeted 3 times this entire year. 2 of them were about Trump, and 1 was denying a report about a $600 million wedding.
It's a big change. Equity futures right now on the S&P positive by 0.1%. Coming up this hour, we'll catch up with Omar Aguilar of Schwab Asset Management as stocks notch back-to-back winning days. Dan Niles of Niles Investment Management as the Mag 7 returns to market dominance. And Dana Peterson of the Conference Board counting down to payrolls Friday. We begin this hour with stocks higher as the AI frenzy once again takes center stage to start the year. Omar Aguilar of Schwab Asset Management looking for rotation. Themes such as the broadening of earnings growth beyond tech and mega caps and the potential resurgence of small and mid-cap companies may present compelling opportunities for investors. Omar joins us now for more. Omar, welcome back to the program, sir. A lot of people said the same thing, and then December happened. What went wrong?
Well, I don't think. Good morning and happy New Year to everybody. And I don't think anything went wrong in December. I think it was a very natural reduction of risk and repositioning going into next year. We had an amazing, 2024 where a lot of things went right. And I think the investors just took a little breather just in preparation for what is, going to be a very interesting 2025. When you think about just the level of small, negative returns that we had relative to the entire year, when you put all the pieces together, the S&P and most of equity markets, ended up having a pretty consistent performance for 2024. I think what is interesting going into this year is this rotation that is mostly driven by, how momentum is shifting. It is sort of what is compelling, and these levels of volatility that we have observed so early in the last couple of days that have, still, trying to see which one of these sectors will lead the way is probably the most interesting part we're going to see in the first quarter.
Well, Omar, we know what's led the way over the last 12 months. Big cap tech absolutely dominated. Is there anything to believe that's going to change in the quarters to come?
Well, if you just look at the top 20% of the what is called the momentum stocks, those have outperformed the market by around 20% on a cap weighted basis. And as you said, most of that has been dominated by the top 7 or the top 10 AI tech related companies. What we have observed over the last 3 months is that top 20% of momentum is now starting to just be a little broader, where there's financials, there's media, there's entertainment, there's other companies that have inched their way into that top quintile of momentum, which also is consistent with what we've seen in the interest rate cycle and the macro environment. So what we have observed here is that now we're going through, the discussion that we had for the entire 2024 about what kind of landing we had, whether it's going to be a hard landing, a soft landing, whether it's going to be a recession. That seems to be just old news. And now we're going into this process where, everything seems to be pointing towards that the recovery. What leads the recovery tends to be cyclicals, tend to be small cap, tend to be, part of the process that we already seen, at the beginning of this year.
At the same time, Omar, you are neutral in duration. This isn't necessarily a rates call. So you think that the cyclical area can actually rally and overperform even in a rate situation that doesn't change that much from where we are. Is that correct?
Yeah, well, this is an interesting piece. What I was discussing earlier, it's obviously relative to what I consider to be a more orderly positioning of equities. I think fixed income and bonds are still in a very wide range of possible outcomes. And I think we're preparing ourselves for another year of a lot of uncertainty and a lot of volatility in yields as we go in through this year. We're already seeing that increase in the long-term yields, in the first few sessions of this year. We've seen that the yield curve is clearly steepening, and it's steepening pretty fast. And a lot of that is as a result of inflation expectations, is economic growth, and also just the term premium continue to just be, pretty high. When you put all the pieces together, the potential range of outcomes within, the fixed income, it is pretty high. So I would probably say that the reason why we continue to emphasize to our clients to just try to stay neutral to their duration is because it's very unclear, where this thing is going to go. And I think it's going to take probably a few more data points and a few more decisions by the Fed to figure out where the yield environment will take us.
Given that backdrop, Omar, we were speaking with Torsten Slok earlier, who said there is this concern we could see a repeat of what happened in 2022 when both bonds and stocks sold off. In this type of environment, what does diversification look like?
Yeah, it's interesting because that is, a discussion we have had, not just recently, but even in the last, quarter of 2024, where, the concern is with good performance on equities and all of a sudden with the uncertainty in yields, is there a possibility where things will just need to be, different? There's two things. One is, the concept of what we have on the short end of the curve. So what is being cash or cash equivalents, that seems to be extremely, positive and a very good foundation for what comes ahead. So it is a very different environment what we have in 2022, where the prospect of, where the short-term part of the curve was going to be was very different than what it is now. We're seeing in the process where we know the potential path for the Fed, maybe the speed of where, how many cuts we're going to have and how many, how fast they're going to go in 2025 is still unclear. But we know that at least the short part of the curve is going to be contained in a place where it is going to have a good foundation for the rest of the market. Now, when we actually see about the correlation, and we do a lot of work in terms of just correlation of asset classes that have been, very consistent in the way that we had, over the entire history, where we have the negative correlation you expect between fixed income and equities that seems to be pretty healthy. Back in 2022, if you recall, at the beginning of 2022, both equities and fixed income were expensive. What we're actually seeing right now is the relative valuation and the equity risk premium seems to be, in a place where we still think that equities seem to have a little bit of an edge, but the correlation structure seems to be working the way that investors, should use for diversification. That being said, we're always encouraging, clients to look for other sources of diversification, especially, as they look in potential alternatives and any other asset classes that can give them a little extra, diversification.
It's why the likes of Bitcoin has done so well over the last year. Omar, it's good to hear from you, sir. Omar Aguilar of Schwab Asset Management. That last note on bonds, an important note. This is something that Mike Wilson and the team over at Morgan Stanley have been reflecting on. The decisive negative correlation between what's happening with bond yields and what's happened with stocks. Bond yields up and stocks down. I think there's a reason for that. It's the why yields are going up that's starting to get onto people's nerves, I think, just a little bit more. Mike Wilson pointing out that economic surprise indices have fallen and thus are not the driver of high yield. So this is not about economic data. And maybe it speaks to those deficit concerns just on the margin, just a little bit more.
This is the dark matter point that Neil Kashkari has talked about, the term premium, which raises the question of, is this because of concerns around the deficit? Is this concerns about just inflation remaining too sticky? It doesn't seem to be stemming right now from increasing growth expectations.
Mike Wilson joining us tomorrow morning, 7 a.m. Eastern time. So don't miss that. Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. President Joe Biden is establishing 2 new national monuments in California, protecting 848,000 acres of land. The proclamations creating the Chuckwalla National Monument and the Satitala Highlands National Monument mark another initiative to establish his legacy. According to the White House, both new national monuments only reserve federal territory, not state or private lands. McDonald's is no longer setting aspirational representation goals, a revamp of its approach to diversity, equity, and inclusion policy. The company is retiring its DEI pledge in its supply chain, renaming its diversity team as the Global Inclusion Team. McDonald's cited the evolving landscape around DEI in the U.S. as a factor in its decision. And prices for used timepieces fell last year, with the Bloomberg Subdial Watch Index at its lowest since 2021. Popular Rolex models dropped 5%, Patek Philippe dropped 4%, and Audemars Piguet lost about 7.5%. Cartier is the only brand whose individual index has posted gains since January of 2023. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes. Up next on the programme, The Morning Calls Plus, Dan Niles of Niles Investment Management on the changes coming to Meta and a whole lot more. Looking forward to this with Dan in just a moment. Stocks up again this morning, positive by 0.2% on the S&P, building on 2 days of gains on the benchmark in America. Let's get you some morning calls. First up, UBS upgrading Bank of America to buy, saying it's an overlooked winner of 2025 and is set to benefit from a capital markets resurgence. That stock is up by 1.3%. Your second call from Nathanson downgrading Apple to sell, citing high valuation, antitrust overhang, and a weakening position in China. A stock is down 1%. And finally, Bank of America downgrading Tesla to neutral, warning of execution risk and saying upside drivers are already priced in. It's a rare downgrade. A stock is down in the pre-market by 1.7%. Let's stick with tech. Meta, revamping the company's approach to free speech. The CEO, Mark Zuckerberg, announcing a number of changes, including the removal of third-party fact-checking and a move to community notes. That's very similar to what we see on X. Dan Niles of Niles Investment Management knows this sector better than most, and Dan joins us now for more. Dan, Happy New Year, sir, and welcome to the programme. I guess my first question to you on this story would be, is this about insulating themselves from potential regulation, or do you really think this move towards the centre and away from liberal policies will actually deliver better growth, better numbers, and help the stock?
Yeah, I mean, I think, I grew up in California. I lived there for over 30 years. And, the politics have changed over a long period of time. And Meta was very left-leaning with their platform. This just kind of gets them closer to the center. I love Michael Jordan's statement from a long time ago that Republicans buy sneakers too. And I think a lot of companies kind of forgot about that. And so I think this moves them more towards the center, and that on the margin, that should be helpful because everybody hopefully feels a little bit better about the platform.
Dan, how much, when you take a look at 2025 performance, particularly in the tech space, how much does regulation play into it at a time where there are increasing national security concerns and we talk about the sort of increasing decoupling between the U.S. and China?
I mean, I think it's a big deal because in China, their government tries to support their biggest companies. They want their biggest companies to dominate worldwide because China wants to rule the world. And in the U.S., we've sort of developed this policy of, we need to hamper our big tech companies. But guess what? If we hamper our companies and other countries are trying to help theirs to dominate, that puts the U.S. on a national security level in a very bad spot. So the government should really be trying to figure out how do we harness the brilliance we have in all of these U.S. companies, the technology they have, and how do we help our companies spread our values around the world. So I think, hopefully that's what's going to be the case going forward with the new administration, where there's a little bit more support for our technology companies. And I think that's a good thing from a long-term perspective.
I want to give you a victory lap, Dan. Last year, at the start of the year, you predicted about a 20% gain in 2024. We got close to that, more than that, but a lot of people had been expecting a lot less than that. This year, your outlook seems a little bit more cloudy. How much do you think we're going to basically take back a lot of those gains that we had last year with the threat of inflation and the threat of maybe some of the promises not coming to fruition?
Well, I mean, I think you framed it perfectly. If you look at where inflation is, and inflation's really been the biggest driver of stock prices for the last 4 years, arguably. You had big surge in inflation in 2021. Market ignored it. CPI went from 1%, 1.4% to 7% in 2021. Market went up 27%. You got into 2022, and people said, oh, inflation's not transitory. Fed starts hiking, market goes down 19%. Inflation comes down. 2 years ago, market goes up over 20%. As you said, last year, the market was up over 20%. But this year, if you look at it, all the inflation metrics kind of bottomed in either June or Q3 and have been going up. And the market sort of has ignored that right up until Jerome Powell said, our inflation forecasts have, quote, kind of fallen apart. And the market went down 3% on December 18th. And I think that's the risk, because the Fed is probably on pause, is my opinion. You might get rate hikes. In that environment, a trailing PE of 25 times when historically it's about 19 times when CPI is between 2.5% to 3%, that's potentially a problem. And by the way, bond yields are also about 100 basis points lower than they normally are when CPI is between 2.5% to 3%. So that's why I worry about a 10 to 20% drawdown this year if inflation does, in fact, look like it's being sticky or moving up. The Fed has to hike. If we thread the needle and you end up with inflation not having a problem, you could see the market up over 10% with multiples holding and earnings growing 10%. But that's why I feel like, cash is one of my top 5 investments for starting this year. Last time I had that was in 2022. Market went down 19%. We'll see what happens this year.
Dan, I was just looking at your 2025 top 5 picks, and below cash, you had Cisco. You just talked about these big Chinese tech companies and why there needs to be strong U.S. tech companies. Are you concerned about what's going on with Chinese hackers? Because Cisco was named as one of these companies that Chinese hackers compromised their large network routers.
Well, I mean, the Chinese companies have compromised Cisco. They've compromised the Federal Reserve, which you might remember got hacked. I mean, it goes back to what we talked about earlier, which is you need to support the U.S. companies and what they can do to try to make America's defenses better. And so I think with Cisco, it's one of our top 5 picks. They've got some good security products that obviously all security across all companies, even the security software companies have gotten hacked, which you probably remember. Mm-hmm. I think that'll really help U.S. networks. And it's one of the reasons we have some of our top picks like Adtran, which is you're starting to pull Huawei out of a lot of telecom networks now in Europe and replace them with more friendly country technology. I think that helps one of our top 5 picks, Adtran, as you roll out that technology in Europe, you pull out Huawei out of a lot of those networks as well.
So basically, anything that is U.S. tech will dominate. Do you think that is because the political policies, or that is because these companies just no longer trust this Chinese tech?
It's taken a long while for Europe to kind of get there, but they've finally gotten there. The U.S. obviously started going down that path many years ago when we had President Trump's first term. And so Europe is sort of catching up to that. And I think that's a good thing. And it should help U.S. tech companies where we might not have the lowest cost product, but hopefully it's a little bit more secure and in alignment with our partners in Europe.
Dan, we've got a lot to talk about in 2025. Looking forward to catching up again soon. Dan Niles there of Niles Investment Management. Got a lot to talk about a little bit later as well. 11:30 Eastern Time. Bloomberg's Ed Ludlow sitting down with Jensen Huang live from CES in Las Vegas. Looking forward to this one.
How many leather jackets do you think he has?
I've got no idea. Danny was mentioning earlier that maybe that had sort of like crocodile leather on it, and that's why it was glistening.
Or it was glitter.
In the lights. Did you notice that?
think these are the important questions that we want to know,
Everyone's
obviously.
commenting on the same thing. I couldn't care less.
Yeah, well, I do think that it sort of is a trend setting. I mean, this is what Mark Zuckerberg's trying to do with his new look, his necklace, T-shirt.
Wear what you want when the stock's up 300%, right?
I mean, basically.
You can get away with absolutely anything. Wear
Pretty
the same
much.
thing every day, all the time.
Yeah.
Do whatever you want. Things get a little bit more dicey when the stock's not doing well.
Well,
do you remember when Zuck used to go around with the hoodie all the time?
I do.
Yeah. It was
Yeah.
great when the stock's up.
Right.
And then the stock wasn't doing so well.
And all of a sudden it was the cost
All of a sudden
cutting
it was
and we
like,
got serious.
He used to put a suit on.
Yeah, exactly.
Put a tie on.
Yeah, necklace. Look, with Jensen Huang, I think it's going to be really important that he shows how this is going to potentially go beyond just NVIDIA. And that, I think, is sort of a question. Yesterday we heard why this is great for NVIDIA. With the promise of it expanding, I think a lot of people want to say, show me the money elsewhere.
The biggest clients have spent a lot of money on this. And I think it's the investor patience of the biggest customers that we've been watching for, whether it breaks or not, over the next year or so. And it's one to watch for 25. Up next, we'll catch up with Dana Peterson of the Conference Board, and we'll catch up with Brian Weinstein of Morgan Stanley Investment Management. We'll do all of that in just a moment. From New York, this is Bloomberg.
B. Grimm entered the energy sector to support Thailand's growth. With clean energy, we empower communities and industries, aiming for net zero by 2050, creating a better future for all.
Checking on stocks. Unless you want to talk about that. You want to talk about that?
No, let's go.
You
Let's
good?
talk about stocks. Yeah.
Lisa's Googling how many leather jackets Jensen's got.
At least 7.
At least 7. Okay.
Yeah. One for each day.
He's got enough money, hasn't he?
Yeah.
Equities right now in the S&P up by 0.1%. With 60 minutes to go into the cash open. With your morning movers, it's Manus Cranny. Hey, Manus.
Jonathan, let's kick it off with NVIDIA. I mean, there's a host of notes now come into your inbox in terms of what Jensen Huang said to the market yesterday. I like what Steve had to say. The announcements on robotics, the announcement on automation, the announcement on going into hardware is about deepening the moat of real uniqueness around this stock. Dan Ives, the evangelist of Jensen Huang, we know the phrase, the godfather of AI. But he talks about a 5 trillion market capitalization in the next 12 to 18 months. That's a pretty staggering uplift from the 4 trillion he originally had penciled in. What are robots worth? The whole business, the whole world, probably about $38 billion. Auto business for this company by 2026 will be worth $6 billion. And that personal hardware is now an entry into personal hardware for those AI supercomputer developers at $3,000 a touch. So there's an evangelist moment for Jensen Huang, but there's a halo effect onto Uber. It's our data on your systems. That's essentially what we're hearing here, which is Uber's going to give the data to NVIDIA, and we're going to have a magical moment in terms of autonomous driving collaboration. And this is about leveraging the Cosmos platform. So this is about symbiotic coalescing of two major tech companies. And as Dara Khosrowshahi said, it's going to supercharge the timeline for safe and scalable autonomous. Tesla, speaking of autonomous, of course, we know that Dan Ives has said 15 to 20% of this company's valuation is the cars. The rest of it is autonomous driving. Bank of America takes a bit of a pop at this morning. They downgrade on valuation and execution risk. Yes, they upgrade the price target of $490 from $400, but they talk about elevated costs. Sidebar, the US, of course, has blacklisted one of the major suppliers of batteries into Tesla in China. Jonathan.
It's quite a story. And overnight, Manus Cranny, thank you. That's the latest on the corporate side of things. Lots of economic data in the next several days, including payrolls on Friday. The estimate in our survey, 163K. This came from BNP Paribas. This is what BNP's take is, and I think it's an important question for us all going into Friday. What would it take to this Fed to cut interest rates at the end of this month? We expect the Fed would require a clear miss in key dimensions to spur a rate cut this month. So they'd be looking for, Lisa, payroll growth well below 100K and a jobless rate above 4.3% to get this Fed to consider cutting interest rates at month end.
Would that even be enough, though, given how much we've seen the long end increase and how much they've talked about patience? Would one print that arguably people could say would be noisy for a whole host of reasons, would that be enough? A lot of people are going to be looking at the internals of this report. What's wage growth look like? Where is the employment coming from? Is it mostly still coming from government positions? And those are some of what will go into how it's interpreted by markets.
Here's the latest take from Dana Peterson of the Conference Board on the labour market data, writing labour data will be the focus for markets and the Fed this week. The Fed can be less worried about labour market excesses, but should remain concerned about the effect of higher labour costs on inflation. Dana joins us now for more. Dana, welcome to the show. Before we get to payrolls Friday, we've got some numbers in between just to work backwards on Wednesday, ADP and claims, and then later this
when you want it with Bloomberg News Now. I'm Karen Moscow. We begin with some breaking economic news on the jobs front. Initial filings for unemployment insurance fell to 201,000 in the week through January 4th. That's the lowest since February. Meantime, recurring applications in the previous week climbed to 1.87 million. The data can be choppy from week to week, especially around the holidays. Meanwhile, U.S. private sector hiring slowed in December, indicating an ongoing moderation in demand for workers. Employment rose by 122,000 last month, the least in 4 months, following a 146,000 increase in November. This from the ADP Research Institute. The report showed employment growth was mixed across industries. And of course, we get the December jobs report on Friday. Turning now to the wildfires in California, with millions of people facing at least 2 more days of dry, hot winds that have fanned the blazes across Los Angeles County and sent residents fleeing for their lives. Hurricane-force wind gusts of as much as 86 miles per hour have torn through the region, pushing flames through high-priced neighborhoods and hampering efforts of more than 1,400 firefighters who have flocked to blunt the blaze. Public Information Officer Margaret Stewart with the Los Angeles Fire Department says the wind is grounding firefighter helicopters and planes.
It's purely the winds that are preventing them from being able to fly. We can fly at night, so that's not an issue. It's just the wind. So as soon as they have a window of safety with the winds, then they'll be up flying.
And the flames from a fire that broke out last night in the inland foothills northeast of the city are spreading so rapidly that staff at a senior living center had to evacuate dozens of residents. Another blaze that started hours earlier was ripping through the city's Pacific Palisades neighborhood, and in the flight to safety, roadways became impassable when scores of people abandoned their vehicles and fled on foot. Now to President-elect Donald Trump, who is asking the U.S. Supreme Court to intervene in his hush money criminal case to prevent his January 10th sentencing from going forward. The filing with the nation's highest court came after a New York appellate judge rejected Trump's argument that his guilty verdict on 34 felony counts should be vacated in light of his victory in the November presidential election. The filing is a last-ditch effort by Trump to put the case behind him before his inauguration on January 20th. The outcome hinges on Trump's argument that the verdict violates his presidential immunity, even though he hasn't yet been sworn in. Well, Donald Trump could declare a national economic emergency to provide the legal basis for universal tariffs. This is according to a report from CNN, and it comes a day after a Mar-a-Lago news conference where the president-elect threatened high tariffs on Denmark if it doesn't give the U.S. control of Greenland, and economic pressure on Canada to make it the 51st state. Bloomberg's Kevin Whitelaw has more.
It really brought back a lot of memories from the first 4 years of his administration, because you sort of end up at you come to the end of one of these things and you do try to find out, pick it apart, what is real, what's not, what's serious, what's not, and what's literal and what's not. And I think that it's going to take a while before we can really actually understand what he's really looking for in each of these situations.
And that's Bloomberg's Kevin Whitelaw. A cohort of about 20 Republican House members from New York, New Jersey, and California was invited to meet with President-elect Donald Trump at his Mar-a-Lago estate Saturday, ahead of a looming fight over an extension of his 2017 tax cuts. Much of the group is likely to attend and plans to discuss increasing the $10,000 cap on state and local tax deductions. Former U.S. President Jimmy Carter will continue to lie in state after his remains arrived in Washington a day earlier as part of state funeral rites. The Georgia Democrat and 39th president died December 29th at the age of 100. Carter will remain at the Capitol until tomorrow morning when he is transported to Washington National Cathedral for a state funeral. President Joe Biden, a longtime Carter ally, will deliver a eulogy, and Carter will be buried in his hometown of Plains, Georgia. Now to the economy and U.S. mortgage rates, which edged up to just shy of 7% at the turn of the year. And a gauge of home purchase applications tumbled to the lowest level since February. That's adding to evidence of a struggling housing market. The contract rate on a 30-year mortgage rose 2 basis points to a 6-month high of 6.99% in the period ending January 3rd. Over the last 4 weeks, home financing costs have increased nearly 1/3 of a percentage point. And Federal Reserve Governor Christopher Waller is saying he believes inflation will continue to cool toward the central bank's 2% target, prompting his support for additional interest rate cuts this year. Futures, they are little changed this morning following the economic data. NASDAQ futures down 0.1%, and the 10-year Treasury yield at 4.71%. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow, and this is Bloomberg.
There are two kinds of people in the world. People who think about climate change and people who are doing something about it. On the Zero podcast, we talk to both kinds of people. People you've heard
pretty well here.
BMO Chief Investment Strategist Young Yuma, good start to this year, of course, drumbeating to that jobs report, looking at where yields will impact the markets. But we're going to discuss more on the technology trade. We're going to talk about quantum computing, though. Stocks in the industry are having a moment. They were for a few months now, but one comment from NVIDIA CEO sending the shares of those companies off base and pushing those companies lower. We're going to talk about why next. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends.
Get ahead of them. And so many more.
Morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
If you look at private equity just as one piece of the institutional equity market, there are 3 times as many dollars invested than uninvested, right? So you have about $3.5 trillion in the ground that needs to get resolved versus about $1.5 trillion that's wanting to be invested. So if you're a private equity manager, you're trying to decide, do I take my capital and put it into my existing portfolio to either defend what I own or to try to grow it and create more value? Or do I use some, to your point, some creative financing to extend the duration or the runway of what I own and then try to put the capital into the new market environment? And everyone's taking a different approach. It's a function of where you are in your life cycle. Everyone is dealing with that. Even the highest performing PE firms, you're seeing slower fundraising. And in this deal environment, you have to start thinking creatively about how to get liquidity back to your investors.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Romaine Bostick in Detroit, and this is Bloomberg.
Next, though, on the agenda, we're going to dive into the details. Lizzie, there is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Getting out of high interest, look at what's making headlines around the world. Wildfires tore through the Pacific Palisades area of Los Angeles. Homes were destroyed and about 30,000 people were ordered to evacuate after a brush fire erupted in the community, causing panic and traffic gridlock, with some people abandoning cars without leaving their keys in them on narrow hillside roads. The blaze has spread to almost 3,000 acres and remains uncontained. President-elect Trump is asking the U.S. Supreme Court to step in and stop his hush money sentencing from going forward. The sentencing is currently scheduled for Friday, like this coming Friday. The filing follows a verdict from a New York judge who rejected Trump's argument to vacate the 34 felonies in light of his presidential victory. The judge who oversaw the trial has said he won't sentence Trump to any time behind bars. And Bill Ackman's trade idea still has the market's attention a decade later, scooping up shares of Fannie and Freddie. The founder of Pershing Square posted last month about a bet on the U.S. government unwinding its massive stakes in those companies acquired as part of a $190 billion bailout during the GFC. Ackman is eyeing a profit, or forecasting a profit, of 1,200% on the investment. Meanwhile, the shares have already soared by over 200% since the election of Donald Trump. The re-election analysts warn investors to approach the trade with caution.
We're now going to turn to a more nascent industry, of course, quantum computing. It has struck the fascination of investors, but shares of stocks linked to the next level computing technology are plunging today after months of bullishness. This comes after NVIDIA CEO Jensen Huang told analysts that quantum computing is likely 20 years from going mainstream. Bloomberg Technology co-host Caroline Hyde is here to explain. One thing I did to really put some context around this is go back to Alphabet and what happened in early December here. The lead of our own story on this talks about, okay, fine, they have a quantum computer needing just 5 minutes to solve a problem that would take supercomputers around 10 septillion years. That was the exciting part.
Longer than the entire existence of our universe.
But the next sentence...
a long shot, like exponentially longer.
Right. So there's the promise. The next sentence was Google's next task was to find an actual use for that superpower.
Yeah.
So aren't they saying the same thing?
But it is interesting that Google quantum AI team have said we're going to find something relatively useful in 2025. Whereas here comes Jensen downplaying what stocks have actually risen about 1,000% in the last year, I might add. So coming off about 20% ain't much. But dousing a little bit of that euphoria, saying, look, it's going to take 15 years until we get something incredibly useful, 20 years until we get something significantly useful. And NVIDIA, in theory, should know, because NVIDIA has been working with Google Quantum AI to simulate the use of hardware, of chips that are going to be necessary in the use of these supercomputers. We haven't got the hardware yet to really overcome the significant limitations. The big breakthrough, the Willow chip, which is made by Google, is that it does help reduce errors, cancel out the noise. This was some of the significant issues that have been limiting quantum computers thus far. So maybe there's a little bit of, I don't know, bitterness or even a little bit of competitive streak, feeling that Willow chips got there. But ultimately, Google's using NVIDIA to help simulate, to help identify the ways in which they have to build chips and hardware. So if anyone knows, Jensen should know as and when quantum computing really comes to bear.
Well, 2 points there. I mean, Jensen did say that 15 years for very useful quantum computers. So who knows what very useful means to him. But that's what I was going to ask. I mean, is this Jensen talking his own position because NVIDIA isn't ready for prime time and sort of talking back the market, or is this really, do you think, an honest assessment of where this industry actually is?
Are you asking me to say whether a CEO is honest or not, Kate? I mean, exactly. I have to just say that thus far the guy's been honest. He's taken big bets very early. He saw generative AI and the need for GPUs and AI applications of his own technology far before anyone else did. If he's going to see round corners, I would bet on him to be able to do so. And I haven't really seen something authoritative. When we had Google Quantum AI chief on, he didn't say, yes, we're going to have a breakthrough in necessary quantum computing that's going to be super useful in the next year. They're just going to start to find the applications. So perhaps they're actually singing from the same hymn book here. It's just the market got ahead of itself. We, the retail investor and the institutional investor, powered up these particular companies, these smaller quantum-related stocks, to the tune of thousands of % on the hope that maybe we're going to have a breakthrough in the next year and the year after that. Funnily enough, maybe the market's just getting ahead of itself.
You point out that some of these stocks have already risen rapidly. Qubit, QUBT is the ticker, is up, what, 1,900%? Rigetti is up 1,500%. But these are still just only 2 or 3 or 4 billion-dollar companies, right?
And their revenue, I think Rigetti, I think they have a 3 million per quarter revenue. Yeah. These companies are so early doors in what they're going to be able to provide in terms of useful application of what they're building that many are just pumping them up on the hopes that they'll have a key breakthrough in the next 10 years.
Nvidia.
No, these are kind of like biotech stocks. You either win or you lose.
Yeah.
Well, yeah, let's even take an even bigger step back. If we're talking about Rigetti, $300 million, what is useful? Going back to Katie's earlier question, useful today, what would show progress over the next year, even if you believe that the biggest of gains are going to come in 10, 20 years?
Yeah, and Bank of America did a good job at trying to point out where would quantum be useful. Drug discovery, most prevalently. Actually, generative AI is where it's going to be deeply useful because we're going to be able to be speeding up the way in which we train data and inference. But that is unlikely to be coming. I don't think Bank of America are like, yeah, that's going to be occurring in the next couple of years. But in the longer term, what is going to be useful in the here and now is continued breakthroughs when it comes to these chips, when it comes to actual cancelling out of the noise. Basically, the fact that it's incredibly difficult to basically use the hardware as it currently stands. It can only run a certain number of, I don't know what they're called, quantum operations, so to speak, in a certain amount of time before the noise just gets too much and you start to not get accurate results. So how can we understand that? How can we ensure that ultimately when you're holding these things at freezing temperatures to be able to allow some of this quantum physics to even allow to be working, how do we overcome that? How do we store it, make it also scalable? Because this is expensive to hold temperatures at such a level.
Well, I want to get the investor perspective here. There's at least one ETF that tracks this industry.
Yes.
The ticker is QTUM. It's an ETF from Defiance. It launched in 2018, so it really was ahead of this wave. Obviously, it had a fantastic year last year. It took in $500 million, almost a $1 billion ETF. Even with Jensen Huang coming out and pouring some cold water on this craze, I mean, how excited and interested are the investors that you talk to on BTEC about this industry?
Well, we had Sylvia Jablonski, who's behind Defiance, the ETF for quantum, on. And look, she's actually saying it. If you look at the performance of the ETF, it underperformed the likes of Rigetti because they have to iron it out by ensuring they've got diversification, by putting the likes of IBM, Google in, people who are actually at the forefront of building some of the supercomputers, not just the penny stocks or now the dollar stocks that you see. and she really is saying that this is going to be the trend of 2025. We had a lot of people coming on saying now we've got to these stages within generative AI.
She
now
would say that, wouldn't she?
She would. Well, I mean, but I think she's also betting on all other areas of innovation. So maybe she wants to continue to see the inbound into her ETF, but I think she was realistic that you've got to bet on some of the bigger players, not just some of these smaller stocks.
Yeah,
she's a great guest.
She's great.
I've seen her on, what's that show called?
ETF IQ.
ETF IQ.
You remember that? Yeah.
Mondays at noon.
Absolutely. Yeah, they're a thematic issuer, so they are exposed to a lot of the shiny objects, as Eric Balchunas would call them.
You can catch Sylvia on Bloomberg Tech.
She can.
Weekdays
she
at
also
11.
has a leveraged microstrategy one as well. I mean, she's in on all the hot properties.
Yeah, it's going gangbusters.
Great having you on, Caroline. Thanks so much for joining us. Caroline Hyde there from Bloomberg Tech. Tune into that program, as I said, at 11 a.m. Eastern. Caroline and Ed Ludlow interview CEOs from Panasonic and Mobileye, as well as others from CES in Las Vegas going on now. This is Bloomberg.
Bgrim entered the energy sector to support Thailand's growth. With clean energy, we empower communities and industries, aiming for net zero by 2050, creating a better future for all.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
A multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. January 20th, Donald Trump will be sworn in as the 47th President of the United States. Bloomberg will have special coverage of the historic inauguration, live from Washington, D.C. It all starts at 11 a.m. Eastern. Context changes everything. The top names at the Fed are on Bloomberg.
The median projection is 2 rate cuts next year. That makes sense to me, but we have to remain agile. Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
Nobody covers the Fed like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
All right, welcome back to Open Interest. You can see that little bit of a rally I was talking about half an hour ago, totally dissipated right now. We're still about unchanged, but the color is red, and that's significant because we saw a lot of red yesterday when it comes to both of these big benchmarks right here, the S&P 500, the NASDAQ 100. Not even NVIDIA could save us yesterday. The worst day of the year for both of these, which isn't saying too much given that it's January 8th. You also see some weakness in the small caps right now. The Russell 2000 currently down about 0.9% pre-market. This was your slight outperformer yesterday, but still a big down day for the small caps today. And at least right now, we're set up for another down day across the board, across all the size tiers. We'll see how that develops as we get a little bit deeper into the trading action. And with less than 4 minutes to go, coming up as we welcome the market to this Wednesday day of trading, we'll discuss the market moves with JP Morgan's Abby Yoder. That conversation coming up next. This is Bloomberg.
This facility, which is part of your $2 billion investment in the last 2 years, is a massive amount.
Yes, because we focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on-site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
Good morning.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Just moments away from the starting bell. Not a lot of action in futures. We're pretty much unchanged here as we wait to see whether we get some catalyst to drive the market higher or something terrible to bring it down again. S&P futures up 1 or 2/100%. Totally unchanged on the NASDAQ. Russell futures are climbing, Katie. We'll talk about that in
They're falling.
Or sorry, falling significantly, though. I meant real movement there. Red, green. Take a look at the NASDAQ market site. You've got Principal Financial Group, a fintech ringing the bell there. Over at the New York Stock Exchange, there's some kids. Exodus Movement. It's a software services company. It's small, but it's up in the last 12 months 700%. 28% so far this year to date, and we just started. So pretty good for them. Katie, what do you see in terms of other indexes, sir?
Well, it's exactly what you said, Matt. Not too much to report right now. We do have the colors are red, and we are moving a little bit lower in the first seconds of trading right now from the S&P 500 to the NASDAQ 100 to your small caps. Of course, all of the action is on Friday. U.S. markets are closed tomorrow, of course, for President Carter's funeral. At least the stock market is. So a lot of attention paid to 8:30 a.m. on Friday. We had a mixed bag of economic data this morning. Not really a clear picture. Maybe that explains these small moves, at least if you take a look at the large stocks. The small caps, your little guys, the Russell 2000 down about 0.9%. We'll keep an eye on these ones as well. But let's look under the hood here, because we've been talking about those quantum computing stocks really taking a big leg lower after comments from NVIDIA's Jensen Huang. He said that very useful quantum computers are likely 15 to 20 years away from reality. Again, what very useful means to Jensen Huang could mean something to all of us, but in any case, you take a look at Rigetti right now, down about 34%, Shanali.
Yeah, speaking of NVIDIA, let's take a look at the chip stocks at the open, because of course you saw a brutal set of selling yesterday when it came to NVIDIA. You're seeing it relieve itself right now, up about 1.5% this morning. There were concerns about tariffs and inflation. They're all on top of Wall Street's mind as Trump prepares to enter office. But it's interesting, Matt, you still see a pretty mixed trade. AMD still down more than 3% at the market open, but Micron extending its gains another 1%.
All right, I'm looking at Albertsons. After spending a significant amount of time in England, I really care about grocery store stocks. Albertsons raised its profit guidance in its first earnings report since a judge blocked the $24 billion deal with Kroger. The company's comp sales growth missed expectations slightly, and you can see the shares down a little bit, but I don't really care about grocery store stocks. I'm just saying that.
I wasn't sure. You know, I would believe almost anything you said, which is pretty dangerous. But in any case, Albertsons down about 12% over the past year. Definitely needs some good news after that merger fell apart. But in any case, let's broaden out this conversation with JP Morgan Private Bank U.S. equity strategist Abby Yoder joining us on set. Great to see you in person.
Great to see you.
So let's talk about drivers of this market right now. One of the narratives, of course, towards the end of 2024 was that this was going to shift away from a macro-driven market into more of a fiscal-driven market. It feels like in the early days of 2025, though, you're seeing every economic data print move this market. A lot of attention paid to Friday's jobs report if you take a look at the options market. How are you thinking about the potential catalysts going forward?
Well, I think to your point, yes, Friday is very important from a labor market perspective. I would say our view on the labor market at the moment is that it's loosening at the margin. It's nothing to be very concerned about, and it's loosening to an extent that allows the Fed to continue to cut. In terms of catalysts in the near term, I think the most important thing really is going to be earnings, which is coming up starting next week. So I think that's something that we're very focused on. I think the consensus estimates are around 12% growth for the quarter. We're slightly above that in terms of our outlook, and a lot of that is being driven by tech and our optimism for tech going into next year.
I'm glad you specified, because when we look at those estimates, estimates, one big question I have is you have a stock pickers market once again, and more investors saying to us that you can't even pick sectors anymore. You have to pick stocks within the sectors. So what are the ingredients that you're looking at for companies to outperform here, that growth story?
Yeah, well, so I think to the point on looking within sectors, right, so we're still positive tech, but the way we're thinking about it is like, yes, we still like these mega cap names, but we're in this we're entering the third year of this AI phase, right? And so we're thinking about different parts of the tech supply chain that are going to benefit in that type of time period, right? So when you're thinking about a data center, for example, thinking about companies that are supplying the components that go into those data centers and that allow data transmission, which is obviously very important and is going to increase as these data centers, process more information. And so that's something that we're thinking about. So not just necessarily the mega cap names, but the other names that are going into that build out as well.
If I think about a rally, I have to worry about yields. And I mean, I showed a chart at the top. We're perilously close to 2008 highs. In the UK, I think they're there, right? Isn't that a concern? Or I've heard some people paint it in a bullish light. Is it a good thing for stocks?
I mean, it's not necessarily a bad thing, right? I think the way that the market's moving right now, and the way that let's think about it. Let's compare it to the move in yields in the fall, right? And what you saw was stocks actually held in quite well when rates moved that much because economic data was hanging in. That's what we're getting right now, right? And I would say there is definitely a concern around what's going on with the fiscal picture, right? That's what's really weighing, I think, on the term premium as it relates to rates. But the difference between, to your point, Matt, on the U.S. versus the UK is it's not necessarily like a deficit concern in our mind because you're not seeing the dollar sell off, right? You're seeing the pound sell off in conjunction with rates, and that to us is like a fiscal concern in terms of their outlook. Whereas in the U.S., you're having that decoupling of rates versus the dollar, which is to us signals that the market isn't quite concerned right now. There's like some tidbits of that, but not overly concerned.
So if you dissect the drivers, maybe it's not as scary as maybe the 4.7 on the 10-year Treasury yield would be at first blush. But is there any level that would concern you when it comes to the long end, drivers aside? You had a note from Goldman out this morning saying that basically equities have been really resilient during this bond sell-off so far, but that leaves a lot of scope for downside if we get much higher.
Yeah, well, so I think, and this isn't precise, but I think there's like probably a psychological level around 5 to 5.5 that would cause some pain in equity markets. But I think what's important, and we incorporate this in our outlook, is right when you're thinking about what is the drive, like why do rates matter to equities, it's really around mostly valuation, right? And so in our outlook, we have a year-end target of 6,400. A component of that is valuation compression, right, down to 21 times. And I would say that's probably below the majority of the street in terms of their outlook. And so we're taking into account like those higher for longer rates in that outlook, in that view.
It's interesting. We talk so much about rates, but one thing that's harder to digest, I think, is the impact of the dollar on equities as well, because that's what's been moving very drastically in light of any conversation about trade. DataTrack this week said that the nominal dollars index, the gain, is worth 36% of the S&P's relative outperformance since the election. That's incredible. I mean, if that's the case, then what would it mean if the dollar were to reverse?
Well, I mean, I think there are two components of the dollar move. I mean, a stronger dollar is not necessarily good for international profits as it relates to these large companies. So I would also
domestic investors. Who cares?
Yeah, right? I mean, I would argue that like the stronger dollar has been a negative impulse on the equity market. Like I think that's been more of the headwind, and I think it's one of those things that's under the radar because we're pointing to rates. But I do think the stronger dollar, from that perspective, will be not obviously a fundamental headwind, but a headwind in terms of earnings for international companies.
Abby, we have to leave it there. We thank you so much for joining us here on set. Happy New Year to you. Can you still say that? Is it too
Larry
late?
David says that you can. January 7th was the last
cutoff?
day.
Damn, we're
According to Larry
late.
David, if you put stock into that.
I don't.
I do. What he says makes sense.
Boy, is this another debate we're going to put our guests up to? That's what I want to know, Abby. Again, thank you so much again. I want to quickly check on some stocks here because you have eBay just moving higher. It's your biggest gainer in the S&P 500. Meta said it will will allow eBay ads on Facebook Marketplace in Germany and France and the United States to comply with an EU antitrust order. The EU ordered Meta to stop trying its classified ad service to Facebook's social media platform, and eBay shares now highest since 2021. We're going to keep you in the loop on all things moving under the hood. Interesting single stock stories here. Now coming up, another one, Moderna stock on the rise as it looks to help another public health crisis. We're going to bring you the details of that next. This is Bloomberg.
The top names in business are on Bloomberg.
We are in the midst of the largest wealth transfer in history right at this very moment. So $100 trillion of wealth is going to next-gen and millennial clients over the next decade. So that has some pretty significant implications. But in addition to that, women are controlling more and more global wealth. Today, they control a third of global wealth, but in the next 5 years, $30 trillion is going to pass in the hands of women, and they're going to control over 50% of the global wealth market out there today. Women care deeply about investing with purpose, investing to make an impact, doing good with their investment. So you're going to see some significant opportunities for us as we lean in and have been leaning in to capturing more of the female wallet globally.
Nobody covers business like Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
The multi-trillion-dollar industry.
Down, Chrissy, in the session yesterday. The 10-year now at 4.6%. We have seen Fed cut bets eroded in the first half off the back of that eco data. Now you've got a bit of optimism on Wall Street, but for the European session, down 0.4% for futures. Euro dollar at a 103 handle, around its lowest in over 2 years. The countdown to the opening trade starts right now.
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
The CEO of NVIDIA speaking exclusively to Bloomberg's Ed Ludlow, talking about, you could argue, two of the main subjects that we're focusing on this morning. There are three, but two of those certainly hit there. The three basically are what is happening with NVIDIA, what is happening with Greenland, and what is happening with the bond market. Those are the three main subjects that everybody seems to be talking about. Let's talk about NVIDIA first of all. The stock down pretty hard, Lizzie, down 6% yesterday. That's 220 billion wiped off the market cap of NVIDIA. Yes, I wonder if you could buy Greenland for 220 billion.
It's not for sale, guys.
Apparently.
It's not some real estate deal that you can just do.
Square footage, that's 110,000 per square kilometre.
A bargain, but it's not on the table right now. Look, NVIDIA, Jensen Huang, not invited to Mar-a-Lago just yet. He's got to join the queue, he tells Ed Ludlow. But it, as you say, had a pretty bad day yesterday. I told you that CES speech was a bit underwhelming.
Yeah, meh was their word.
Exactly.
Everybody should have used that yesterday.
Didn't cut the mustard. But he actually did a favour to Samsung because they didn't have the best of results and actually the shares had fallen. And then Jensen Huang stepping in saying, look, they can resolve their technical issues, sort of rescued the stock after that.
When you look at some of the analyst commentary around the NVIDIA story, there's a long tailwind is basically what they're saying. They're not saying there's a slowdown in demand. They're not saying their long-term forecasts are looking poorly by any reason. They're just not the A+++ kind of impact that you get from an A++ student.
Were you an A++ student?
I was an A.
Guys, crude oil target done. You can book the profit over here or you can wait for the breakdown as well. This is a support, weak support. WL is representing weak level. To sell from the resistance, book the profit, or if you want to trail, book half profit and remaining quantity trail कर लो यहाँ पे. अगर ये breakdown retest कर गया तो फिर 6283 is that final target. If you take the support or if you want to buy, go with a very small quantity. It is a very weak support area. Sellers book the profit. Sellers can book the profit. Or if you want to trailing target this one, trailing SL cost to cost with remaining quantity. Now inventory is also there, so remember. It's completely sideways at FVG. ये बिल्कुल ही sideways हो गया FVG पे. Barak ji, thank you so much for joining channel membership. If you have any question, you can ask in the comment box. Silver मैंने बता दिया. The level already mentioned in silver. Entry at 9 PM, so sideways भी जा सकता है. बाकी forecast देखोगे क्रूड ऑयल की इन्वेंट्री का तो लास्ट वीक -1.2 था, -1.8 एक्सपेक्ट किया हुआ, -1.8 मींस लास्ट वीक के कंपैरिजन में और कम एक्सपेक्ट कर रहे हैं तो फोरकास्ट के अकॉर्डिंग कम आता है तो इट इज़ बुलिश फॉर क्रूड ऑयल प्राइस। अगर अगेंस्ट आ गया तो फिर और नीचे जाएगा। फोरकास्ट के अकॉर्डिंग तो ऊपर ही जाना चाहिए। लेट्स सी। बाकी नेचुरल गैस की इन्वेंट्री काफ़ी लेट है 10:30। लेट्स सी व्हाट हैपन ओवर देयर। ओके एंड सिल्वर, इफ यू लुक एट द सिल्वर, वही सेम ही लेवल था, वहीं से मार्केट सपोर्ट लेके बैठा हुआ है। ऊपर भी छोटा सा रेजिस्टेंस है। ये रेंज ब्रेक हो जाए तो फिर थोड़ा बड़ा टारगेट मिल सकता है किसी एक साइड पे। नेचुरल गैस साइडवेज चला गया लग रहा है इन्वेंट्री की वजह से। यूएस मार्केट ही कैंडल ने। हाँ 8 PM की कैंडल ने। ये देखो ये साइडवेज ही है अब, मुझे लग रहा है ये ना, ये है साइडवेज ही अब मुझे लग रहा है इन्वेंट्री तक। एक पॉसिबिलिटी है अगर थोड़ा निकल जाता है ऊपर तो ये यहाँ तक जाना चाहिए लॉजिकली तो। हाँ वही यूएस मार्केट के वक्त थोड़ा सा फिर अवॉइड कर सकते हो उस समय ट्रेड लेने से। वैसे इसमें कोई ट्रेड बना भी नहीं है नेचुरल गैस में। सपोर्ट पे अगर किसी ने बाई किया तो बात अलग है, नहीं तो अभी तक ये किसी भी सपोर्ट या रेजिस्टेंस पे आया ही नहीं है। एफईजी पर ही रुका हुआ है स्टिल। क्रूड ऑयल में मिल सकती है फिर से अपॉर्चुनिटी। वैसे तो इसमें इन्वेंट्री है, अगर ये ब्रेकडाउन रीटेस्ट हुआ तो यहाँ पर एक ट्रेड मिल सकता है वापस से। बाकी वीक सपोर्ट है, लेट्स सी सपोर्ट लेता है नहीं लेता है। लोगे तो थोड़ा क्वांटिटी कम रखना बाइंग के लिए फ्रॉम दिस सपोर्ट एरिया इन क्रूड ऑयल। बाकी सेलर्स आई होप निकल गए होंगे जो लोग ट्रेल कर रहे हैं। ट्रेल द एसएल। गोल्ड में न्यूज़ थी, न्यूज़ डेटा और न्यूज़ थी, जा चुका है। अब कोई डेटा नहीं है। ब्रेकआउट हो गया शायद गोल्ड में। गोल्ड में ब्रेकआउट हो चुका है कल के रेजिस्टेंस जोन का। सिल्वर में अभी भी नहीं हुआ है। गोल्ड में देखो लेवल बनाया ही नहीं है, कल का ही रेजिस्टेंस था। मार्केट उसका ब्रेकआउट कर चुका है। रीटेस्ट करता है तो एक बाइंग का प्लान कर सकते हो। ऑलरेडी बाइंग में हो तो ट्रेल कर लो। 2663 ब्रेकआउट ऑलरेडी हैपनिंग। कल डीप लेवल से रेजिस्टेंस लेके आया था तो चांसेस आर वेरी लेस फिर दोबारा रुकेगा। ऊपर देख लेते हैं एक बार रेजिस्टेंस और कहाँ मिल सकता है। 15 मिनट। पर तो फिर रेजिस्टेंस वही 2677 से 2680 के बीच में ही मिलेगा। अगर ये ऊपर सक्सेसफुली निकलता है तो दैट इज अ मेजर रेजिस्टेंस देन।
comes from Europe. It's nice to see them putting their money where their mouth is. But he says there are three problems, right? The engineers are too humble, the regulators are too ethical, and the investors are too cautious.
So companies like Anthropic in the United States continue to dominate. This is a pretty decent spending round. How they spend it, I think, is interesting. What they spend it on, I presume there's a whole load of Blackwell chips that are being lined up on the back of this. But what else are they going to do with the money?
This idea of this kind of bolt-on acquisition approach that is still continuing, by the way, this is coming off of, I think the context is very crucial here. These Mag 7 companies, your Amazons, your Microsofts, your Apples, et cetera, sitting on trillions in cash on their balance sheets. They can't deploy it. Buybacks are too expensive because the stock market valuation are too high. So what do you do as you get your own internal R&D up to date? You buy. This is where Microsoft has this investment in OpenAI. Amazon did that with Anthropic and is now growing even more. The fact that you're getting these funding rounds tied to the Mag 7 space at these valuations brings this idea that you're seeing the issues and concerns in the public markets now seeping into the private ones, and certainly in Silicon Valley as well.
It would be amazing to see Europe doing something like this. I could just feel so unlikely at this point. The science is here. Of course the science is here. Even in the UK, the UK has amazing science in this space. Especially the UK. And yet it doesn't. What is holding us back? If Keir Starmer was to find a company like this in the UK, how transformative would it be in terms of the ripple effect into the rest of the ecosystem? You think about how the UK develops growth from here. Where does it come from? Does it come from the City of London? Does it come from the sciences? Does it come from life sciences? Does it come from the AI community? These are the areas where the UK, in theory, has strength.
And it comes from joining the dots.
But it doesn't. The dots don't get joined.
As I would say, that's an easy way to make a valuation play, right? If you believe in the technology and you want to not pay up for it in the States, buy it here in Europe.
Find it here in Europe.
A bull case right here on the continent. Coming up, we're going to stick with that tech theme. We're going to bring you more from our interview with NVIDIA CEO Jensen Huang, who says he's ready to meet President-elect Donald Trump. Plus, the new EU Commissioner for Industry tells Bloomberg that Europe must be ready to defend itself from potential tariffs out of the States. That exclusive interview later in the show. And up next, we go back to the markets. We're joined by Nicholas Brooks, head of economic and investment research at Intermediate Capital Group. If you have any questions of your own for our guests or for us, get involved in the conversation. IB plus BBTV Go is a function on your terminal. This is Bloomberg.
Markets have very much focused on the fact that, you probably will see somewhat more inflation in the short term. They've taken that as quite hawkish, but it's double-sided. I mean, you have it, on the one hand, you have an inflationary impact. On the other hand, there are also some risks to markets if we were to see a more aggressive tariff posture, which of course is a risk.
Love economists on the one hand. On the other hand, Goldman Sachs' chief economist, of course, Jan Hatzius there, talking to the team yesterday. The bond market seems to be in charge of the narrative. US stocks got hammered yesterday. We saw the big sell-off in the US bond markets, deepening speculation about when the Fed is going to be cutting rates. Is it before July? That certainly is what is being priced in now. Inflation seems to be the word on everybody's lips right now, along with yield curves, steepening, all of these kinds of phrases that we're throwing around at the moment. The move is dramatic. Let's put some size and scope on it. Valerie's here to do just that.
Yeah, that's right, Guy. A lot of factors at play here in the Treasury market, especially in the long end. That 30-year bond at 4.90. Just how much longer until we breach the 5% level? A lot of those factors at play that you mentioned, the swelling deficit, the Treasury supply that the market will have to digest this year, alongside the upgrades to growth and the prospect of inflation being ignited under Trump's economic policies. But let's put the Treasury move into perspective. In my next chart, I want to show just how close we're getting to those cycle highs when it comes to the 10-year and the 30-year. We are 30 basis points away in both of those treasuries from the cycle highs that we saw back in the end of 2023. And remember, that was quite a treasury scare when it comes to the market confronting more treasury supply. That was Yellen when she announced that these treasury auctions were going to get bigger and bigger. We're now 30 basis points away from breaching those levels. Could be some more hot economic data that could take us that leg further. We have Friday's NFP, but before before we get to that, we have the Fed minutes tonight at 7 p.m. London time. Be very interesting to see just how close that call was to cut rates in December. And the market will be parsing through this about any hints about how long the Fed expects to be on pause. We're now expecting, when it comes to market pricing, the Fed to be on pause until July. We also want to know just their take on the political situation, what their guise is from the potential economic policies from the Trump administration. They factored this into some of their growth forecasts, into their upgrades, into inflation. We want to be discussing, we want to look very closely about what they're penciling in for those potential adjustments to the U.S. growth. That drops at 7 p.m. UK time, those Fed minutes.
There's a lot going on, isn't there? You've got Fed minutes coming up. Obviously, we're watching the data. Payrolls Friday, feel like a mile away at this point. Seems like we've got an awful lot to get through in terms of the sessions ahead. Valerie, thank you very much indeed. Let's carry on the conversation and figure out what is happening. Nicholas Brooks, Head of Economic and Investment Research at ICG, joining us around the table. Do I sell stocks if I get to 5% on a US 10-year?
I'd say yes, probably. I think we're in a situation right now that's a little worrying. I think we have a lot of contradictions going on. So, for example, as you reported earlier, we saw the services PMI or services ISM in the U.S. very strong, and the prices paid element very strong. At the same time, the labor market is booming along so far. We'll see on Friday. And what I think, and that's why I think what's going on in markets right now is quite rational, is the Trump administration, or Trump's promises in any case during his campaign, were very fiscal stimulatory. So if the U.S. economy is now growing at or possibly above its potential rate, and we're talking about more fiscal stimulus next year on top of what we're already doing now, it's quite rational that bond yields are moving up. But at the same time, valuations are very high in equity markets. So I think if we were to see the U.S. 10-year move beyond 5, we could quite easily see a relatively large correction in risk assets.
How large? And are we now? So we're now basically at the point where good news is bad news. Economic good news is bad news for equities. Is that the right way of thinking about it?
Yeah, I think, what markets really want, of course, is the Goldilocks scenario. So that we want decent growth without too much inflation. And frankly, that's more or less what we've had over the past year or two, which is one of the reasons why equities have done so well. My concern in 2025 is that we've been running these large fiscal deficits. The U.S. economy has been booming along at close to 3%. And now you have Trump coming in saying rates need to be lower. And we want to, cut taxes. It's, it doesn't make sense.
The math doesn't quite add up there, does it? But I'm curious about the move on when it comes to the long end of the curve. You talked about the deficit there a little bit. Is this really a problem? I'm taking the contrarian approach here. Is it really a problem to have yields on the long end rise if it's done in a slow and gradual fashion, as opposed to something like we saw in the third quarter of 2023, where it was the same fears, deficit, housing, policy as well, but it was more of a shock? Does it matter if it's slow and gradual?
No, that's a very good point and a very good question. I think, slow and gradual, you can get away with for a while. But there is a point where the cost of capital becomes a problem for companies. I mean, companies have been dealing with, and by the way, the government have been dealing with much higher interest costs over an extended period. Now, you could say it's a little bit like boiling the frog slowly. You don't know at what point is this going to become a problem. So, yes, gradual probably has less immediate market impact. But the question is, and I think nobody knows the answer to this, of course, is at what level does it start to trigger problems in the corporate sector, and when does it become a potentially an unsustainable situation in the fiscal side?
But the reason that this time is different, one would argue, is that
love that phrase.
You're welcome. The reason this time is different, potentially, is, especially from the corporate perspective, there's still so much cash on the balance sheets. You're seeing this with the hyperscalers. You're seeing this in NVIDIA. You're even seeing this in other more cyclical companies where they're still sitting on so much cash. You're seeing this in households where they're still sitting on so much of that stimulus and that wealth generation. Even though they may not feel it, it's there. Again, is there enough cushion to digest the tariff risk, digest retaliatory policies? What metric are you looking at for that crack to become clearer when it arrives?
Yeah, I mean, I think a key ratio to look at across the board is interest coverage ratios. And what I've seen and what I think is probably going to be a key theme this year and probably into 2026 is this dispersion of performance. You have larger, mid-sized companies that have good cash flow, that are asset light, that are going to perform well. But then you've got a lot of companies, smaller companies, that have been having issues. And we probably see more cracks coming up there. So I think there'll be this performance dispersion with balance sheets being a critical differentiator for company performance.
I feel like this is a question that we're asking ourselves. When you have a press conference like Trump has just done at Mar-a-Lago, where he's coming up with policies on pretty much everything, what do you listen to and what do you kind of tune out? What's going to have a longer-term effect?
Yeah, again, another very good question. This morning when I saw those headlines, I was a bit surprised as well. I would say that I think ultimately investors are going to look at which announcements seem most credible, and will focus, of course, on the ones that have the most immediate economic ramifications. So I think the two areas that investors will be focusing on in 2025 are obviously tariffs. Those are real, and those will have a real impact, not just at a country level, but at a sector and at an individual company level. And then, of course, the fiscal policy, because Scott Bessent is going to be in a very tough place when he steps into Yellen's shoes, because, you know, if you look at IMF data, we're talking about a U.S. fiscal deficit this year or last year of 7.8% of GDP, debt to GDP gross 120%, and a number that I was just looking at yesterday that surprised me, maybe not some of our listeners, is that U.S. interest payments as a percent of total government revenue, 20%.
It's a very big number.
It's a big number.
And one that's going to continue to be an issue if we track even higher on these 10 years. Nicholas Brooks, Head of Economic and Investment Research at ICG. Thank you very much indeed. Nice to see you. This is the challenge. Tariffs and fiscal policy. That sounds straightforward. How do you? Yeah. But what are you looking for? And Bessent's got so much he could do at this point as well. Yellen issued a lot of front-end bills, and she issued at the front end. He's talking about issuing further down the curve as well. That could even further steepen the curve up. There's a lot going on here in terms of even the details within relatively straightforward areas of what Trump is talking about.
Is it scarier for the market if it comes in one big, beautiful bill, all in one go with a hefty price tag?
This is the key point, right, that Nicholas just made. The math doesn't add up, and you have to get the tax cuts in before you get the actual tariffs. Or maybe the tariffs before the tax cuts. We'll talk about what the order actually looks like. Coming up, we go to more right here on the continent. Europe has been burning through its natural gas reserves at the fastest pace since 2018 this winter. We're going to dive into the details. This is Bloomberg. "30 minutes from the start of the opening trade. When you look at the futures picture, you really want to keep an eye on all the geopolitical news that may be a little bit of a headwind or a potential tailwind for certain industries. Eurostoxx 50 futures down about 0.4%. Underperformance in France as well. Outperformance over in the States, but not by a massive margin. S&P futures virtually flat right now, 59.59 on those contracts. The bond market picture, remember, in the context of the States where you did see that sell-off yesterday, continues in the German 10-year as well. That might have something to do with the factory orders that we got, a 5.4% drop on a month-over-month basis on a very volatile data set. As Guy had mentioned, the French and Italian yields marginally getting a bid. Maybe a little bit.
So you could think about what happened in the States yesterday. You saw the ISM services, the inflation story was kind of quite clear within that data. You've also seen that within the European data over the last 24 hours. European data certainly signaling that inflation continues to tick higher. Energy prices certainly a factor in all of this, adding to the CPI picture. And you can see that in terms of what is happening in terms of the gas futures. They have been tracking high. We are up 50% year on year. The region is burning through its reserves, gas storage, at its fastest pace since 2018. It is getting increasingly cold outside. So how much faster are we going to be getting through those reserves, and how big a problem could this be for Europe as we head out of this winter and into next winter? Nadia Martin-Wigan, Director at Sullen Capital, a commodities-focused alternative investment manager, joining us to discuss. Nadia, as I say, it's getting cold. We're starting to think about gas storage. We're going through it pretty fast. How fast are we going through it, and how big a problem could this be?
Good morning. So we're on a trajectory that matches what we saw in 2016-17 and then 2017-2018, where we ended the winter season at 10 to 20% stock levels. When we compare that to where we've been since Russia invaded Ukraine, it's a massive difference. Already the market seems to be thinking that we could be as low as 35-40%, but to come that low, it really puts pressure on imports. And when you have storage dip below 30%, your withdrawals are less efficient, so you can reach that bottom very quickly. In addition, we don't have floating storage of LNG available offshore like we've had the last 2 winters to prevent price spikes if there are production outages for TTF.
So how do we refill? Presumably, if we don't have Russian pipeline gas, that's going to be more tricky. How much extra LNG do we need, and how much capacity do we have to refill via the LNG route?
So if we start with what we know, right now, Russia is no longer transmitting gas through Ukraine. To replace those volumes, which is 15 BCM, that means 1 LNG cargo entering Europe every other day. For that, we have ample capacity. It can very easily be done. If we're down to these low stock levels that I described, we could face demand for up to 400 additional LNG cargoes needing to come into Europe to hit that 90% target on storage for November 1st.
I mean, Nadia, good morning, it's Lizzie. Do you think that the real issues start next winter as you get the storage withdrawals now? I was talking to Javier Blas on Bloomberg Opinion about this yesterday, and I think you're even more pessimistic than him about where the storage levels drop to.
Absolutely. I think that we've just seen how cold weather really draws it down quickly. And we're in a situation that we've already had a lot of demand destruction. Right? So it's not where we were in 2022. So this need for LNG is much stronger this time. And this is, of course, for next winter. But that mandate for 90% levels of storage, that comes from the EU. There are some very big penalties in certain countries if you don't reach that. And the feeling amongst the trading community is that if storage holders don't do it, then the TSL will do it. And when we look at the shape of the natural gas curve in TTF, we can see that summer prices are still very, very high. We don't have the contango we should to build that storage. So it's really looking to be an issue already in the summer to prepare for next winter, not waiting until next winter to really have the shock.
So we're talking about the US ramping up production to make up for this lost Russian gas through Ukraine, to keep Europe supplied. Where do you see it flowing to mainly?
So when we look at last year, US exports of LNG went #1 to Europe, especially the Netherlands. Then it went to Asia, Japan, South Korea, India. What we saw is overall imports of LNG to Europe were down year on year. But then that was immediately almost 1-to-1 replaced by this extra Asian demand. When we look at what we see in extra production coming out of the US, it perfectly can match what is no longer transmitted via Ukraine from Russia. However, when we're looking at rebuilding the entire storage situation, that would probably require LNG from all sources, even possibly including Russia.
Nadia, when we traditionally talk about LNG, we're doing it from an energy perspective, from a heating perspective, certainly an export perspective. Today's kind of big theme on the show is a lot of the tech story and the data build out, the AI build out. There's a narrative in the States that to do that, to kind of fund that AI growth, to fund those data centers, and also to supply the energy needed to make that sector thrive, natural gas is the way to do it. What does that outlook look like, and how much of a tailwind is it for pricing in that sector?
Absolutely. We believe at Svelland Capital that natural gas is the reliable, fast solution and least expensive solution to have these data centers up and running. When we look at where prices have been in Henry Hub, though, we saw curtailments in production last year. You know, when we're at $3.5, $4 for MMBTU, then we start to see production coming back. And this is where we've been waiting to see Marcellus really ramp up production. But right now, there's such a cold snap in the US that instead of increasing production, we now have cuts to production. Last year, we had a massive cut to production. Granted, it was short term, but this is where we need additional infrastructure build out to make it more across the lower 48 to bring that going forward for the next 5 years.
Nadia, what does that relationship then mean for the oil sector, especially in the United States, again, where so many of the utilities that used oil as kind of that power generator and that commodity for the reasons you just outlined in terms of just how expensive it can be, have switched to natural gas? What does that mean in terms of the correlation between oil and natural gas from a pricing and trading perspective?
Well, they will be increasingly related. And what we also see is when natural gas prices get very high, we see switching back. And so that can continue to happen. One thing that is very helpful for the oil sector is that a lot of shale production has associated gas. With higher gas prices, even where they are just a little bit higher on Henry Hub, it means that producers will be able to produce more oil with less high oil prices and still be above their break-even prices. So it should help the entire sector together, hand in hand.
All right, Nadia Martin-Vigan, Director at Svelland Capital. We thank you for joining us, making time for us this morning. And coming up on the programme, the NVIDIA CEO has given Bloomberg his insights on the coming US administration and the future of AI. So we'll bring you that interview with Jensen Huang next. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
So we saw NVIDIA shares slumping after a wide-ranging product presentation by the CEO, Jensen Huang, failed to win over investors in the AI chipmaker, a bit underwhelming. He was also speaking, though, to Bloomberg Technology about plans under incoming President Donald Trump and the impact of AI on the gaming industry.
AI is going to reinvigorate the video game industry. On the one hand, for developers, it's going to reduce the cost of creating the content. On the other hand, all of the characters that are in the games are going to be smart characters in the future. So every time you interact with them, they're going to be interacting with you in a much more intelligent way. And so the games are going to be more interesting. The characters are going to be more interesting. The content development cost is going to decline. And that's going to be really great for the industry. And so I think that the future is really bright for video games and these virtual worlds. And artificial intelligence is going to really reinvigorate it.
Project Digits. May I pick it up?
Yeah.
$3,000 Project Digits.
Yeah.
A supercomputer you can
sitting
put on
right
your
next.
desk.
Exactly. Could you imagine you're just sitting there just like that? You're working on your PC.
Well, I can't imagine. Why would I need one of these? Probably not me. But how big is the addressable market for this? What is the addressable market?
There are 30 million software developers. There are probably something along the lines of 10 million designers around the world. Probably another 20 million creative artists. Hard to say exactly how many students. I'm going to guess probably a couple of 100 million students around the world. Everybody's going to have to. Everybody's going to have to. Well, they can afford computers, and so if they can afford computers and they would like to have a companion that helps them do AI, this is the way to do it.
Can I just clarify something on it? I think you said on stage Mac OS, Linux, and Windows, but the communication said just Linux.
No. Whatever computer you use, you're literally enjoying how it's going to be used. It's sitting right there, and you just connect to it wirelessly like it's your personal cloud.
I promised the audience I'd clarify that because they're excited. We're running short on time. President-elect Trump has been speaking during the course of our conversation. How imperative is it that you go to Mar-a-Lago and meet with him if NVIDIA is America's leading AI company? And will you?
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
A lot of what you outlined on stage last night in the realm of physical AI, I saw XPeng, for example, in the autonomous driving context. That's happening in China. Like, they are doing a lot on robotics. So I'm going to ask you about tariffs. You know, it's likely this coming administration will be as restrictive on technology export, and tariffs will be a function. How have you prepared for that, Jensen?
Whatever the administration ultimately decides, we'll give them as much insight as we can from our perspective. And I'm sure that the administration will make the right moves that's in the best interest of our country.
So that was the NVIDIA CEO, Jensen Huang, speaking to Bloomberg's Ed Ludlow. Let's get analysis now, though, from Bloomberg anchor Tom McKenzie. He joins us round the table. Tom, there are a lot of announcements here. Which of them were new, and why was it kind of underwhelming, seemingly, for markets?
Well, I think there's still this gap, and this is something that Ed was pushing Jensen Huang on, which is what is the market opportunity? What is the dollar number that you can put on some of these future projects? And I think that's where Jensen Huang either failed, willingly or not, or was unable to give a number to. And I think that's the mismatch. He outlined, of course, the projects around having a personal supercomputer for $3,000 for programmers, but talked about hundreds of millions of students, but couldn't really give a dollar number on that. The humanoid robots, Ed pushed him. When is the timeline for that? He couldn't really give a timeline. He talked about the fact that this is a company that is a foundational company in terms of software and the chips. They feed into all these different segments. That, though, makes NVIDIA reliant on its clients coming up with business solutions that they can actually sell to the public and to enterprise. And that dependency means there is some uncertainty around the dollar numbers, unlike, for example, data centers and that component, and those revenues continue. And on that point, he did come out and say, look, we are still at the very early stages of the data center spend, because, of course, Ed asked him, there's concern about that running out. And he said, we're still at the early stages of that. That has a long way to go. That was a positive. I think, interestingly as well, on tariffs, increasingly, as NVIDIA pushes into these different segments, and he talked about autonomous vehicles, for example, they're going to become increasingly reliant, or at least, I should say, increasingly vulnerable to tariffs. And he didn't have a clear answer on that either, maybe for very diplomatic reasons, said they're going to work with the incoming Trump administration. That potentially is a vulnerability for NVIDIA going forward. So there's a mismatch in terms of the future prospects of this business. They're outlining all these ambitions, but they can't really yet put a dollar number on humanoid robots, the supercomputer for personal use, and the cloud, the foundational cloud as well, that doesn't seem to have a real commercial use case at this point.
And yet the priorities are very clear, as you outlined there. The diversification, of course, that dream, even things going into like medical equipment, for example, still very much there. That's not something you see in the likes of Samsung. It's also not something you see necessarily in the likes of Tesla, which he actually commented on, that the priorities are right. The execution may take some time.
Yeah, so Ed asked him about what he thinks the impact will be of Musk being so close to, or in fact inside that new incoming administration. And very interestingly, he talked about the fact, Jensen Huang talked about the fact, he thinks Musk is hitting the mark on three key areas of AI. He talked about XAI, for example, which is the foundation model part of Musk's empire. He talked, of course, about Tesla, the vehicles, and describing that as essentially an AI company because of all the data that they hoover up and how that positions them going forward. It's worth noting, of course, Musk is therefore a major buyer and purchaser of GPUs. In fact, he's put together this 1,000 GPU cluster, so he's a major client for NVIDIA. So there's rationale for that. But it's interesting in terms of how Jensen Huang described Musk's approach to AI and saying he's getting it all right on three key areas. Samsung was another story that came out. It's amazing. I mean, Jensen Huang is getting kind of, you know, almost central bank power, central bank speaker power when it comes to the moves on the markets. He just mentioned one line when it comes to Samsung and the fact that they're working very hard to address the tech issues to get these high bandwidth memories, chips that accompany AI accelerators. They're closing that gap on SK Hynix. He says they're working very fast on that, and you saw the stock moving higher, despite the fact that the numbers that came out from Samsung were very weak indeed, and they have that softness in terms of the demand coming out from China, as well as the competitive threat from China as well. They need to get the accreditation from NVIDIA for those HBM chips. They said it was going to happen last year. Yeah. They need it to happen in the first quarter of this year. Yeah.
Tom, great stuff. Thank you very much indeed. T-Mac on tech, thank you. OK, let's turn back to the broader markets. NVIDIA was obviously a big feature yesterday of the sell-off we saw in the United States. But you need to roll in the ISM, you need to roll in the JOLTS number, you need to roll in inflation, you need to think about what's happening in the bond market as well. Ven Rom, Bloomberg's MLive cross-asset strategist, joining us now from Dubai to talk about all of this. Ven, US stocks fell out of bed a little bit yesterday. NVIDIA was at the vanguard of that move, but nevertheless, the bond market story is front and centre. Is this sell-off just getting going if yields continue to rise?
Well, I think that, there's the well-known January effect, Guy, when investors are supposed to be in favor of buying stocks at the start of the new year. This time around, I fear that the Ides of January have come to roost the markets. And the market is beginning to demonstrate that good news for the economy is bad news for stocks. Then there is the question of overzealous valuations, with the S&P offering an earnings yield of just about 4%. If you look at the NASDAQ 100, the basket offers just about 3%. So if you calculate the fair value on the S&P 500, it works out to around 4,800 on my model. So the market is basically trading 25% above where it ought to be trading. So it's almost as if you could park a jumbo jet between where it is indicated and where it actually is. So the risk reward at these levels seems skewed, is distinctly in favor of a correction. And of course, you've got the Trump inauguration coming up as well. And that is also, investors are likely to be jittery ahead of that inauguration, because who knows what announcement is going to come from White House on tariffs.
Who knows indeed. But just to bring it back to the bond story, I mean, you reckon that 5% yields on the 10-year are possible. Why not 6% then?
I think that 6% may be over-egging it, Lizzie. I think that having said that, I think that the bear case for duration is well-founded. The MOVE index, which gives a robust indication of what traders are thinking, reckons that 10-year rates will settle somewhere between 360 and 555 in a year's time, and that is with a 1 standard deviation certainty. Treasury 10-year rates have already shot up some 80 basis points since the market started factoring in the Trump trade. So the markets are kind of almost well prepared that Trump might slap some tariffs and stoke inflation. They've partially priced in what he may announce. They front-run it. So it all depends on what he announces and whether he announces anything on January 20. So the pricing means that there's further sell-off in Treasuries likely, and that will be to the tune of 20 to 30 basis points on the 10-year from here. So I think that we are going to tread water around the current levels until Trump takes office, and depending on, they will bifurcate from there depending on what he's going to announce on tariffs.
360 to 555. What a range for Treasuries. Bloomberg's Ben Rahm walking us through, of course, that market story. You get more from him and the team. ML Ivy Go on your Bloomberg terminal is the function. Let's go from the macro to the micro. Here's stocks to watch with Joe Easton. Joe.
Morning, Critty. So we're going to be watching defence stocks today after Donald Trump had said in an interview yesterday that he is looking for NATO countries to potentially be pushing up their defence budgets to 5% of GDP, something he has already called for, but going more heavy on that call. So these are the stocks we're going to be looking at today: BAE, Rheinmetall, Leonardo, Saab, some of the usual ones we tend to look at. And of course, this sector has done really well over the past couple of years, given the increased pressure on countries to spend more on defence. We could see potential gains in that industry today. Then the other sector I've got my eye on is bookmakers. This is after Flutter in the US warned that it's been hit by unfavourable sporting results. So gamblers doing well over in the US. A lot of that related to NFL, according to a statement from Flutter yesterday. Now, that is mainly seen in November and December, according to them. Flutter, of course, relisted to the US, so a lot of the volume is over there now. But the one to look out for in particular is Entain, because they've got a big exposure with their BetMGM business in the US, a massive part of that company now, and a couple down here, Evoke and Evolution, also keep an eye on those as well. Then in terms of ratings, Nestle and Danone both downgraded to underperform at Jefferies today, which says that the food part of the staple goods sector is going to continue underperforming. Cosmetics is doing well, according to the broker there. Nestle has been the underperformer, given some weakness in some of their core products, including the coffee business. That stock fell around 25% last year. There's the ratings on Nestle. Only 2 sells on that, but just got an upgrade from Exane as well, so I'm not sure which one's going to have the bigger impact. Novo Nordisk, the other big buy rating over at UBS, and a couple Zurich, L'Oreal. Keep an eye on those as the market opens today.
All right, Joe Easton with our stocks to watch. We thank you so much. Of course, we are counting down to the opening trade here. When you look at the futures picture, seeing marginal moves to both the downside and the upside. I'm looking at U.S. futures here, higher by one-tenth of 1%. Yeah. European futures are, of course, down pretty broadly.
It's interesting. So There's this argument that Europe is cheap right now and therefore is a diversifier, but it keeps moving kind of hand in hand with the US markets. Do we need to see less of a move in Europe on bigger moves in the United States for that to be true? And is that something we're ultimately going to see today? Keep an eye on the defence sector. Keep an eye on what's happening with the wind sector as well. That can be an interesting story as well to watch out for today. Plus tech, of course. We don't have much of that, but we do have some. Futures are pointing a little negative. The Open is next.
Why was Saudi chosen to host the 28th World Investment Conference? We are becoming a really global thought leader. Since the launch of our Vision 2030, all the world has been watching. We know that the global FDIs are declining. However, in Saudi, for the past 2 to 3 years, we have been increasing. It's not a zero-sum game. We can all work together for the prosperity of the international community.
Wednesday morning, good morning. Europe's got a little bit of work to do this morning, pricing on the downside after we saw a sell-off in the United States yesterday. We pushed down towards session lows towards the back end of the US session, as you can see, getting close to some really interesting levels from a technical point of view. The bond market, obviously a key feature here in terms of what we're watching. Are we tracking towards 5% on a 10-year? Is that what is driving this risk-off sentiment that we are seeing in US stocks? The growth picture looks pretty good, but apparently it could be accompanied with a little bit of inflation, and the Fed obviously has to react to that. So we've got a little bit of a gap to fill this morning, Lizzie.
Yeah, it looks like it's going to be a negative start for Euro Stoxx 50 this morning, down 0.25% on futures. The FTSE 100 futures just slipping into the red, but so far not as bad as the rest of Europe. Is that because the UK is less in the firing line from Donald Trump? You've got the DAX pointing to a start lower, 0.25%, Kriti. Maybe we see it more in the sectoral picture.
We certainly might, especially when it comes to that German defense sector. And that's going to be crucial when we look at, again, you mentioned it, the Trump effect, when you talk about some of the kind of ripple effects into Europe. The fact that he's now calling for 5% spending of GDP. I mean, look, the U.S. doesn't spend that. We spend about 3% and at the moment. But the fact that we could get there or call for that and that Europeans may have to match it could be a tailwind for the sector. Big emphasis on could. Another Trump effect on the wind and energy sector, of course. Orsted, Vestas very much in focus. And then Nestle, we're looking for a break from the doom and gloom, perhaps getting a double upgrade to outperform or underperform at BNP Paribas Exane. The broker saying the earnings bleed is finished and there's upside to current consensus to like-for-like sales. Guy, quite the rave review from BNP Paribas Exane.
Stocks come down a long way, an awful long way over the last few months. OK, here we go. Time for the opening trade this Wednesday morning out of Europe. There is an awful lot to factor in, to price in. Let's see how that's reflected in the numbers. Here we go. FTSE 100, we're expecting actually to be fairly flat this morning. A little bit of green, but we're oscillating, I would have thought, either side of the plus and negative line here in London. So the FTSE 100 is up. Elsewhere, I think you're probably going to see a little bit of weakness creeping into the market. The Stoxx 600 is also out of the gate positively, but we'll start to see maybe that changing a little bit as we see the CAC, the DAX maybe coming through, and we'll see what trade looks like in those key markets this morning. There's a number of key sectors that we're going to be watching out for. All of this seems to be trading off what Trump had to say yesterday. We're watching what is happening with the defence stocks. We're watching what is happening with the wind stocks, trying to figure what is going to be happening there. But we've also got, obviously, this big tech story that we need to be pricing into the markets as well this morning here in Europe. Guys, what are we seeing? What is the story below the surface?
Well, before below the surface, it's kind of what we expected. I think you called this from the beginning, the energy effect, that wind effect. Those are your two biggest contributors to the downside. You're also seeing the likes of Shell, for example, really taking a beating this morning and actually weighing on the entire index. They're talking a little bit about that natural gas exposure as well. We're going to dive into the details later on, but Orsted, Vestas are certainly down. To the upside, though, you are seeing a little bit of the healthcare sector regaining some of its losses. And your biggest index contributor to the upside is Novo Nordisk, Liz. And I think this one's interesting because, of course, it has taken a pretty big beating, I think 40% or so from last year's highs. On top of that, I just think the timing is so interesting here. On the same day, same 24, 48-hour period where you're talking about relationships between the United States and Denmark, the biggest export from Denmark to the U.S. is Novo Nordisk's Ozempic. I don't know if that's factored into the pricing. It could just be a technical move. but the coincidence is uncanny.
Yeah, we talked about the fact that Donald Trump didn't seem to have a plan of how he was going to get Greenland. Do you get to see it through a tariff? That's your point. Does Novo get hit by it? But also we were talking about defence stocks, and you're seeing the likes of Rheinmetall, Leonardo, Saab, as flagged by Joe, all up in the green this morning. Saab really up 2.5% there. But break it down by sector across the stock 600. You've got about half in positive territory. Financial services leading the gains, up 0.7%. Consumer products and services at the bottom of the basket. And we've just had this report of French consumer sentiment unexpectedly falling amid all that political gloom as well.
Luxury's under quite significant pressure as well. L'Oreal, LVMH down. Hermes is under pressure, I saw just a moment ago. But Vestas is down by 4% now. Donald Trump saying he's not going to build any wind farms in the United States in his 4 years. Vestas is obviously highly exposed, but so is EDP. So are many of these European companies that are on this the energy transition story, this huge move that we could be potentially seeing. So a little bit of pushback there coming through. But the points seem to be coming. Like Shell is down pretty hard. That's adding obviously a lot of points to the downside. But luxury is a big drop today. Few tech stocks down as well. Infineon is down by 1.31%. But it does seem as if defence stocks are doing well. You've got wind stocks not doing very well. Luxury is the other big loser that we're watching here in Europe this morning.
Yeah, and I'm waiting for the full pricing to come in when it comes to the DAX as well. You are starting to get some of the opening trades there. We'll see how that shakes out in terms of that defense story as well. In the meantime, we posed that very question in U.S. programming to Jason Thomas, Carlyle, head of global research and investment strategy, about the Trump effect and what that means for Europe. Take a listen to what he had to say.
We have to wait and see what Europe is going to do in response to the U.S. election results. I would pay very close attention to changes in Europe. It's priced about a 40% discount to the United States. Obviously, market participants are not especially optimistic about the likely changes there. But that provides a pretty significant risk compensation to investors.
Pretty significant risk compensation to investors. Could this be a tailwind for basically buying a little bit of bottom feeding? Let's bring in a true expert, Virginie Masseneuve, Global CIO for Equity over at Allianz Global Investors, joins us around the table. Virginie, we've been looking for a bull case in Europe for quite some time with very little success. Could this be that moment that the sell-off is so strong, that the doom and gloom around Europe is so strong, it's almost too cheap not to buy?
I agree. I think that you want to make sure you're not too underweight in Europe. You could have positive catalyst. It could be Ukraine. It could be more spending coming out of Germany with the new election and the new leader. There could be some green shoots, if you want, that have not been taken into account. All this said, growth is lower, but that's in the price. That's why you have the discount. Rates will probably be able to go down faster, as we've discussed. Trump tariffs is interest rates lower less fast or less cut. So I think all of this puts Europe into a position where if people are very underweight, they should have a position.
When it comes to what actually drives the index, I know so many people right now are talking about the growth story. Yeah. But given that so many European companies have that American exposure, I'm waiting for that consumer resilience story in the U.S. to bleed into Europe. Why hasn't it to a bigger margin?
I think the political element has taken over, to a certain extent in Europe. But you're absolutely right. A very large part of the European earnings are global and somehow have not been reflected in the stock price. Somehow the concentration of the market, if you want, that we've seen last year in very strong global markets. I think we're up 40% from October 23 or, whatever the exact date is. But we've had 2 years of very strong rally. And I think in that you've had that concentration on the U.S., on part of tech, and a lot of the other, if you want, less glamorous stories have been ignored. And if you think 25 is a year of volatility, more erratic behavior, as we know, more unforeseen news coming out of Washington, I think you want to have that diversification and you want to make sure that you find those companies at cheaper valuations with earnings potential.
If the S&P fell by 10%, would the stock 600 fall by 5% or 15%?
So what are the currencies going to do? Okay. Because that's the key. Again, if you go back to the tariff topic, if you look at 17, 19, tariffs, you've had a decline of the dollar of about 10%.
Yep.
So your return, are we talking in local currencies or are we talking in dollars? Yeah. In local currencies, I think you could have, given the valuations, and let's put France aside, given the political volatility that might come, I think France will come down less than the US.
Okay. How does that argument go down when you make it to US investors? Because in theory, they've got the strong dollar to bank the currency story into the mix. Europe looks super cheap. In theory, that should be a win-win. But when you make that argument, what do portfolio managers say?
Well, so it depends on the time horizon.
Yep.
It depends on, their benchmark. Do they really have a global benchmark? A lot of US investors have a US benchmark and then an international benchmark, and they play with the allocation. But I think there is...
Do they buy the argument around Europe being cheap?
I think they do.
Is it an argument that gets that gains traction?
I think they do. I think what's really interesting to me is to see if in 25 corporate America will see Europe as cheap and it will see more M&A.
Okay.
There's a lot of really good assets in Europe. Is there room for more M&A deals coming out because companies are cheap? So in terms of a massive capital allocation from US investors to Europe, I think that's going to be very difficult. Massive, right? I think the home bias, as you know, in many countries, the home bias is still there, particularly if you have a strong currency on an hedge basis, maybe some allocation. Yeah.
Okay. Virginie, we've also been hearing this morning from Jensen Huang. He was speaking to our very own Ed Ludlow, talking about how he's up for meeting Donald Trump but hasn't been invited yet. I know you've been writing about semiconductors, how they're so strategically important, they're like a critical utility but not quite.
Yeah.
I'm kind of wondering if supply and demand is going to be so totally upended by geopolitics. As investors, how should you be thinking about that pricing in the industry?
Yeah, that's really important. And you're right. I wrote, we with the team wrote a note on semiconductors, the new utility. What I mean by utility is it's so critical. It's like electricity. The concept of national security really does that come first versus the concept of profitability? And when you see the ask and when you see, for example, what some companies are doing in terms of building capacity in the US, you have to wonder. So I think it's going to be a mix of both. I think what you'll have is the high end of semiconductors, or the part of the supply chain that's linked to artificial intelligence, particularly if we see that impact on productivity increase from AI, service, impact on power demand, etc., continuing and intensifying. That part, I think, will continue to do well. But we have to take into account the fact that national security and semiconductors now are completely linked.
But in terms of AI, when you've got the likes of Jensen Huang waiting for more imagination beyond his part of the chain, how do you play that in 2025? Or how do you diversify as well?
I think you have to be diversified. I think you really have to think in that second generation of impact, on service and productivity enhancement, et cetera, et cetera. You have to think of not only the big guys, but also the smaller companies or the medium-sized companies who are going to be able to benefit more strongly. So it's a lot of bottom-up work. It's looking at it on a global basis, including in Asia, to make sure that you're not only concentrated in a few big names in the US.
Virginie, nice to see you. Thanks for stopping by to see
Thank
us.
you.
It was greatly appreciated. Virginie Maisonneuve, Global CIO for Equity at Allianz Global Investors. Let's talk about the Core 6 and see what's happening there. This is the centre of gravity here in Europe. This morning you've got Novo tracking a little bit higher, upgraded to buy at UBS as an attractive entry point, according to the Swiss bank. You've also got Nestlé double upgraded at BNP Paribas. Both of those two stocks, it's interesting to see what is happening. Novo is actually reacting fairly positively. Nestlé, much more of a muted reaction. LVMH is down. We've got chips moving higher, though. ASML, Schneider, both gaining traction this morning. Let's get some more details on those individual moves and what else we're seeing. Joe Easton joins us with more.
So we are seeing some movement in these wind stocks this morning, Guy. Vestas and also Ørsted declining around 4%, almost 5% on Ørsted. Of course, Donald Trump saying potentially that he will be looking to block all new wind projects during his term, and that would threaten potentially billions of dollars worth of projects. Remember, Ørsted did actually have a lot of cancellations in the US, so that is weighing on that sector today. Then in terms of defence, we are seeing moves higher there. As Lizzie mentioned a moment ago, seeing some decent upside, particularly Rheinmetall and Saab, as Trump says that he's looking for NATO countries to spend 5% of their GDP on defence. We'll have to see if that actually does go through, but they are moving on that news today. Then in terms of the bookies, some weakness in those gambling stocks today after Flutter warns it's been hit by gamblers doing well on some of their NFL bets, the sport I know absolutely nothing about, but we are seeing some weakness in the rival here, Entain, that one coming down almost 2% at the moment. Flutter in London, thin trading in that one. That did a relist to the US, as we mentioned earlier, nonetheless moving that market. Then in terms of TeamViewer, a big mover. Now this is the work-from-home technology company that rallied in the pandemic. It has had a big slump, but today beating expectations on their sales guidance. And look at that, 14% gain for TeamViewer in Germany, probably the best of the mid-cap stocks that we're going to get today. Then we've got morning calls. The first one, as Guy mentioned a moment ago, Novo Nordisk gets a buy rating at UBS. Now that stock, of course, plunged following the CagriSema data, which was disappointing. The participants lost less weight than expected, but as Guy mentioned, UBS reckons that is an attractive entry point now for that stock, so they go buy on Novo. Then finally, Nestlé. As you mentioned there as well, Guy, it is a muted reaction to the Exane outperform, but that is because Jefferies has actually cut the stock to underperform on the same day. So they've got a new outperform, new buy and a new sell over at Jefferies, which says the food outlook is weakening. So that is why we've got a muted reaction there. But Nestlé gets a couple of rating changes, unchanged at the moment over in Switzerland.
All right, Joe Easter from our equities team, we thank you bringing us the latest on those analyst calls. As we look at the Stock 600, not doing much this morning, higher 0.1%. We had thought it was going to be a negative session, but really it's not as much of a muchness across European equities as a whole. We're going to dive into the impact of Donald Trump's pronouncements on wind next, as Joe was referencing. Vestas and Ørsted affected this morning. He says that wind farm construction during his second term in office is off the table. We'll discuss that next. This is Bloomberg.
"17 minutes into the session here in Europe. It's half of it's up, half of it's down. There you go. We're not going anywhere in a massive hurry here in Europe this morning, to be brutally honest. There are individual sectors and individual areas that are really interesting. Take a look at what is happening with defence. Take a look at what's happening within the wind sector. Take a look at what's happening within the tech sector. Also interesting. And that's really where I think a lot of people are focusing their attention this morning. You saw a big dump in NVIDIA shares yesterday. This after a wide-ranging product presentation by CEO Jensen Huang. It failed to win over investors. Lizzie called it meh. I think that probably pretty much sums it up. He also spoke after that presentation to Bloomberg Technology. It was a wide-ranging interview. He talked to Ed Ludlow. He talked about the fact that he'd also be happy to meet President-elect Donald Trump and do what he can to help the administration succeed. I thought that was pretty interesting in terms of the narrative that we got coming through from him. In terms of the impact that we're seeing folding through into European tech stocks this morning, there is an effect. It's not that great, but you can see that there is an effect coming through from this. When US tech catches a cold, the rest of the sneezes, the rest of the world definitely, to a certain extent, catches a cold. But let's talk about what we can take away from what we've seen over the last 24 hours from Jensen Huang. We're joined by our executive editor for global technology, Peter Elstrom, around the table. That was a really interesting conversation he had with Ed Ludlow. We got a big market reaction, though. Why? In some ways, it feels like what Jensen's talking about and the market reaction feel like they're almost on different pages at the moment. Just to kind of talk me through what you thought was interesting. What are your takeaways from the last 24 hours?
I think, in a sense, they really are on different pages. So this is it's important to remember, this is the Consumer Electronics Show that he's appearing at. He came out and he talked about consumer products in a number of different areas, including their GeForce graphics chips, which are really to drive these computer gaming machines that are so important to this segment of the segment of the market that used to be very important for NVIDIA. It still is important for NVIDIA. It used to be a majority of their shares, but now it's a small number of shares. He also talked about some of the new areas that are expanding into, including autonomous driving, some of the robot technology that they've got. But really what investors, I think, are reacting to is something quite different. What's really driving the revenue at NVIDIA these days is their data center sales, their ability to sell the AI chips that are going to be put into these data centers to be able to drive the AI models at OpenAI, Microsoft, Google, et cetera. That is where the big money is coming from right now. And he did not give as much of a status update on the progress in making those sales as perhaps investors had been looking for. So this focus on consumer products, I think, again, at the Consumer Electronics Show may have conflicted a little bit with this idea of where the revenue are actually going to come from in the future.
But the diversification story still remains a headwind. And even though you look at the analyst commentary off the back of it, everyone's saying that they're still quite bullish on that long-term case. The progress, yes, I see as a potential headwind, but it hasn't, besides kind of paring back the stock a little bit, it hasn't really dented the momentum. And yet some of its big kind of tech peers also took a really big hit yesterday. Amazon, Apple, Microsoft, all the hyperscalers that are investing in NVIDIA. How do you make sense of that?
Right. Well, I think they still have to prove that this AI growth story is real and it's long-lasting. Certainly right now, NVIDIA, because it's selling chips to all these hyperscalers out there, they're making lots of progress. The revenue's growing very quickly. They would like to see more progress about how quickly that's going to go at this point. But on the other end of the table, they have to prove that these services are going to be profitable. OpenAI talked in the interview that we had with Sam Altman about how much of a struggle it is to actually make money from some of these AI services at this point. They need to be able to get to profitability to make sure that they can keep buying those chips in the future, which matters for NVIDIA and it matters for really everybody in that whole tech supply chain. So we saw that kind of cascade across the tech industry yesterday as these concerns continue to bubble up because we need to see profitability at the other end of the AI model.
The actual tech aside, it was interesting as well when Ed asked Jensen Huang about tariffs. And I'm kind of wondering whether, Huang was extremely diplomatic here. Should he be banging down Trump's door for an invitation to Mar-a-Lago? How is NVIDIA actually going to be impacted by the trade war with China?
Well, it's certainly a big issue for NVIDIA in particular. They want to be able to sell into the China market. They want Chinese companies to be able to do business in the U.S. A lot of these CEOs grew up in an era of global trade, free and open global trade, and now they're looking at some potential headwinds on that front. So certainly he's been very aggressive in trying to sell the AI chips into China that he can. He's had a couple of different restrictions slapped on him by the Biden administration in terms of his ability to sell those. So I think he'd like to foster stronger relationships, let the businesses flourish and build their businesses. But, the reality, the politics are we have Donald Trump coming into office on January 20th.
All right, Bloomberg's executive editor for global technology, Peter Elstrom, thank you. Good to have you round the table. I want to take a look at another industry that Donald Trump had his eye on yesterday. He was taking another dig at the renewables sector, saying that he's aiming to block construction of wind farms during that second term in office. Previously, he'd vowed to issue an executive order against the sector on his first day in office. And indeed, we've seen the hit to the wind stocks this morning, in particular Vestas. Those shares down 3.4%. As things stand, Ørsted even more so, down 4.4%. But let's get to Bloomberg's Rachel Morrison, who leads our coverage of gas, power and renewables in Europe for more. Rachel, just take us through how the shares are responding, why they're reacting this way.
The wind industry has been sort of braced and really dreading more from Trump on his plans for the sector. So we have in the past had some quite negative comments. And a lot of people are sort of putting that down to some of Trump's personal experience with a golf course in Scotland. So he sort of has said comments about how wind turbines are bad for whales, as in the sea creature, for which sort of have no evidence to support them. So it's not totally clear why he dislikes wind so much, but it really is a sort of growth sector, or was thought to be a growth sector for the US. So with Vestas, they would have expected to be selling turbines into the US. That's obviously looking less positive. And for Ørsted as well, they are a big developer, but also have projects in the US.
What impact can he have, Rachel?
Well, when it comes to permitting for new projects, he can have a lot of impacts and he can enact this, particularly for offshore wind or land onshore that's owned by the government. So not private land, but the leasing and the permitting for those projects can be blocked and can be stopped. So for projects that have already been permitted, they should be okay, but they'll be worried. But for new projects, this is really the sort of growth that will be stymied by this, potentially by what he plans to do.
So, Rachel, walk us through kind of this geographic allocation here. If the U.S. wind sector is such a big piece to these companies, in the absence of that expansion, if that's what happens the next couple of months, where else can that growth come from?
Yeah, it will be interesting to see what happens, how Vestas, who sell wind turbines, react to this. There are other markets. Europe is already a lot more developed when it comes to offshore wind and onshore wind than the US. But there are pockets of growth in Central and East Europe where companies will be looking to sell into the UK as well. For Ørsted is a big market. So really the developers follow the markets where the best incentives are on offer. So those are CFDs, contracts for difference, things like that, subsidies, and then the turbine makers then follow that. So there are pockets of growth. They may look more to Asia, but for the moment, it looks like the US will be a lot smaller of a market than hoped.
Bloomberg's Rachel Morrison walking us through that Trump story. Of course, you're already seeing it in the market reaction today. We thank you so much. Guy, you're the one who flagged this early on this morning, that you might actually see some sort of ripple effect in Ørsted investors. Rachel was talking there about what the kind of driver of this might be. In the U.S., his base is not a fan of renewables. There's been a real point of contention in terms of spending from Biden as well, and perhaps that's one reason.
What's interesting, though, is red states have had a really big boost from government spend coming through into this space. So in some ways, that's quite counterintuitive for his base not to be in and on board with this as an idea.
Yeah, and I think it's also coming at the fact that some of the kind of big oil is not renewables kind of narrative is still so plagued into there. But you've seen the likes of major oil companies, Exxon, Chevron, who've actively, to cater to Biden's agenda, kind of rejigged their capacity, leaning into carbon capture, leaning into renewables, are now saying, wait, hold on a second, we kind of maybe want to keep that allocation that we've moved around on. So that's something to explore in the coming months and certainly in the coming years as well. Coming up on the program, we go back to the markets. Europe's biggest equity bulls say the region can't beat the U.S. in 2025. That conversation next. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session and not much doing really on European equities. The CAC 40 in the red, though, down 0.1%. Maybe a bit of a hit from luxury there. You've got LVMH suffering this morning, but nowhere really making major moves this morning, Kriti.
Yeah, certainly something to keep in mind. Of course, this is through the broader market reaction. We're continuing to see a sell-off, specifically in the tech sector, Guy, when we were talking about that kind of pain that we had seen in yesterday's trade. Some of that's seeping into Europe, but I actually see SAP as one of the major kind of upside contributors to the Stock 600 this morning.
It's interesting, isn't it? Tech's actually doing okay here. It's a mixed bag, but tech is doing kind of relatively well. So that's an interesting story. What I'm watching as well is what is happening in the bond market. Yields are actually moving a little lower this morning, certainly on the 10-year tenor across most of Europe. Just want to check in on the 30-year just to see what's happening there, because that's where the action was yesterday. UK's down a little bit. Elsewhere, we're actually seeing long European bonds moving a little higher in terms of the yield story. This is the core of the story that we're watching so carefully at the moment.
Yeah, that kind of interplay between the bond market and the stock market. When it comes to the stock market, though, we've seen such a sell-off in Europe, this doom and gloom look. Is that a reason to be more bullish on Europe? Well, a few of our guests on the show think that maybe it's the right time. Take a listen.
You see these indexes that actually have performed well this year, some of them more than the S&P equal weighted, and therefore you shouldn't ignore them completely. Great companies, strong indexes. Yeah. Don't ignore Europe.
There's a few things that could give us hope that Europe is going to see, if not double-digit upside to the market next year, then at least very high single-digit upside.
In Europe, there's a lot of companies in today that meet our criteria of being long-term winners. It's the European stocks today that have been dislocated last year that I think look a little bit more interesting.
Feels like we start every year this way. Europe's going to outperform. We're going to get a better performance coming through. The disappointment doesn't take long to show up. Deutsche Bank strategists have also turned overweight on European equities, citing opportunities for stocks to tactically outperform US peers in 2025. The team led by Maximilian Uller expects a 50% upside for the Stoxx 600 by year end. He joins us now. Max, good morning. Thanks for taking the time. What gets us to 50% upside on the Stoxx 600?
Good morning. Well, I think there are 5 reasons, actually. I think the political uncertainty is getting better or lower. I think we'll have very positive earnings surprises in January, February. I think economic surprises are better than people kind of price in right now. I think China will be a positive surprise. Plus, look at the rates differential, right? We're talking about overweight Europe versus US. Rates differential between Europe and US, a lot more favorable for Europe than for the US. That's a very short summary. Happy to discuss.
OK, so when you take those arguments to particularly US portfolio managers, what do they say? How much pushback do you get against this idea? How high is the barrier at the moment for people listening to what you have to say and committing capital to Europe?
Yeah, so I think US investors are quite far away from buying European equities yet. I think there are 3 phases. First one is rather short-term money moving back into Europe. We see an underweight or net short in hedge fund money. Then I think the next step will be European investors, and then lastly, US investors. I think for US investors, we need 2 of those triggers to really happen. And that is, one is better politics in Europe. So we need a new coalition. We need reforms. I think that will drag in more interest from US investors. And number 2 is really good, effective communication of the next stimulus program in China. That's also something that's perceived to be very positive for Europe. So once we have those 2 triggers, I think US investors will come back. But again, that are not the investors that I expect to come very short term.
Well, Max, let me follow on your first point, then we'll get to the China piece as well. When you talk about kind of the levels to buy here, we look at it a lot in terms of the rate space. That if you say hypothetically a 10-year at 4.50 or a 10-year at 5% could disencourage or disincentivize investment in the U.S. Does the same apply here in Europe from international investors? If you see parity on the euro, does it incentivize more fund flows into Europe just from the currency move alone?
Yes, so rates and currencies, I think both are 2 aspects that are getting a lot more favorable for Europe. Look at the impact of a stronger dollar on earnings. I said earlier that we expect about 10% earnings beats for Q4 earnings in the coming reporting season. And that's not even yet pricing in the higher dollar. So the higher dollar is supportive also for European exports. I think that's a positive. And on the rates differential, I think 250 in the bond, that's really not hurtful. If you look at credit spreads in Europe, no problem at all. If you look at how the risk return is in economic data and the reaction function of rates, it's very different to the US, right? If we have weaker PMIs, for example, in Europe, we've actually seen a positive market reaction because investors are anticipating the ECB to be cutting more. If we have positive news flow on economic data, we barely see any reaction on the Bund. Look at what we've seen with the inflation data earlier this week. Barely any reaction of the Bund. That was more driven by US data. And very different picture in the US, right? You get stronger job data. Equity market is reacting more negatively because markets are already expecting 3% perfect US growth, and any disappointment will be a disappointment for equity markets. So I think pretty different in the setup. And again, stronger labor markets in the US, higher rates in the US, and that's been the key worry this week.
So that's the relationship with the U.S. Let's talk about the relationship eastward as well. You mentioned the China angle. We talk a lot about on the show what the China playbook should be when it comes to the European equity market. Is it as simple as buying and selling luxury? Is it as simple as buying and selling basic resources at a time when the Chinese are trying to pump in this fiscal stimulus with mixed results?
Absolutely. So I think it's too early. And I would still want to wait for the communication that we'll see probably later in March and how effectful that will be. But don't forget that our estimate, for example, is that we'll have 10% more fiscal spending in China in 25 versus 24. That's quite massive. That should have some positive result. I just think the communication so far hasn't really been that positive. From a sector perspective, we are not yet overweight luxury. I think for that one it's too early. We still need to see results to get more credibility for those stimuli. For example, higher retail sales or sales in general in the sector. We haven't yet seen that. Maybe Q4 earnings season gives a first hint, but I think for that sector specifically, it's a little bit too early. But again, we have so many catalysts. China would be a little bit of a wild card late Q1. That would be another push for Europe. I think the other four catalysts that I mentioned earlier, they're already enough to push equity markets higher. China would be a very positive and welcome wildcard for Europe.
Max, where you talk about the bond stocks relationship, does it apply to the UK as well? You've seen this rise in the 30-year gilt yield. How worrying for UK stocks is that? Is it kind of an anomaly, the picture here in London?
Yeah, within Europe it is, right? Indeed, you have a bit of a similar situation in the UK that is similar to the US. However, if you look at the export structure of UK companies, they're very much more international than, for example, US companies. We've touched upon, or very shortly, your colleague touched upon minings, metals and minings. I think for that sort of industry, it's less relevant. And then again, for the banking sector, it's actually good news that we have higher rates, because that means higher NII for longer. So yes, it's more of a drag for UK equities than it is for Eurozone equities. However, not as tough as it is for US companies, I would think.
And you're not really worried about all this latest inflation data that we've had this week forcing the ECB to be more cautious and giving less of a helping hand?
We think that the inflation data that we've seen recently, that they're very temporary, quite some base effects. Our view is that inflation will come back down below 2. And if you share that view, then I would think that we are very likely going to be at 150 in Eurozone rates by the end of the year. I mean, compare the current environment to the 2010s, you'll find a lot of parallels, right? We have inflation, which we again think will be below 2 later this year. We have economic growth around 1%. We have high debt to GDP ratios in some of the core countries, so very similar to the 2010s. However, rates right now are at 3 versus average 0 in the 2010s. So quite a gap. Neutral rates are probably a lot lower, terminal rates also. So I think clear trajectory for the ECB to be cutting.
Max, great to catch up. Really useful insights. Everybody watching what is happening with the European picture as it develops through 2025. Maximilian Uller, Head of European Equity and Cross-Asset Strategy, joining us from Deutsche Bank Research. Thank you very much. Let's talk about what happens next in Europe from a different angle. The EU must be ready to defend itself from possible punitive trade measures emanating from the new US administration. That's the message from the EU Commission's Executive Vice President, Stéphane Séjourné. He spoke exclusively to Bloomberg's Ollie Crook about how the bloc plans to respond to the new US administration.
Europe will remain an open market and will not become a closed one. There's no gain in a trade war. However, Europe cannot be the only continent open to global overcapacity. Across the globe, markets are increasingly protective, with state aid marking our industries uncompetitive. This must be addressed. We have both offensive and defensive trade instruments that we must activate as part of a comprehensive economic strategy. This marks the end of European complacency or excessive openness. We need to protect our industries when they are not operating on a level playing field.
And one of the great risks to the European economy and indeed to European industry will be tariffs that have been promised by Donald Trump, obviously something that you're paying very close attention to. I want to ask specifically about steel tariffs, because if there is no deal by the end of March, as you know, there will be steel tariffs between the United States and Europe. Are you prepared to support European industry if that comes to pass?
Regarding steel, there is no automobile or wind power industry without steel. So if we want to be able to build automobiles and wind turbines in Europe, for example, for carbon neutrality, we need a European steel industry. We will have a plan to protect the steel sector from global overcapacity while ensuring competitiveness. I'm prepared to explore both defensive and offensive actions with my colleagues at the Commission. This is a dialogue that we will have at the Commission. I still hope to convince the next U.S. administration that we have everything to lose from a collective trade war. Europe is an economic power with 450 million consumers and must be viewed as such. Our goal, our responsibility, is to be united as 27 nations to be able to negotiate.
The EU Commission's Executive Vice President Stéphane Séjourné there with our very own Oliver Crook in Brussels. Ollie joins us now from the Bureau. Ollie, I love that you asked him about steel tariffs, these quotas that are hanging over and basically on ice until Donald Trump takes office. What's the roadmap? How are the Europeans preparing?
Yeah, so listen, I mean, this is a new job, the executive vice president, technically, for prosperity and industrial strategy. You know, we call it the competitiveness commissioner. And basically what he is tasked with is basically implementing a large portion of the Draghi report across a number of different industries. But again, one of the main focuses that they're going to have very, very early on is this question on heavy industry, because we have not got very specific details about the actual policy levers that they're going to pull. I think this was more of an instructive conversation in terms of how they're thinking about doing this. And really, I think for Stéphane Séjourné and this competitiveness commissioner, it's all about bridging the old industries to make sure that the old industries, that the new industries are dependent on, like steel for, say, wind turbines and automobiles, basically the old industries don't die, while at the same time investing aggressively in the sort of new industry. So that means supporting steel, aluminum, heavy industry, the autos, but also the chemical sector, to a point that there is enough of that in order to throw it forward into this sort of question about renewable energy, you know, battery technology and these sorts of things. But frankly, these are not areas in which, you know, Europe is really winning right now. They do have some strong sort of wind companies. Solar, they certainly are not at all really players. And again, sort of the chemical sector and all those sorts of things are some of the things that have been the hardest hit. So the question I had for him, because if he's going to implement the Draghi agenda, a large part of the Draghi agenda is spending up to about 800 billion euros every single year. I asked him if it is realistic for them to do so without the use of joint debt. Have a listen.
Yes, it is realistic because, first of all, if we add the competitiveness policies of each member state plus the European budget, we are not very far from the investments that need to be made. I will push to implement the whole Draghi report and nothing but the Draghi report, all the components, including the investment aspects.
So listen, they need to implement this Draghi report. He's saying that basically they don't necessarily need to tap joint debt in order to do that. Again, this is a very sort of sticky and thorny issue. And I think once you get more concrete plans about where money would actually spend, you can actually start talking about that. We will get the sort of new clean industrial deal. That is something that we're going to get a lot more detail on. That will come in February. But again, these are sort of the way that they're sort of trying to frame this, going in not only to a sort of very more hostile environment with the Trump administration, but again, the prospect of a trade war between China and the United States. That means a huge amount of overcapacity coming into Europe, and that is something that is weighing on these officials right now.
Ollie, great stuff. Great interview. Thank you very much indeed. Ollie Crook joining us after that conversation. How does Europe progress from here and deliver on Draghi? Coming up, we're going to be talking more about what is happening in these markets. A firm focus on what is going on in the bond market still represents kind of the centre of gravity, I think, for a lot of people right now. We'll talk more about that next. This is Bloomberg.
Sea cargo is responsible for 3% of global greenhouse gas emissions annually, and ports are a major contributor. As Mexico's first carbon-neutral port, ICTSI subsidiary Contecon Manzanillo is setting the standard for progress by deploying electrified cranes and tractors, recycling and reusing resources, and offsetting emissions by allocating resources to preserve critical ecosystems. This demonstrates how ports can be drivers of positive change and sustainable growth.
Can you set the record straight? Is Greenland still not for sale then?
We have had that discussion already, and I don't think there's any good reasons to enter that again.
Can you assure the world that as you try to get control of these areas, you are not going to use military or economic coercion?
No. I can't assure you. You're talking about Panama and Greenland. No, I can't assure you on either of those two. But I can say this. We need them for economic security.
Donald Trump speaking there yesterday, certainly putting the cat amongst the pigeons. The comments from Denmark's Prime Minister, that was back in September. President-elect Donald Trump speaking yesterday. This is still a live issue. Trump declining to rule out using military force to either seize the Panama Canal or Greenland. Let's bring in Bloomberg's Brussels bureau chief, Kevin Whitelaw, who's got long experience of covering these types of stories. Kevin, what should we make of the comments yesterday?
Well, look, I mean, this really was a throwback to sort of the freewheeling style that we all sort of got used to in Donald Trump's first term, and it is a it is a reflection of what he's thinking at any given moment, but it's not necessarily something that tells you exactly how things are going to play out over the next days, months, or years. Greenland was an issue he talked about as president the first time round, and he talked about having an interest in it. It never ended up really going anywhere other than causing a little bit of a stir. He's obviously back at it now. I think the question down the line is going to be, what exactly does he end up doing? How seriously does he pursue it? And what does that really mean? You can see that Denmark is already trying to find ways to blunt some of this. They're saying that they're open to deals. They're ready to do business. Greenland's open for that. But at this point, obviously, there's zero interest in trying to indulge Donald Trump in the idea of somehow purchasing Greenland.
Well, Kevin, I just want to kind of nerd out on Greenland for a moment, because I want to argue the other side of this. Does he have a point here? I mean, when you Google this stuff, there is ancient Cold War doctrine that says the U.S. already has military access to this part of the world. Does he have a point in terms of pursuing whatever it is he's pursuing in this part of the world?
Well, I mean, to the degree that the U.S. may have national security interests, there's already a certain amount of U.S. military presence in Greenland. And so, the idea that the U.S. would like to expand that is something that actually could happen within the existing structures, right? I mean, this is all part of sort of NATO and other existing security structures. So it's a question of what exactly he is looking for here. And is he looking for something that is about sort of bolstering a military presence? Is it about access to some kinds of minerals? Or is he really looking for the prestigious idea of something that is about enlarging, the United States and sort of having the Trump purchase, if you like, and as sort of his real estate days coming back to roost. So I think ultimately the question down the line is going to be, what is it he's really looking for? And I'm not really sure, even though this issue has come up before, that people have a fully clear idea of why he is so fixated on Greenland.
Well, on the military theme, Kevin, he's also asking NATO allies to spend 5% of GDP on defence when the US isn't even doing that itself. Are we meant to take it that this is what he's going to do? Do we, by extension, take any of this seriously, or is it really all noise?
Well, I do think it has to be taken seriously, but maybe not literally. And so, obviously, Trump was pushed Europe very hard on defense spending in his first term, and a number of European leaders, including the former and current Secretary General of NATO, have credited him with helping to drive this issue and helping to focus European countries on the need to spend more on defense. Obviously, the war in Ukraine has only solidified that and made that more urgent. When Trump was president before, the target was 2%. We still have 2 or 3 countries that are just barely getting to 2%. And NATO itself is talking now about 3% as sort of the new idea of a notional target. If they get to 5%, there's simply no fiscal room in most European budgets and probably not the U.S. budget also, given the tax cuts that Donald Trump is talking about. But is Europe going to feel the pressure to keep boosting spending on defense? Yes. Are they going to feel the pressure to keep boosting spending on Ukraine? Yes, they will. And that's exactly what Donald Trump wants them to feel.
Yeah, you go for the maximalist approach, you push the numbers high, and then you maybe deliver a more realistic number. Kevin, great to catch up. Thanks very much indeed. Kevin Whitelaw joining us on the politics, the geopolitics. Let's talk about kind of what is coming up a little bit later on in terms of the data, Chrissy. Data moved the market yesterday in a fairly big way. And we saw the ISM services number really kind of moving things around. The JOLTS number can't be ignored either.
Yeah, the outperformance that you're seeing basically in the United States continuing to take those Fed rate cut bets off the table, potentially more in the hours ahead. At 1:15 p.m. UK time, the ADP jobs data, the private basically numbers are going to come out, potentially kind of paving the way for what we're going to get on those non-farm payrolls as well. 1:30 p.m. UK time, some Fed speak from the Fed's Waller on the economic outlook, and then the ECB speak to fall that 5:15 p.m. UK time. Villeroy speaking in Paris. And then, of course, maybe the main event, 7 p.m., the FOMC minutes this morning.
It's going to be fascinating.
This afternoon.
Yeah.
Whenever it happens.
This evening. I think it's 7 p.m. UK
7 p.m.,
time.
so evening.
So evening for us, close to bedtime. I'll be taking a look at what is happening. I go to bed early. So does Valerie, I suspect. She's sitting around the table joining us to discuss all of this. We could get a hawkish set of minutes, which would be interesting as well, because that could even add extra juice into this bond market move that we're seeing right now.
Yeah, the question is just how, the market's already very much adjusted to the hawkish surprise we got in December. Is there really going to be anything in these minutes to kick it more, right? Yeah. Well, right now, the market is pricing in a Fed on pause until July. So that's a substantial amount of next year where the Fed isn't active. Maybe we do get some hints in this minutes on just how close that call was to cut rates in December, maybe foreshadowing, that descent that we did see. Maybe this Fed is going to be on hold longer than they expected. The cementing January is what we might, get from these minutes. But it's not going to surprise the market very much. What I do think the market is going to focus on is the political side of the story for the Fed. We heard from Fed Chair Jay Powell in the press conference talking about some members already having adjusting their forecasts, preempting these economic policies we're likely to get out of Trump. Just how much did that play in the discussion? Just how much did that play in their revisions to growth and their upward revisions on core PCE growth for 2024? I think that's what the focus is going to be.
You had Ben Rahm earlier on the program talking about a one standard deviation move being anywhere from 330 to 550. That was the range he suggested, at least that the Treasury markets are pricing in. Is there a case for 350 on the 10-year?
Look, we would have to see a very big shift in the economic outlook for the U.S. We'd have to see this economic data turn around. We've not gotten that at all yet. We've had a string of hot data to start the year. Maybe NFP on Friday changes the tune. But to get a big rally in the Treasury market, we'd definitely have to see some weak economic data.
All right. Bloomberg's Valerie Teitel walking us through the Treasury market dynamics. And we had her this morning, like I said, saying what is actually driving these markets. And she gave me a laundry list of things. There's just no way to narrow it down because everyone is hedging and preparing in a different way.
We're waiting for Trump. We're waiting to figure out. That seems to be the biggest variable right now. Yeah. What happens on the 20th? What are we really going to learn? Everything feels like preparation for that.
More uncertainty. That's what happens.
Yeah, the uncertainty is there's just, as Valerie says, just multitudes of multiple factors being folded into the market at the moment. But how much of it's accurate and how much of it's not? This feels like a really difficult January to navigate. Ed Bastian's going to be joining the team a little bit later on. That conversation from the Delta CEO coming out, I think, of CES. Looking forward to hearing what Ed has to say about the global economy. That wraps things up for the opening trade. The Pulse is coming up next. Hope you enjoyed the show. This is Bloomberg.
तो गाइस इन्वेंट्री नेगेटिव पॉजिटिव ही आई है बट इम्पैक्ट कुछ भी नहीं हो रहा है। गैस में कुछ खास इम्पैक्ट नहीं हुआ है, साइडवेज चला गया कम्प्लीटली। क्रूड ऑयल एज एक्सपेक्टेड वीक लेवल था, वीक सपोर्ट, थोड़ा बहुत रुकने की कोशिश ज़रूर करी बट ब्रेक डाउन करके नीचे ही आ गया है। जिन लोगों ने ट्रेल किया था वो लोग अपना पूरा प्रॉफिट अब बुक कर सकते हैं। नीचे एक सपोर्ट है कल वाला, यहाँ पर थोड़ा बहुत रुकना चाहिए प्राइस को। एक्सपेक्टेड है सम बाइंग ओवर हियर, थोड़ी बहुत बाइंग आएगी। ये कल काफ़ी एग्जॉस्ट हो चुका है सपोर्ट, तो ध्यान रखना। सिल्वर को देखोगे वही रेजिस्टेंस से थोड़ा बहुत रेजिस्टेंस ले लिया वापस, स्टिल अभी भी रेंज के अंदर ही है सिल्वर। सुपर साइडवेज नेचुरल गैस, सुपर साइडवेज। भी करते रहो गाइस। आज और कोई डेटा नहीं है, कल ध्यान रखना, कल यूएस मार्केट क्लोज है शायद। ठीक है, कल शायद यूएस मार्केट क्लोज है तो हो सकता है वॉल्यूम ना रहे या वॉलेटिलिटी बहुत बढ़ सकती है। अच्छा मूव कर गया है, जिसने यहाँ तक भी प्रॉफिट बुक कर लिया था उसका भी बढ़िया है। जो लोग ट्रेल कर रहे थे दे गेट ऑलमोस्ट 150 पॉइंट, बट आई नो सबने ट्रेल नहीं किया होगा, बट जिन्होंने भी किया यहाँ पर थोड़ा बहुत रुक सकता है। देखो यहाँ पर बाइंग मैं ये नहीं कह रहा हूँ नहीं आएगी, बट ये थोड़ा सा ना एग्जॉस्ट लेवल है तो क्वांटिटी कम ही रखना। इन्वेंट्री भी नेगेटिव ही थी क्रूड के लिए। ये देखो अगर गया 6270 तो फिर और गिर सकता है प्राइस उस केस में।
Dynatrace helps that individual to augment their intelligence, so to speak, to do that for them because of the AI engine, because of the ability to deliver those tailored insights and giving clues in terms of what are the best decisions to act upon the insights.
That I had to make that really, at the time was like gut wrenching and not something that I was used to. Like I was used to just like making money fast and spending it fast and just having what I wanted, you know, to like having to, live in my parents' basement and like talk about like, you know, like past traumas and like that was a very, very, very weird, hard time, and I'm glad I'm out of it, but it was something that was necessary to. I had to take a step backwards to take the step forward and get back to the place that I'm in now.
Right. I think I heard two things there. I'm going to just kind of summarize this. I think that you talked about living life large, and a lot of people do that. So I would think maybe the first one is living below your means, no matter what your means are, as you're growing your business. Right?
Absolutely.
And then the second one is being really conscious, and we can't be conscious unless we know the numbers, right? Conscious means that we have to pay attention to what is actually happening when we make the decisions with our personal finances or our business finances.
100%. Yeah. And I think that like even from a business perspective with KindPen, in the beginning, like, I mean, Anthony and I, we didn't know anything about business. We didn't know like that you had to understand certain numbers and do certain things, and that is kind of what I want to say like made our due diligence process last so long the first time. And if we had certain things buttoned up in the beginning, the company would have been their company when that bad news came out, not ours still. So like if we did things right the first time, in the beginning, we would have probably been successful with that first acquisition.
Are there resources for folks to know how to do it right the first time? Is there like a program or?
I mean, there's definitely like accelerator programs. I didn't go to college. I just kind of, started the entrepreneurial experience right away. But I would say mentoring is huge for me. Like I do have people on my team that I trust to do the things that they're doing. We have vendors that we really trust to do the things that they're doing. But I still want to like bounce those things off of people who have more experience than myself and some of my team members and vendors, So I think like finding a mentor in the beginning of starting a business, I think would be like my number one suggestion.
Right, that's great advice. Thank you, Jadis. Please hold that thought. We're going to cut away to a quick break here. Welcome back to Living Not So Fabulously. We're going to resume our interview with Jadis. So I want to kind of start tacking to Motivo Scar Company, but before we do that, it almost seems like you're experienced at like failing forward. When you hear a comment like that, how do you feel? How does it make you feel?
I mean, it makes me feel like I learned a lot that I can take now and do the right things with going into this new venture. And I feel more prepared, even though there's no like industry crossover between what I did and what I'm doing now. But a lot of the failures that I had at my time during KinePen have really, they molded me and shaped me into who I am and gave me made me more prepared for Motivo.
Nice, I love that. So what's the elevator pitch for Motivo Scar Care?
So Motivo Scar Care creates inclusive and performance-proof scar care products that help diminish the appearance of old or new scars.
Wow.
So
And much needed.
I think that's applicable to almost everyone, right? Almost everyone we know has some sort of scar that is showing or not showing on a regular basis and wants to have it covered up, right?
Yeah. Over 50% of Americans have at least one visible scar on their body.
Oh, wow.
And a lot of people who have scars have either gotten them from some type of traumatic situation or a reason that they didn't want them. So, I mean, our hope with Motivo Scar Care is that if we can kind of help you diminish the appearance of that scar, get rid of it, that you can kind of start to move past whatever trauma came along with how you got that scar.
Gotcha. So you're in the healthcare space. What are you seeing on the horizons? What's new and hot that maybe our Yahoo Finance investors might want to tap into?
So actually, what we are trying to do differently with Motivo Scar Care is fill the white space of scar care within the beauty industry. Because I think that scars really impact how people internalize their beauty and how they feel about themselves. So I don't think that I would be walking to the first aid aisle to look for scar care. I'd go to like a skincare aisle. So what we really want to do is bring this into the beauty industry, where people are really more like appearance conscious shoppers and people overall.
Yeah, I've never really thought of the blending of the two together, but now that you articulate it, it makes total sense.
Yeah. I mean, medical grade, scientifically formulated products to help diminish the appearance of scars in the beauty industry. I mean, it makes more sense than, I mean, if I'm going to first aid, I'm looking for like active wound, you know,
right?
Versus like post wound care. Like, how do we figure that out?
So, what was the motivation then? If you had this experience, and obviously it was enjoyable experience, I think for the most part.
Yeah.
But then having to move back into your parents' basement.
Would you like to move into your in-laws' basement?
No.
I highly don't recommend.
Yeah. What was it that said, I am going to do this again, right? I'm going to take this risk. I am going to try this
Where'd you get
again.
that courage?
Instead of saying, okay, now I guess I learned my lesson. Now I'm going to go get my W-2 and try to climb the ranks that way to make my money.
I've never been a person to like be able to just follow rules and do the whole, I don't know. I've always felt like I was meant to do so much more, and like I have a meaning within my life. And I feel like I've been two different people in this lifetime. You know, I've lived majority of my life growing up in early adult years as a female. And then always knowing that like I wanted to transition since kindergarten. And once I did that, and I went through that process and my experience with top surgery, and you know, I knew that there was something here with this. There was a big gap in this market and a real need for more innovation on the products that existed. And I don't know. It was something. It would wake me up out of my sleep. You know what I mean? A lot of the ideas that I have had with Motivo that we've brought to life were like me waking up at 3 o'clock in the morning, like, oh my God, like writing it down in my notes, and there's just a push. Because it's not fun.
Right.
Yeah.
They're fun, right? Obviously, they're fun aspects, right? Especially
but it's hard work.
When you see the progress and the excitement, and your product rolls out, and people are buying your product and all that. You bring it. It's always, entrepreneurship is always an uphill battle with someone, whether it's yourself or a customer or a potential acquisition. There's always some sort of battle on the horizon. So you definitely have to prepare for that.
Yeah, you have to want this, and the want needs to be more than the monetary success that you'll get or may get at the end of it, because you very well likely, like, probably won't get that. A lot of startups fail, especially, like, I mean, even just trying to raise capital as a LGBTQ founder, like less than 2% or less than 1% of VC dollars go to LGBTQ founders.
Right.
Yet we create more successful businesses. So there is that, I don't know where.
Logic
Yeah.
Why the gap?
That brings up a good question. How can LGBTQ plus consumers, the community, support other LGBTQ plus businesses more than maybe we already do?
I feel like doing your research and being mindful of where you spend your money, and the communities that you surround yourself with. And I think, I just being more conscious of how you shop.
Yeah.
And that supports, like, not only LGBTQ, but minority founders as well. And just as a whole, like small business owners, which make up a lot of businesses in the USA. I mean, majority of them are small business owners, and, you know, could be minority, could be women, could be LGBTQ. So just knowing who you're shopping with really makes a difference.
So rapid fire here. What are 3 small business hot tips that you might be able to share with the entrepreneurs who are listening or watching, that want to learn from you?
Definitely get a mentor. That is a more than likely free resource that can help you with multiple aspects of your business, depending on the person's expertise. I think one of the first real people I brought onto this company was a CFO. I think especially in CPG, if you don't know your numbers, you can really go down quickly. And then just really try to take a step back from working in the business, and also, like, because your personal brand means so much, especially, like, to the point that we made about people realizing who they shop with. You know, putting yourself out there, giving yourself a personal brand that also ties into the brand that you're building, I think will really go a long way.
Yeah.
I really appreciate that last point, because we oftentimes see that entrepreneurs hide themselves behind their business.
I wish I could all the time.
and we live in a world where people really want to be invested in the people that they see doing good things.
Yeah.
Right? If we are doing good work with our and we can do good work with our business, then people will invest in not just the business itself, but they're also investing in us and our dreams and our passions and our mission.
Absolutely. I mean, do you want to, you know, shop with a faceless corporation, or do you want to support, you know, your neighbor, your friend, someone you resonate with, and someone who you can emotionally connect with, and that you just overall think is a good person? I mean, that, to me, at the end of the day, like, I don't care what you do, what's best for your household is what it is, as long as just be a good person. That's all.
That's what it all comes down to.
Yeah, exactly.
So I'm going to ask you to take a step back, and as our last question here, and with all your hard-earned success, what would you say is the one big takeaway that you've learned? Whether it's applicable to finance, business, or just life in general.
To be yourself. If I didn't take the time to step back and authentically, like, you know, go through my transition to become myself, Motivo wouldn't be a thing. Maybe it would be a thing that someone else created, but it's taking the time to be myself and learn myself, and it really put me on my path. And I think that, as not fun as owning a business and building a brand can be sometimes, it makes it so much more worthwhile.
Absolutely. Thank you so much for sharing your story. It's so inspirational.
Thank you for having me. Appreciate you.
I love that interview with Jadis. Jadis shared so much with us, especially around this idea of failing forward. And I think it's important for us to remember that. I mean, we've had our own experiences of not being able to get the success that we want when we want it. And that's always this learning cycle that we have to go through. And as you have shared with me so many times, it's not failing, we're learning. And one of the ways that Jadis shares that we can really learn is by having a mentor. I also really appreciate this, that your mentor doesn't need to cover your whole business. Sometimes it's best to have multiple mentors, one that can help you with one side of your business and one that can help you with another. I think that really can help charge your success.
Yeah, I definitely love that. Two other suggestions that we would add is, one, try to avoid chasing all the disco balls, especially because of social media. We can see somebody blowing up with a particular strategy or doing really well on another social media platform, and we think that we have to try those things ourselves. Find what works for you and lean into that until you can prove that it doesn't work for you, and then maybe at that point tag. The other suggestion that we would have is build one bridge at a time. Probably also because of social media, so many of us tried to build multiple income streams simultaneously, and that rarely ends up being a recipe for success. Build one bridge at a time, get successful at that, get it monetized, and then maybe start to build other income streams.
Can that bridge be a catwalk?
It certainly can, sir. Thank you for joining us for another episode of Living Not So Fabulously. Don't forget to join us every Wednesday at noon Eastern Time on yahoofinance.com, your favorite podcast player, and YouTube.
Remember to click that notification button, like and share, and until next time, stay fabulous.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
In these incredibly complex environments, end-to-end observability is no longer optional. It has become mandatory.
Next up, we want to talk about Meta facing backlash after CEO Mark Zuckerberg announced plans to end the company's fact-checking program, also announcing the addition of UFC CEO Dana White to its board. Meta employees criticizing the decision on the company's internal messaging board. Zuckerberg says ending the fact-checking program is part of the company's plan to go back to its roots around free expression. Another criticism gaining traction on social media, the watch that Zuckerberg was wearing during the announcement, which cost nearly $1 million, according to Bloomberg. You can see the stock down today, but that is part of a broader sell-off, not necessarily related to this news, I don't think. But it is interesting because we have seen kind of this shift from a lot of companies, not just Meta with regards to fact-checking. We've also seen some of these DEI programs closing, big banks announcing that they are getting rid of their net zero emission pledges, for example. And we've been talking in our meetings with the team about the kind of reaction function and whether or not you'll see a negative reaction from internal employees. Sometimes that can lead to cultural shifts. It's interesting to see this internal messaging from employees as one potential example of that pushback. Whether it changes anything at Meta, though, I highly doubt.
Yeah, and I don't think this is to any surprise, right? Just given the timing of the shift, maybe what this signals here for the years ahead, you can certainly see why maybe Mark Zuckerberg is doing this from a business strategy standpoint, just given the pressure and given some of the rhetoric that we've heard from President-elect Donald Trump, not only towards Meta, but also some of its competitors there during his first term. But I think the big question is whether or not this is really going to pave the way for a spike here in misinformation and how to best handle that. And I think that is at the crux of the issue and why we could, when we talk about potential backlash there and that potentially escalating inside the walls here of Meta, then what that exactly looks like and what that employee pushback looks like. And then, of course, how management is going to handle it here. But I think the path forward here for Meta, lots of questions about whether or not they actually did become too restrictive. Obviously, that's arguments that are heard from both sides of the aisle on that. And then whether or not it was prone to over enforcement. One of the questions and one of the talking points that have been brought up here over the last 24 hours. But again, when you have a move like this, a dramatic move like this, and also the timing of this move, it's likely then to spark some of these types of conversations.
Yeah, absolutely.